Good morning. Online, offline, everyone. Good morning. Let's begin a small subject in CA Final called as AFM. Actually, it is small. Compare it to some other smaller subjects. Like for example, in Group 1, you have one very small subject called as FR. Okay. Some 5 modules, 2800 pages. That's it. Okay. So compared to that, this is actually small because it's only one module if you see. The ICA study material is one book. A little thick it is, but it's one book. Okay, but CA Final. So obviously intensity will be very high. But let's start on a very positive note. The only paper, let me tell you, the only paper in CA Final, if there is a possibility of scoring 100, that is this paper. Only paper where you can score 100 out of 100 is this paper. I mean, people have scored before, that's why. Okay, FR, the possibility is there, but writing speed has to be extreme because the paper is usually accounts, right? It will be usually lengthy. Then audit, there is no real possibility, I feel, because theory, right? Anywhere they can cut marks. Somewhere they don't like something and they can, 89 and all was the highest, I think, audit. Then group 2 taxation, it's possible, but no one has scored DT, GST. The last paper, it's very new, so we don't even have that much data to back up. But AFM is the only paper where people score 80s and people score 90s. Till Jan 2026 happened. Okay, when Jan 2026 happened, they suddenly thought, oh, AFM is difficult. See, now it's about the student's mindset. You are paying fees for the course. You will get the books like that. Thick books will come to your house, correct? You are paying fees to write the exam. Go to the exam center. They'll give you answer papers. How much ever you want extra sheets you take, write. That is the money you are paying. You know, in CA Inter, you would have learned something called as purchase consideration. Okay, in accounts, not in FM, you would have learned something called as purchase consideration. That means if you want to purchase something, you have to pay something. So therefore, here also you are paying a consideration. For paying the consideration, what you get in return, you get the books and you get the answer papers and the place to sit and write. Correct? Now, you are not paying any money or you are not getting any money to predict papers. Correct? So don't do it. Don't predict papers thinking, last 5 attempts, this question came. This pakka will be there for 8 months. This I'll study properly. This didn't come only, so I'll not touch it at all. Okay, you can't do that, right? Because you're not having any awareness about that. One more thing is, you're not paying any money or getting any money, okay, to decide the marks. There will be people, no, they'll be like, FR I'll score 60, AFM I'll score 80, audit I'll score 40, pass. Correct? When studying only, looking at the index only, some people will do the decisions. Okay, this paper I have to score this much. Looking at the index itself. Correct? Don't do that. Because a lot of people in Jan 2026, what happened was, their prediction went bad. They saw September 2025, they saw May 2025, they even saw the previous exam, November 2024. Okay, those AFM papers were very easy. Very easy. They saw people scoring 70s, 80s for fun. For fun they were scoring because questions, if you see, when we go to problem solving, you'll see questions were like very, very similar to ones which were there in old RTPs or ones which were there in study material. So people were scoring 70s and 80s. So when they went with the mindset to Jan 2026 that AFM I have to score, FR and audit will push little. Okay, you know what happened when they went to AFM exam. Okay, what happened is exactly what happened in this cover page. What happened in this cover page? Very beautiful, right? I sat for 1 week and designed this cover page. Or I sat for 2 minutes and gave one prompt to ChatGPT. Which one? ChatGPT only, no. That is exactly what happened in Jan 2026. That's exactly what happened in Jan 2026. ICA also has learned ChatGPT now. They'll just go and tell, mergers and acquisition, ICA level exam, CA final level question. Please prepare. First, second, third and all will be bad only. Yes, good morning. Yes, first, second, third and all will be bad only. But keep prompting it. It will give you a very good question. And that very good question is not there in the database because it was not there in any old RTPs, no MTPs, no previous year papers. So what happened in Jan 2026 is exactly what happened in this cover page. ChatGPT. Clear? You think what? I designed this bull, I designed this bear and all. No, nothing. Sorry, first of all, this bull is not there right now, okay. Only bear is there. Okay, if we are seeing the current market, there is this animal is extinct. Only this animal is seen. Other day only some 5,000 crores something wiped out from the stock market, right? But next day little recovery happened. But people who lost money. So all this designing and all I did not do. Okay, only thing I told ChatGPT is this is a CA Final cover page and this is my name. Okay, that only it did. That is exactly what ICA also did in Jan 2026. Not 100% of the paper, but some level. The irritating or tricky questions were all somewhere. But ChatGPT also has a database, no? They are also searching and creating questions. So they are also ultimately going into old RTPs, old PYPs. Clear? But the day is not far when ChatGPT can make its own question also, just based on concepts. Clear? So what we are going to do is completely this is going to be concept based. Completely concept based. We are not going to buy our things. Okay? As much as possible, we will try to understand why it is there. When you know why it is there, it will remain in your head for a longer time. Okay? That is one thing. And material, some of you who have already have app access, it's already there in the app. Otherwise, by the end of the class today, we'll put it in the WhatsApp group also. You'll get the material there. There are two parts to it. One is around 467 pages. One more also 400 plus pages only it is. It is better if you print it. I'm not forcing you to print it. It's better if you print it because something you can mark there which will help you later in your last day revision and all. Otherwise, if you are very comfortable with your soft copy, it's fine because now full digital India, right? So if you are very comfortable, we are very happy looking into screen, then no issues. Okay, but when you're studying, I mean, I don't have to tell you at final level. When you're studying, if it's in the mobile phone, right? And if you're studying full seriousness, you'll be studying. Suddenly one notification can spoil everything. Okay, we don't want that. At inter level, I tell students, okay, like keep the phone away and all that, because when you keep the phone, some notification, some bubbly notification will change the mood itself. Somebody sent one message. Final, that will not happen. That message will be only from your boss if you are getting it. No bubbly in life. Correct? Only message that can come is from client or from boss. But that can spoil the mood to next level. Okay, articleship, how bonded labor we are in articleship. Okay, so that can happen. I mean, you can always put it to airplane mode and study, but we will also be having FOMO, fear of missing out. If you put to airplane mode, what and all I might miss. Okay, and distractions are too many, especially when we are studying. Distractions are too many. If you have no distraction also, even one Zomato notification can distract you. Correct? Because Zomato also very creative there. They'll send some very creative notification telling that, are you craving for this today morning? Okay, all that they'll send. So when you see that notification, automatically you will also be like, oh, how are they so creative? I'm sitting for 8 hours and studying. Nothing is going to my head. Okay, so let's not, if you are still comfortable, I'm fine with it. But otherwise, hard copy is what I would prefer. Maybe I studied from books, so that's why I'm feeling that way. So, and after that, in question paper, if question paper comes concept based means like Jan 2026. Okay, then you'll smash it because we are going to go with concept based. So it's not that you have solved 100 questions, because what happens is 100 questions if you solve also, ICA gives 101st one, then you'll be little shaky. That we don't want. It should be such that you have studied the concept, we'll still solve problems, because when you solve more and more problems, only that concept gets cemented in our head. But it should be in such a way that with concepts, if you go to the exam also, you should be able to solve. Okay, that is the logic. And if it comes regular means what? If ICA goes back to its old mode, okay, then you'll just hammer it. That should be the situation. That means whatever paper comes, you should do well. That is the moral of the story. Okay, even theory we will revise. Not that much in depth, because theory is also there, some 10-14 marks. Theory will be there in your exam. Target is 100. All boys only in class. So you know cricket. Okay, in cricket there is something called as nervous 90s. Okay, no nervous 90s also. We are targeting 100. But guess what? This is not cricket. If you get nervous 90s also, no, you'll be very happy. Imagine getting 99 in AFM. You'll be very happy, no? Okay, so that is how it's going to be. And the timings you already know. On holidays, we'll extend. Okay. Otherwise, 9:30 we'll try to wind up. How many people are going to articleship here? Okay, majority of the class are going to articleship. Only you both. You're done with the dreaded time. Correct? Now peace, no? Life feels very peaceful. I mean, even studying feels easy, no? When you are going to articleship, you will think every day that these many hours I'll come and watch classes. Nothing. It will get postponed to next day. Yes. So, I mean, we'll not talk about that. It's your principals who face the same thing. They want to give you the same thing. That is the logic. They never thought of making it better or something for you guys. But okay, it'll make you stronger personalities. Correct. That's seeing a good thing in even bad thing. Correct. Otherwise, nothing good is there in articleship. Okay. Only thing is full exploitation, but still, at least you'll be stronger. You will not any other future troubles in life also you'll be able to face. So this is how the material is, and this is part A. In part A, we are going to discuss about mergers and acquisition and corporate restructuring. Very, very commonly happening thing these days. Every day almost you'll find some merger. Okay. Security valuation, that is valuing the price of the shares and bonds and other things. Business valuation, entire company ka valuation. Okay. These two in combo can be asked in the exam. So it's very difficult to differentiate these two chapters. So together only we'll be studying these two chapters, because here you are finding the price of equity share, and that with the debt will become the price of the entire company. So this will be a combo chapter. Then a very small chapter called as startup finance theory it is. Risk management also, if you see, very small chapter. Then you go into a very, very small chapter called as portfolio management. This is part A. In part B also you have some small chapters like derivatives. Okay. Derivatives, the reason why many people might be losing money, Okay, put option, call option, zero. In 10 minutes, market made it zero. Correct. So that we'll study in part B, because some of the basics which we are going to study here will be required over there. That we are going to see. And then very, famous or favorite topic of CA Final students in AFM, Forex. Okay, Forex, that also in part B. Heavyweight chapters there. I mean, almost everything is heavyweight because number of chapters in AFM is limited. So almost everything is asked in the exam. Maybe one chapter might get missed, but even that also in MCQ somewhere it might be asked. So let's not do that ABC analysis and all right now. We'll try to study everything. First chapter is mergers, acquisition and corporate restructuring. Before we go to that, there are certain things that we have to revise, assuming that you remember that there was one subject called as FM. In CA Inter, there was one subject, FM, some people I think FM and SM. Some people it was FM and Eco, I think, right? Economics. So different schemes, different combinations. Yes, so we will try to learn some basics before we go to mergers. These basics are very, very important. Somewhere or the other in AFM, we will be going through or requiring this. Okay. So now, this basic sheet also I'll share it with you. So no need to write that. So our writing will happen directly when we go to mergers and acquisition only. Okay, I'll tell you what to write. Now, and all the study material questions we'll be solving in class. And RTPs and PVPs also will solve, but there will be many repetitive ones which we'll just discuss over there. Okay. So, but we'll try to cover. What we are going to cover is everything from 2018. I don't know. That was the time when new scheme of that time started. Before that also there was a scheme where there was AFM was called SFM that time. Okay, strategic financial man. Nothing, name change. That's it. Subject is same. Okay, and this is a subject which can have no amendments at all. Only amendment is I say we'll add 3 extra questions which are tricky. That's all. Otherwise, what can get amended? Nothing. People who made all these formulas and all, they died. Okay, they are not there anymore to amend it. So God and all those people went. So we don't have to worry about them. So 0 amendments, and yeah, 2018 is the date I have picked because that's when the new scheme got launched. And before that also there was a scheme where there used to be study material plus there was something called as practice manual. ICA used to give something called as practice manual, but nothing to worry. Whatever was there in practice manual, the tricky questions, they are put into the new study material. ICA, just like you guys know, you guys only will go and become part of ICA in future. You know how lazy we are. Correct? They are also lazy. But that laziness has to be detected. Now, before we start, let me tell you one thing, which you might not trust or believe right now. Actually, exams are easy. All papers. Exams are easy. I know you're not believing it. Exams are easy. CA Inter also exams were easy. CA Foundation also, people who came from foundation route, exams were easy. You know what is difficult? Studying is difficult. Studying is difficult. Exams are easy actually. If you see, ICA is not giving some crazily cross-connected questions. 4 chapters merged. Can it frame? Yes. Is it doing? No. They can, right? Practically what will happen? Imagine your DT only. Practically, do you think DT, one person will come with only PGBP? Where you're sitting and calculating only only TDS related question? Do you think that will happen? Only TDS? With that, so many cross connections will happen, right? And only DT. When he's doing business PGBP, only DT, GST applicability also will be there. Correct? No, you're seeing all this in articleship. Such things ICA is not doing. Okay, for that they kept separate paper 6, where they do all this. Not only cross connection of chapters, cross connection of subjects. Now, therefore, exams are actually easy because if you see, it's a huge database. From that database, somewhere they pick, they merge and make one new question. So if you have covered the database, actually it's easy, but studying is difficult. Okay, that I have to agree. Studying is difficult because at this age, there will be a lot of distractions. Correct? In fact, if there is no distraction at this age, then something is wrong with you. Correct? No. If you don't have distraction at this age, then what? At 60, you'll have distractions. Or that time, life will be sorted. Peace. Correct? So, distractions will be there. Let's address that fact. Okay? But you have to overcome that. And now you are in CA Final, so you know how to go into that exam mode where whole world becomes silent. We don't know only what's happening. Iran and US are fighting. We don't know only. Until the drone comes and falls on our building, we'll be studying itself. Correct? So, we know that. I don't have to tell you how to do that. But try to. Like sometimes what happens is after inter, when you come to finals, no, inter will be in crazy study mode. Because it's like that time, it's study time, right? When we go into articleship, you go into work phase. When you go into work phase and then shifting again to study mode, no, it becomes a little difficult. Especially with articleship. Managing studies becomes difficult, but I would really suggest whatever we do, no, 3.5 hours, okay, maybe 15 minutes we'll take break or 10 minutes we'll take break in between, but otherwise roughly we'll have some 3.5 hours class. Please spend at least 1 hour every day to revise. What we do in 3.5 hours, 1 hour you'll be able to revise, okay, you don't have to sit for 3.5 hours again, because many things you'll be like, okay, this we remember, and problems you don't have to resolve again, but some problem maybe which was tricky, which took time in class, that you can just go and try again. But please, don't close your book in class and open the book next day in class. Okay, try to revise. Maybe even in office, if you get some time, no. Now, I think little off season, no. He's already laughing. In office, if you get some time, sir, what you're talking, sir. The time which is no hours also, they are extending and taking, you're telling office, you're getting time. Okay. No, some offices, off season, I've heard, like students sit and study also. Okay, but otherwise, high level of notice is there. Your own clients notice or new clients notice? Why you didn't do it properly last time? Why notice came? We don't want to do it right. Notice should come, then little more income. Client doesn't realize it. Imagine client start asking question. You only filed return, right? Why didn't you do it properly? Then you'll simply tell, you didn't give me all the information. You wanted to pay less tax. Simple, no? But notice is good. I mean, from practice point of view, not from articleship point of view. Yes, let's start with the basic concepts, okay? These are some basic concepts. Some of them you might feel absolutely silly. Why are we seeing this? But still we'll see this. Yes. Yes, good morning, ma'am. All these guys were telling that there is no women representation in class. Yes. 1, 2, 3, 4, 5, 6, 7, 8. I thought Tala for a reason. No. 8 it became. RCB. Malleshwaram, no classes. RCB fan base. Yes. But you saw no recently. When Tala entered the ground, what happened? Some CSK, some function was there, no? Inauguration, something like that. People were crying. They didn't see him for 1 year, they were crying. Such is the fan base. But RCB fan base is also like that only. Virat Kohli has made a new request. He told if there is more than 3 days break, he wants to go back to London and come. He has become full family person only. Doesn't matter. Let him do anything. If he plays enough. Yes. Basic concepts to remember. This is some of the concepts that you have studied in CA Inter FM, which will be very much relevant. It will be required. First, we'll try to understand the income statement. Okay. Now, cross connection to accounts will not happen. Cross connection, don't think of schedule 3 format and all that. That we are not going to do. Okay. We just want to know how an income statement looks, because this is how they can give the income statement in the question. So we need to be able to read the information properly. So always starts with sales. From sales, you remove variable cost. Everyone knows what is variable cost. You arrive at something called as contribution. Cross connection to even costing of CA Inter. Now, from that you remove fixed cost. Fixed cost is something that doesn't vary with the output. It remains stagnant. That when you remove, you get something called as operating income, or it is also called as EBIT. EBIT is earnings before interest and taxes. Now, if you see P&L, you will not get EBIT actually. Because if you see schedule 3 format of P&L, there will be finance cost, employee benefit expense, cost of material consumed, everything there in the expense side. You will directly get profit before tax only. Before tax, extraordinary items and exceptional items. But here in financial management, when the income statement is presented, it will be presented like this, because interest on loan will also have an impact on a lot of decision making that which we are going to do. Clear? Interest on loan, when we remove, you will get your EBT and taxable income. Now, interest on loan is something that is paid to debenture holders, loan, other lenders, correct? Which is it fixed or is it variable? Is it fixed or is it variable? It is fixed in nature. Unless loan amount, yes, it is fixed. Online students, yes, you also should answer, okay? Unless the loan amount keeps fluctuating, it's always fixed, correct? Now, one more thing that is fixed in nature is preference dividend. Do I put it over here? Do I put it over here? Will it be part of this calculation over here when we are getting EBT? No. Why? It is not taxable. This interest on loan is payable to outsider, and preference dividend is payable to insider. Are you getting this? So first you pay all outsiders, then you pay the biggest outsider, that is Nirmala aunty. Okay. Then whatever remains belongs to insider. In insider there are two people: equity shareholders, preference shareholders. So always you pay everything that belongs to outsider. You will get EBT. Pay your taxes also. You will get EAT or net profit. In P&L this is called as net profit. Clear? Earnings after tax. This earnings after tax is there, can be distributed to two people, but always first preference will be to preference shareholders. So remove the preference dividend. That time whatever remains, if it remains, belongs to equity shareholders. This is called as earnings available to equity shareholders, or it's called as Patesh, profit available to equity shareholders. Clear? This is completely whose money now? Equity shareholders money. Now will equity shareholder take 550 rupees? In this example it is 550 rupees. Will he take 550 rupees and put it into his pocket? No. What will he put into his pocket is what is given to him only. That is basically dividend. Okay, I have divided it by number of shares. You'll get EPS. EPS is earning per share. Okay. That just the total is divided by number of shares. Now, if you are going and referring to your accounting standards and all, it's not actually number of shares in accounting standard, it's weighted average number of shares. Okay, but weightage will not be part of FM here. They'll just give number of shares directly. So your assumption is that whatever number of shares are there, that only is the weighted average number of shares. Basically, if I'm telling from starting of the year till ending of the year, I have 10 shares. That means weighted average also will be 10 only. Clear? Otherwise, if you refer your accounting standards, it's weighted average number of shares. Divide by 10, you will get EPS. Clear? 55 is earnings per share of whom? Shareholder. But will he get 55 into his pocket? No. Is he supposed to get 55? Does 55 belong to him? Yes. 20 is given over here in this example. Remaining also belongs to him only. It will be retained in the company. That is 35, and that is retained earnings per share. Clear? Now if company shuts down, this 35 also belongs to him only. The retained earnings also belongs to him. Why is it retained? For future benefit. Okay, for future expansion. If we distribute everything, our cash balance will become zero. Are you getting my point? This is basically like why P&L and why CFS. Cash flow statement. Why cash flow statement? P&L is there, no. You know what used to happen? Companies used to see P&L. Oh ho ho, 10 crore profit. Very happy they were. Let's spend 10 crore, go into cash, OD balance. When they should go to cash flow, no OD balance. Why it used to happen? Because a lot of credit transactions are also there. High amount of credit sales, made profit, but we didn't get the money yet. Okay, therefore, everything what we earn cannot be distributed. Okay. It might be distributed in new companies where they are not having credit transactions, but otherwise it will be retained. Okay. So that our cash balance doesn't become zero and our working capital doesn't get affected. Clear? Now, one more shortcut format of seeing, or one more way. Basically, we don't have to prepare income statement. Why I have given this over here is because ICA will give income statement in the question. So, sales minus cost of goods sold will give you gross profit. Okay. In accounts, there is no gross profit because Schedule 3 doesn't have trading account. But gross profit, from that you remove your operating expenses, selling expenses, administrative expenses, whatever expenses are there. You remove that, you will get your EBIT. Okay. That is your operating income. From that same thing. Remove interest, remove tax, same procedure will continue. This is the shorter format which you have to remember. Clear? Now, let's go into some few formulae. EPS, earnings available to equity shareholder divided by N. That means now whatever earnings is there, which is not net profit, not PBT, not net profit. After net profit, whatever you have distributed and remains, see this part, 550. If I have to explain, this will be 550 divided by 10. Can you see the 55 being here? Yes, this is your earnings available to equity shareholders. Imagine you don't have preference shareholders. Then E80 divided by N. If there is no preference shareholder, E80, if this becomes 0 over here, then this will be 1050 only. So we don't have to worry about earnings available to equity shareholder. Directly you can take earning after tax and divided by number of shares. Clear? Now, we'll focus on certain formula which is related to dividend. Dividend percentage. Now, it might seem silly, but students make mistake in the exam. Dividend percentage, when you talk, dividend is always given on what? Face value. So it will be dividend per share divided by face value. So if you see this example, dividend percentage is 20. Let's say 20 and I'm telling face value is 10. Okay. 20 divided by 10. 2%. Is it 2%? No, you have to multiply into 100. 200%. Clear? If at all, face value is 10. If it is 100, differs. It doesn't matter because volume will be same. So dividend percentage will be dividend per share divided by face value. But if I tell dividend yield, wherever you see the word yield, it's almost like return on investment. Yield means what am I getting? What am I yielding? So dividend per share divided by market price per share. Clear? Can you see the difference here? So basically this formula, what is it telling us? If I go and purchase the share today, I have to pay this, let's assume 50 rupees. Clear? And return what I'll get is dividend, and that is 20 rupees. So 20 divided by 50 into 100, obviously. Clear? So whenever you see the word yield, it is what you are going to invest to yield this amount. Next, you have dividend payout ratio. What is dividend payout ratio? Out of what you earned, how much did the company give? What was earned over here? 55. What did the company give over here? 20. So basically 20 divided by 55 will be your dividend payout ratio. What was not paid out? What happened to that? Retained. So whatever ratio you get over here, let's say it is no need to calculate. Let's say we get here some 35%. If you get 35% paid out, what is not paid out is retained. So 65%. Clear? That is basically retention ratio can be 1 minus DPR also. Dividend payout ratio is 100. I mean, total is 100. So 1 minus dividend payout ratio will also give you retention ratio. Otherwise, directly you can do EPS minus DPS. What is EPS minus DPS? Retained earnings. Directly retained earnings only you can take and divide it by EPS. Now see this formula. Payout, dividend per share divided by earning per share. Not paid out is retained earnings. So retained earnings divided by earnings per share. Clear? These are few things which you have to remember, because in the exam, ICA will tell you dividend percentage, and in that face value will be there, market price will be there, everything will be there. You should know when they're telling dividend percentage, that means they have divided it by face value. If it is dividend yield, then it is divided by market price per share. Clear? Now, next very, very important thing, P ratio. Okay, you would have seen this in Inter, right? P ratio. What is this P ratio? Price earning multiple. What does it mean? What does it mean? Basically, forget about formula and all. Okay, forget about the formula. What does it mean in general? I have a company. I made 100 rupees profit. I made 100 rupees profit. You want to buy my company. How much will you pay? Tell one number. How much will you pay? 130. Very bad company then. Okay. 130. 130 means whatever a profit I have made, you are ready to pay 1.3 times of the profit. So my P ratio is 1.3. Price earning multiple. On basis of your earnings, how much multiple, how much fold of your earnings are you ready to pay? If it is 100 and if you are ready to pay 1000, that means it is 10 times. You are ready to pay 10 times my earnings to purchase this company. Clear? That is PE multiple. Now, obviously, this PE multiple is based on reputation and it's also based on market. Now, imagine a company would have been having 100 rupees profit. Now, basically, if you think today, current situation of market only, lot of companies, I mean, people who have started investing when they started their articles, if they thought little, they'll save. Now, their portfolio fully will be red only. Correct? No. Portfolio will be showing red, everywhere red. Correct? Except if you have put silver or gold that time, it would have been, if you put silver or gold after it started booming, then that also will be red only. Okay, because that also has fallen right now. Now, imagine a company is there having 100 rupees as profit. Their profit is 100 rupees. And their market price of the share was how much? 1000. 1000 rupees was their market price per share. EPS was 100. Market price is 1000 rupees. That means, do you agree that PE multiple is 10? PE multiple is 10. That means people in the market are ready to pay 10 times. 10 times of their EPS they are ready to pay. Correct? Now, something Trump did. Because of that, market price has gone to 900. Correct? PE multiple has suddenly become how much? 9. But company is still earning 100 rupees profit. That is today's market. Company is still earning 100 rupees profit. That means the fundamentals are strong. Market price could have changed because of something else. Company suddenly made only 80 rupees profit. 80 into 10 became 800. That would have been a bad situation. Correct? So, because of market geopolitical situations also, PE multiple went down. People's interest to purchase has gone down. But earnings are still same. So what is PE multiple? Basically, what are you ready to pay? How many times you are ready to pay based on your earnings? Clear? So price to earnings ratio, it is full form. Market price per share divided by earnings per share. Market price per share is 1000. Earnings per share was 100. That means PE is 10. And if you inverse or change this formula, which we'll be using a lot of times, market price per share formula is EPS into P ratio. Market price per share is EPS into P ratio. This is the formula which you would have seen. Correct? This formula only when you change it, what will happen? This P stays here. This comes this side. Clear? Anywhere, however it is required, we have to use this formula. Now, higher reputation, higher P. Clear? If the company's reputation is higher and higher, obviously people will be ready to pay more and more to purchase. So higher P will be there. Company that is less risky. Reputation is not that much. It's not generated, but the company is very less risky. You know that if you put money, it's safe and you're getting returns also. P will be higher. Next, company expected to grow in future. Today, nothing. Loss-making company. Today, lot of people would have invested. No, based on that also, thinking that future is AI. Correct. Silver will be required for AI. Future is EV. Silver will be required for EV. And today, silver is loss-making. No, but someone YouTube channel, someone told 5 lakh it will touch. Okay, so higher P. So today situation might be bad. Reputation might not be there that much. And today it might be sitting in loss also. But because of future growth potential, okay, that time there will be a higher P. So different factors can affect the P ratio calculation or P in the market. Now, if two companies have same factors, what does it mean? Two companies, earnings, everything is same. Risk is also same. Everything is same. Okay, now if P is high, if one company's P is high, that means share is overvalued. If it is low, that means it is undervalued. So where did this green line come? Okay, forget it. Okay, this logic is irrelevant if factors are different. One company is having earnings of 1000. One more company is having earning of 2. Now there you don't compare P's. It's a very, very rare comparison which we are going to do only if all the factors are same. Everything is same, but only P is high. That means it is overvalued. Otherwise, this one is undervalued. Clear? Now, earnings yield percentage. Yield percentage. That means on your investment, correct? EPS divided by MPS. Did we have one more formula? Dividend yield percentage. There it was DPS divided by MPS. Clear? Dividend yield is how much dividend you are getting. Earnings yield is how much earnings you are making on the investment. Today's investment market price. Clear? Now, inversely related P ratio. Can you see market price by EPS? Earnings yield percentage is EPS by MPS. And P ratio is MPS by EPS. So, those are inversely related. You can use these factors for our future calculations. Therefore, if you just do, if there anything is inversely related, 1 divided by P ratio, if you do also, you will get earnings yield percentage. Somewhere, what will be given to us is earnings yield percentage will be given. With that, if you have to get the P ratio for that question, you can use this formula. Clear? Now, market capitalization or market value. Market value is not book value. Book value also we are going to study maybe little more. If I scroll down, you'll find it. Okay. Market value means what? What is market value? Today's value. Today's value in the market. In the books, in your financial statement, you'll be showing something else only. Now, market price per share, which we have calculated, maybe right now we know only one thing to calculate market price per share, that is EPS into P ratio. There are other different ways to calculate also, which we'll see in the syllabus. Now, market price per share into number of shares will give you the market capitalization or market value of the company. Clear? Now, this market price per share, if I divide by EPS, what will I get? I'll get the P ratio. Now, P ratio if you have, and this number of shares, if you multiply into EPS, what will you get? You'll get earnings available to equity shareholders. Now, you can use this formula also. Here, what happened? It is per share multiplied into number of shares. You get the total. Correct? This per share, if you divide, you will get the P ratio. That P ratio you apply directly into the earnings only, you will get the total. Basically, how did you get MPS? You got EPS into PE ratio. EPS into PE ratio was market price per share. Now, apply that PE ratio directly on not per share earnings, on the total earnings. You will get the total market capitalization. Is it clear? Okay. Again, okay, you might have seen so many formulas already. Again, it's not a formula based subject actually. All those formulas, if you just understand the logic, right, you don't have to buy out the formulas. Automatically, you will understand what divided by what in the exam. Now, cost of equity. Somewhere in CA Inter FM, you would have studied something called as WACC. Okay, KE, KD. Okay. Now, cost of equity means what? Basically, what is it? Equity means what? Whatever belongs to equity shareholder. They have put money. We have to give them returns. Now, you're like, sir, equity shareholder and company, same. No, that we have studied in accounts. Something called as entity concept. They are different, we are different. Correct? So, what is supposed to be given to them or how much we are supposed to give them? That percentage is actually an expense to the company. So, cost of equity is when funds are raised from equity, amount payable to them in return. What is supposed to give them in return? In percentage, it will be given cost of equity. Right now for KE, the biggest method to calculate KE, we'll study other methods when we go to valuation. But here it is CAPM. What is CAPM? Capital Asset Pricing Model. I think CAPM was there in FM. CA Inter FM. Not there? Okay. Now here, one new thing that we are going to learn, RF plus beta into RM minus RF. What is RF? RF is something but risk-free rate of return. Risk-free rate of return. I will take my 100 rupees. I will take 100 rupees, go and put it in FD. I'll go and put it in FD. FD they are giving me, let's say 5% return. 5% return. I am not happy. I want to go and put it in market. Go and put it in market. Market means what? I'm going to bet on index. Sensex, Nifty. I'm going to directly put on the market. So that means the best companies. I'm going to invest in the best companies. So market is giving 12% return. Market is giving 12% return. But 12% is not my extra return that I'm getting. Already I was getting 5% return. By going and taking risk, I will get extra how much? 7% return. This is called as risk premium. This is called as risk premium. Extra risk I'm taking, I will get extra, I have to get extra premium in my return also. But I am not going to invest in the best companies. I am going to invest in one company. I like that company only. I will invest in one company. Now that one company can be more risky than market or it can be less risky than market. Now more risky or less risky, okay, of a particular share compared to market is given by this beta. Beta tells us sensitivity of the company to the market. There are some companies, no, not some company, every company, when market moves, it will move. But it will not move the same way. Now, if you go and check, or Friday or Thursday or something, market maybe it would have been like 2% increase. But there might be some share which would have been like 5% increase. Are you getting my point? Or there would have been some company which would have been 3% decrease. So, beta is basically a factor which is representing to calculate the sensitivity of the company. How sensitive your company is to the market. So, your company is sensitive by 1.5 times. That means whatever movement happens in market, your company will move 1.5 times of that movement. So basically, if market is moving by 7%, it's giving you extra 7%, then you need 1.5 into 7. You need that extra to cover that risk. So therefore, RF plus beta into RM minus RF. Now beta need not be always positive. It can be negative also. What if beta is 0? Actually, beta discussion is not here. It's in a future chapter. How to calculate beta also we will learn. Don't worry about that. What if beta is 0? Risk free. Beta is 0 means risk free. If beta is 0, this full thing becomes 0. Then it will only RF. That means FD. Government bonds. All those bonds which you suggest to your client for 54 EC. Put there. Money will be blocked. You will get hardly nothing. Correct? Government will make money on that because they will invest that money because it's locked. No. Lock-in period is there over there. I mean, not exactly locked, but if you remove, then you pay capital gain. It will come back. Correct? No. So, RF, if beta becomes 0, that means you have invested in risk-free place. It becomes RF. Clear? Now, what if beta is 1? What if beta is 1? Is there risk? Risk is there. Risk is there. But if beta is 1, that means either you have invested in market only, or you have invested in a company which is exactly as risky as market. Exactly as risky as market. Imagine you have invested in Nifty Bs. Nifty Bs are basically same thing, no? Correct. So, or maybe there is some, which is very rare. Maybe there is some company which is exactly moving like with market at par. So, that time the beta will be 1. I mean, very, very highly unlikely it is. Exams, it will be there. Okay, in question paper it will be there, so we have to know that. So this is your formula to calculate your KE. So basically, if you think of logic, I take my 100 rupees and I go and put it in FD, I'll get 5%. But I don't like 5%, I want to take risk. I'll go and put it in market. Market is giving 12%. That means extra, how much is market giving me? 7%. Market is giving 7%. But the company which I am planning to invest is more risky than market. So this 7%, I will expect something more than, shareholder will expect something more than 7%. Clear? Now, shareholder is coming to you. That means company and investing in you, right? But you are not as risky as market. You are more risky than market. So shareholders' expectation also will be more. That is how K is based on. That is what CAPM is. Clear? Now, and RM minus RF is called as RP. That is risk premium. Because sometimes ICA might directly give RP itself. That time don't do this minus this. It's already given. Are you getting this? This we will decode when we go to questions. Nothing to worry. Now, Infosys can be more riskier than market, or return from the therefore return from share should be higher than market. This we already discussed. Now, Infosys, I don't know whether it's more risky than market. I think it is very, very risky right now because of the AI news and all. Again, fundamentals are strong. Company is still strong. It's a company which even if it shuts, shareholder will become more rich than if it is running. Because their loans and all are very, very low. Cash reserves are very high. So if Infosys closes down, shareholder will be more happy. I mean, momentarily. Future growth will not be there. Momentarily, they'll get more money actually. Okay, so next, equity shareholders fund. Equity shareholders fund is nothing but book value. Book value, net assets, net worth. Any of these words can be used. ICA likes variety. Same question, one place they will tell equity shareholders fund, one more place they'll tell book value, one more place they'll tell net asset, one more place they'll tell net worth. This is basically based on books, your financial statement. Till now, market cap and all we were seeing based on what? Market value, right? Market value has even PE and all involved. Market value has market price per share. Here, completely based on books. That means this thing what we are going to discuss can be calculated just by looking at the financial statement. Now here, total assets you take. Somewhere in your life, once upon a time, you had one subject called as advanced accounting. Correct. There you had one small chapter called as amalgamation. Correct. There you had some ways to calculate PC and all that. Net asset method. What you should do? Asset minus outside liabilities. Correct. And that same amalgamation will be there again in FR also it is there. Correct. So total assets minus outside liabilities. Okay. Net assets means today's value of the company as per books. As per books. Market can be different. Now when you're taking total asset, some things are going to be excluded. What is it? Assets which are sitting on asset side but not assets. Assets which are sitting on asset side but not asset. What is that? Fictitious assets. Now you know accounting, right? I don't have to tell you accounting. We follow double entry system of accounting. We passed one entry. Salary account debited to bank. Correct. This salary, where will it go? P&L. Didn't go. Where will it go? Has to go to balance sheet. Didn't go. Has to go to balance sheet. Double entry system of accounting. Balance sheet means what? Schedule 3 format and all is there. That's a format. Balance sheet means what? Sheet of balances. That's it. Any ledger has balance, it will sit in the balance sheet. Whether right or wrong is secondary. If you do your accounting properly, balance sheet will look proper. Otherwise, it will not look proper. Simple. Correct. So, salary account debited to bank. Salary should not be shown in balance sheet. If you don't transfer it to employee benefit expense in the balance in the P&L, then that salary expense also will go and sit. Salary is having debit balance. Debit balance will go and sit in asset side of balance sheet. Are you getting this? So, basically, these are, before we used to call this as deferred revenue expenditure. That means expenditure which is not transferred to P&L. So if there are something like that on the asset side, it is fictitious. It is not actually an asset. It's there on the asset side, not really an asset. It's not going to give you, asset means what? Something that should give you future benefit. This is not going to give you future benefit. Already benefit is done. Employee has worked, you didn't pay, that's all. I mean, you paid, but you didn't transfer to P&L. So fictitious assets are basically preliminary expenses or P&L debit balance. This will not happen actually if you follow schedule 3 format properly, because P&L debit balance will go and sit on the liability side as a negative figure. Correct? But they in AFM, they'll give you balance sheet horizontal. They'll not follow schedule 3 format to frame one AFM question. They'll give you horizontal balance sheet. That time on the asset side, if you find P&L, or if you find preliminary expenses, or if you find something like debenture issue expense not written off, or loss on issue of debentures, all those things if you find, no, that is fictitious asset. That will not be included when you are calculating assets over here. Clear? Now, you saw the balance sheet like this. Let's say if I take, for example, one small balance sheet here. I have equity share capital of 100, reserves and surplus of 80, and I have current liability of 20. Okay. Before current liability, I have a long-term borrowing of 50 and current liability of 20. So this totals up to 250. Clear? Now on the asset side, you have fixed assets, which is called as property, plant and equipment. You have, let's say 100. Then you have inventory 50. You have trade receivable 80, and you have P&L 20. Okay. P&L 20 is what? Basically debit balance if it's sitting over there. So 250. This is 250. Now, if you're calculating based on asset, net assets formula, you will take 100, 50, 80. All this becomes 150, 230 minus your outside liabilities. Long-term borrowing is also outside liability. Current liability is also outside liability. Minus 70. You will get 160. 160. Clear? This if you are doing net asset formula. You can directly do it from the liability side also. Equity share capital plus reserves and surplus. That should be basically book value. But if there is fictitious asset, you have to minus that. Because if you are just taking this on the asset side, even fictitious asset also was there. Fictitious asset means what? Asset which is not asset. If it is not asset, it should be wiped out. If it is wiped out, whose wealth will go? Shareholders' wealth will go as per books. Therefore, if you see equity share capital and reserves and surplus, this is 180 minus fictitious asset 20, you will get the same 160. Is it clear? Yes. That should be how you are going to calculate. I hope it's clear, guys. Book value. Okay. Note. DTA. What is DTA? Deferred tax asset. Day-to-day basis, you might be seeing this. Deferred tax asset, even though you might get one feeling within, this is also fictitious, but it is not fictitious. Why not fictitious? What is deferred tax asset? basic. Don't tell me according to standard and all. What is deferred tax asset? Today I am paying more tax, but there will be a future day when I am going to pay less tax. Correct? So a future day when you are going to pay less tax, you are going to get future benefit. No. So therefore it cannot be fictitious. No, it's giving you future benefit. So DTA is not fictitious asset as it provides benefit in the future where you end up paying less tax. Clear? So DTA, if you see, don't consider that as fictitious asset. Now, book value per share. You have book value. Now, book value per share shouldn't be a problem. Total book value divided by number of shares. Anywhere in AFM, we are not going to do weighted average number of shares. We are going to assume that the number of shares are weighted average number of shares only, which are given in the question. Clear? So, but don't apply that logic when you go into FR and you calculate EPS. Okay, then your EPS might be something, but marks will be 0. Their weighted average number of shares. Clear? Yes. Next we go into ROE. Very important. Return on equity. ROI also might be there. Return on investment. That is different. ROE is return on equity. So return on equity means what? What the equity shareholder is going to get. Correct? Equity shareholder is going to get what? Earnings available to equity shareholders. Divided by what? Their total money. That is equity shareholders fund. Now my question is ROE 12%. That means whatever you invested, did you get 12% into your hand? Into your hand? No, that information will be given by what? Dividend yield. What will give you that information? Dividend yield, because what you are going to invest is market price. Clear? Whenever you invested the market price, unless you invested at the time of IPO. That time you would have invested face value, which is very rare now. It will also go at premium only. So that is also the market price only ultimately. So basically ROE is return on equity, earnings available to equity shareholder. It is not distributed. Total earnings of equity shareholder divided by equity shareholders fund. Equity shareholders fund. Equity shareholders fund, if you think properly, it is equity share capital and reserves and surplus. So reserves and surplus includes what is not distributed, retained earnings. If denominator is including what is not distributed, numerator also should include what is not distributed. Are you getting my point? When you're calculating, when you're comparing two things, if in the denominator it is including which is not distributed, numerator also earnings should be including what is not distributed. Are you getting my point? So return on equity. So basically it's like you have earned the return, it has not come to your hand. You will get it someday. And you know, right? ROE goes high, market price goes high. So if you decide to sell also, you'll get that premium. Okay. Imagine ROE last year was 10%. Market price was 100 rupees. ROE this year is 15%. Don't you think market price will go? It will become 140, 150 something it will become. So if you plan to sell also and not wait till the company is going to shut down, still you will get a premium. You will get that benefit. Okay. One more formula. EPS divided by book value per share. Nothing. Same thing it is. This thing in totality. This is in per share basis. We need to know it because anyhow they can frame the question. Now, growth rate. Growth rate, I'm not sure if it was there in FM. Was it there? G is equal to BR. Somewhere you have heard of it. Yes. Growth rate is basically retention ratio. You know how to calculate retention ratio. 1 minus dividend payout ratio. Whatever dividend you have given, whatever that is gone. Whatever you don't give, that remains. That is your retention ratio into ROE. Return on equity. That is your growth rate. What is the logic? What is the logic? Do you know MRF? Hardly pays dividend. What happens to the share price? Keeps growing. If money is kept here, that means money is going to be invested into the business. When money is going to be invested into the business, the growth should happen. So therefore, growth ratio, if you think logically, amount you are not going to give, amount you are going to retain over here into ROE, the percentage into ROE. So out of this return on equity, let's say 15% is your return on equity. And we have already discussed that 15% shareholder did not get. Shareholder is supposed to get 15%. Out of that 15%, let's assume 6% they gave. Okay, 6% they gave. That means 94% is still with the company. 94% will be the growth rate. 94% will be the growth rate. Is it clear? Okay, I'm not too sure. Okay, whether growth rate is there in FM or not. It's there? Yes. Now, asset turnover ratio. Asset turnover ratio. Whenever you see this turnover ratios, no, it's basically I put something, how much will I get? Okay, what is the rotation I'm going to do with this money? Now, asset turnover ratio can be there, inventory turnover ratio can be there, debtors turnover ratio also can be there. All these, I think, in your ratios chapter in FM. But they would have biated, no. Like, no logic, nothing. We would have just biated the formula and gone. Then after going to the exam, sometimes you would have had this feeling also. Ayo, numerator or denominator? Suddenly, when you biat the formula, it happens. No, we don't know. Oh, this is numerator or denominator. So many formulas. Okay, but understand this. Whenever you're talking about anything turnover ratio, asset turnover ratio, inventory turnover ratio, debtors turnover ratio, whatever you're telling no is the turnover, that will go and sit directly in the denominator. Asset turnover ratio, asset is sitting over here. Inventory turnover ratio, inventory is sitting over here. Debtors turnover ratio, debtors is sitting over here. It will directly go and sit in the denominator. Is this clear? Now, asset turnover ratio, the formula is turnover divided by asset. What is turnover? Sales. What? How well you use the asset? Yes. Asset turnover ratio, the formula is this. How well you use the asset? Means what? I purchased 100 rupees machinery. With that 100 rupees machinery, how much I could make sales during the year? That means this 100 rupees was rotated how many times? This 100 rupees was rotated how many times? Imagine 100 rupees asset. If you end up making 1000 rupees sale, that means asset turnover ratio is 10. Is it good? Is it good? We don't know. Is it good? We don't know. What? Because we can't tell good or bad. What we can tell is higher the ratio, better it is. As this ratio goes higher and higher, better. That means you're becoming more and more efficient. Okay. So, I mean, obviously it should be positive. Okay. It should be positive. That is the basic, right? Now, turnover, how can it be negative? Liabilities are more than assets. Okay. So, turnover divided by assets or no turnover only. That means dormant company, basically. Turnover divided by assets. After deploying the assets, after putting the assets, how many times of asset turnover was achieved? Clear? How much did you rotate it? Higher the asset turnover, better to the company. Is this clear? That is your asset turnover ratio. Now, next we go into inventory turnover ratio. That means inventory should go and sit directly in the denominator. Now, after blocking the money in stock, how much turnover was achieved? Now, sir, simple. There, whatever turnover that went into denominator, here whatever turnover, this went into denominator. There, numerator was turnover. Here also we'll put numerator as turnover. Is it true? No. Here it is cost of goods sold. Why? Inventory is always at cost. If you take turnover, this will be including profit. That doesn't make sense. So, inventory, when you are taking, it will always be COGS in the numerator. And cost of goods sold is cost of goods sold of both cash and credit sales. So, by blocking your money, if you are telling that is, I mean, you do that, right? When you are filing returns and all. Okay, companies you can't do it, but sole proprietors, partners and all, you know, profit little more we want. Entire game is with stock only. You know, income tax department will not come and check that stock. Entire game is with stock. Stock up, this, how much tax? Oh, stock down, this much, how much tax? That only will be doing, right? So now, by blocking that money, I mean, there it's all dummy figure you are going to put. Okay, by blocking the money in inventory, okay, how much sales is achieved, but inventory is at cost itself. That's why when you're calculating cost of goods sold, you're going to see. This also, higher it is, better it is. When you're blocking money, imagine this is 1. Imagine that is 1. Whatever you have invested in your inventory, that much only sales you have achieved. It might not be bad. It might not be bad. There might be like automobile or defense sector and all. In their entire year, they might make 1 sale. Okay, it might not be bad. But how you can tell it is bad? I am having a ratio of 1. Same industry, one more guy is there. He is having a ratio of 5. Now we know we are bad. Are you getting my point? Any ratio which is given over here, you cannot tell it is bad or good unless you have a comparative figure from the same industry. Clear? Of the amount blocked in inventory, amount of sales generated. Okay, but everything is at cost. Next one is debtors turnover ratio. So debtors should go straight away and sit in the denominator. That means numerator, sir, debtor means sales only. Okay, so numerator should be turnover. No, but debtor generates only credit sales. So here can you see credit sales is the numerator. Clear? Asset directly sales. Inventory sales only, but the cost part of it. Okay, which sales? All sales. But when we are talking about debtor is somebody who has been created because of credit sales. So amount of credit sales that the debtor has generated during the year. Of the amount blocked in debtors, credit sales generated. Nothing can be good or bad unless you have comparative figures. Now, sir, when we are revising all this FM, little I am remembering, sir, FM. Little FM I am remembering. You made one mistake, sir. Inventory, no, sir. There in FM, we used to always have average inventory. Opening stock plus closing stock divided by 2. You are only writing inventory. Here also average asset. Here also average debtors. Are you getting my point? 1% of the time in AFM, they'll give you the information to calculate average. Their focus is not on you calculating average. No. This turnover ratio will be a small working note to calculate something bigger. So therefore, the information for average might not be there. So, did I write it or no? Yeah. If no info is provided to compute average, then take closing assets inventory as or debtors only as the average one. Clear? Usually the denominator is average assets, average inventory, average debtors. But usually that information to calculate will not be their average and all. If they give average, good. If they don't give average, then you have to assume that whatever closing balance is, that only is the denominator for us. Clear? Now, my question to you is, if they tell you debtor is 5,000 and they didn't tell you opening debtor, then you'll take denominator as 5,000. But does it mean that 5,000 is average? Not necessarily. Okay, 5,000 is closing debtor. You have used that 5,000 because of lack of information of opening debtors. For the average also to be 5,000, then opening debtor also has to be 5,000. Okay, possible. You have studied in, I think costing you have studied, right? Now imagine the credit period is 60 days. That means always 2 months sale will be sitting in debtor. That is only in books. Only in books. One person will pay after 3 months. One person will pay after 15 days. In books, you will assume that, 2 months sale will always be sitting in debtor. Clear? Now, this and all you might feel like, this, sir, foundation. Time value of money. Remember in foundation, there was something called as there was one very easy subject called as quantitative aptitude. Remember that? Okay, now you remember. And there was time value of money which used to come for 14 marks something always. Now, this will play a huge role. I'll tell you why. Okay, many chapters will see this. In AFM, no. The subject assumes that the party is Bikari. The subject assumes that the party is Bikari. Doesn't have money at all. So if subject is telling the party wants to buy plant and machinery, assume that this fellow has no money. He has to borrow loan only. Are you getting my point? And if they tell that this fellow wants to, one company wants to take over one more company, assume that this fellow doesn't have money. Okay, always wherever money is required, no. Subject assumes that this fellow is Bikari, doesn't have money at all. So therefore, time value of money comes into picture. Present value, future value calculations comes into picture. Now, time value of money, PV is present value is equal to future value into present value factor. Correct? Present value factor how to get? Formula is 1 divided by 1 plus r to the power of n. Okay, we can use a calculator and find out. Now, if I tell 10% is the discounting rate. Now, this discounting rate can be the interest rate, inflation rate, anything. That we will see later. Okay, we don't have to worry about that. Now, if the rate is 10%, and present value when we will calculate, whenever we are going to get something in the future or whenever we are supposed to pay something in the future. Correct? So, if I tell 10%, everybody take your calculator. I am going to get something at the end of 4th year. How will I calculate this? 1 divided by 1.1 press is equal to 4 times. Did you get 0.683? Anybody's calculator when you press is equal to didn't move. Anyone's calculator is there in class? When you press is equal to didn't move. And a calculator. Okay. Now, if at all there are some calculators, okay, you would have studied this in inter. Online students also, if your calculator hasn't moved, then you have to do 1 divided by 1.1 into you have to press 2 times. Then you keep pressing is equal to, you'll start moving, okay. Otherwise, most of the Casio calculators move. If you're using a Casio calculator, it will move. Some of the non-Casio calculators, this problem is there. Okay, so when you pressed 1 divided by 1.1 is equal to, that means you got the present value factor at the end of first year. Then you pressed again, it became second year, third year, fourth year. Basically, it is nothing but 1 rupee if you are going to get after 4 years. What is the value of that 1 rupee today? I'll not deep dive into that concept. I'm assuming you should know that. Okay, use the calculator always. No need to use the formula. Okay. if the formula is required in some places, because their R might not be there, N might be given. Using that N, we have to find this R and all. It will happen as we go further. That time we'll write the formula. Otherwise, you can use the calculator for present value always. Now, future value means what? Future value means what? Today I got some value. Today I have some value that I'll invest somewhere. What will I get in future? That means the amount has to grow. Here, when I'm calculating present value, what I'm getting 100 rupees in future, the value of that will be lower. If I have 100 rupees today, the value of that in future will be higher. You'll get more. So present value into 1 plus R to the power of N. That means the number has to grow. It should not be divided. It should be growing. So let's assume I am having 100 rupees with me. 100 rupees. I am going to have 10% return. Okay. After 4 years, how much I should have? So it compounding effect it is. So take your calculator. 1.1. And at the end of 1 year, 1.1 into press is equal to. You got 1.21. Press is equal to again. You got 1.331. Press is equal to again. Did you get 1.4641? Stop. Stop. Now you're like, sir, there we pressed 4 times is equal to. But here you're pressing only 3 times. Why? When you took 1.1, it's already at the end of first year. When you took 1.1, it's already at the end of first year. This might seem very silly, but when we learn extremely complicated concepts, these silly things in exam will make us think. Because we have not revised this on the previous day. So such things should not trouble us. So when you have taken 1.1, that's already at the end of first year. When you multiply, you get the second year, third year and fourth year. So you have to press is equal to only 3 times. Okay. So if it is number of years is 4 here, when you press is equal to in your calculator, you will press it 4 times. But here number of years is 4. When you press is equal to in your calculator, you'll press it only 3 times. N minus 1 number of times. Clear? Now, present value of annuity. What does it mean? What does it mean? Present value of annuity. I am not going to pay 100 rupees at the end of 4th year. I am going to pay 100 rupees at the end of 1st year, 2nd year, 3rd year, 4th year. This formula is very relevant only if you are going to have the same amount. You are paying 100 rupees first year end, 200 rupees second year end, 300 rupees third year end, 20 rupees fourth year end. Nothing. This formula cannot be used. You have to do individually only. Clear? So if you are getting same amount at the end of every year, or if you're paying same amount at the end of every year, you can use this formula. Same amount to be paid or received at the end of each year. Use calculator again. What you can do now? Let me tell you, if I have to tell you 100 rupees will be received at the end of each year for 4 years. 10% is our discounting rate. What will you do? First, you wipe out all your old memory. Press MRC 2 times. Once only if you press it, it will go sometimes, but you press 2 times. Okay. 1 divided by 1.1 is equal to M plus, is equal to M plus, is equal to M plus, is equal to M plus 4 times. Now press MRC 3.169 you got. Now there are some calculators which has that feature GT. If you have GT, then you have to just do 1 divided by 1.1 is equal to is equal to is equal to is equal to. Press GT, you will get the answer. If you don't have GT in your calculator, then you have to use memory function. Everybody has GT in the calculator? No GT. Then you have to create the total. GT automatically calculates the total in the background. If GT is not there, you have to create the total. So what you will do, 1 divided by 1.1 is equal to, you have to remember this because 4 years M plus is equal to M plus is equal to M plus. Keep doing it for all number of years. Then you press MRC, you will get the answer. It is 3.169. 100 into 3.169, you will get 317. 317 should be your answer if you are getting 100 rupees at the end of each year. Clear? Is this clear? Now, we'll take some examples. Discounting rate 10%. 50,000 to be received at the end of 4th year. So, are we supposed to calculate future value or are we supposed to calculate present value? Present value. We already know the future value. Future value 50,000 at the end of 4th year. So, you will take 50,000 into 0.683. That is basically 1 divided by 1.1 is equal to is equal to is equal to is equal to. Is it 0.683? 4th year present value factor. Yes. So multiply, you will get 34,150. Now, second example, 50,000 received today. That means what we should calculate? Future value. Future value at the end of 4th year. So what we will do? 1 into 1.1 is equal to, 1 into 1.1 into is equal to 3 times 1.464. Did you get 1.464? That means the 1 rupee today will grow, and when it's growing in a compounded manner, we don't use simple interest. Very rarely we use simple interest here. When it is growing in a compounded manner, it becomes 1.464 rupees. But we don't have 1 rupee, we have 50,000 rupees. That's why it's becoming 73,200. Is this clear till here? Yes. Now, let's see one more situation. 50,000 to be received at the end of each year for 4 years. To be alarm. Over. Gone are the days when you're going to get up at 7 o'clock. Now change your alarm timing. 50,000 to be received at the end of each year for 4 years. Clear? Now you have to calculate present value of annuity. So basically what you did, first year you'll get 50,000, 0.909, second year, third year, fourth year. You added that, you got total. This adding and totaling you can do only if you are going to get this to be constant. Only if this is constant. Otherwise what will happen? It will be 50,000 into 0.909, 30,000 into 826, 20,000 into 751 and 10,000 into 0.683. It's going to be like that. Individually, you'll have to calculate. Now, 50,000 to be received at the beginning of each year. This end and beginning can play a huge role in your calculation. Full question you have read properly. Same question was there in the study material also. You went to the exam. They changed only one word. End of each year they made it. Beginning of each year. You didn't focus on that end and beginning. You solved. You're like, same answer you got. You remembered the study material answer also. You're very happy you were. Correct. But when you see suggested answer, some other answer only is there. Now, what is the logic? 50,000 at the end of beginning of each year means end of previous year. Now 50,000 at the beginning of each year means today only we'll get 50,000. First 50,000 will come today. Second 50,000 will come at the beginning of second year. That means end of first year. Beginning of third year. That means end of second year. Beginning of fourth year. That means end of third year. Therefore, when you take present value factor, see over here. First one is 1. Today it is present value is 1 only. Today's 100 rupees is 100 rupees only, today. Yes. Then 0.909 is first year's. 0.826 is second year. 0.751 is third year's. Now imagine if you have a question like this, beginning of each year, then you do one thing. If they tell beginning of each year until 4 years, think of it as 3 years. Do the same thing what you did GT or M plus calculation for 3 years. Then finally add 1 to that. That time you'll get the present value factor 3.486. Okay, you can try that. 1 divided by 1.1 is equal to M plus is equal to M plus is equal to M plus. And add 1 more, then you get 3.486. Are you getting 487? 486. Okay. Next. Fifth one. 50,000 to be received. Suddenly they changed the logic itself. For 4 years only, but from the end of year 3. From the end of what? Year 3. Now, present value of deferred annuity it is called as. Now, year 1 and year 2, nothing you are going to get. So, whatever you are going to get from where? Year 3 onwards. So, you need present value factors of year 3, year 4, year 5, year 6 only. Same 4 M pluses you are going to do. But when you are doing in your calculator, you will do 1 divided by 1.1 is equal to ignore. Then from third year onwards is equal to M plus 4 times. Are you getting this? Okay. So, this is the logic if you are having a situation like this. Now, 50,000 going to be received forever. From the end of year 1, forever. You're going to get 50,000 forever. This was called as present value of perpetuity. It was called as perpetuity. That means today you did something. Okay, we don't know what it is. You did something which will give you 50,000 every year. Forever. Now what will you do? 50,000 just divided by 0.1. 0.1 because 10% was our example. 0.1. That means the value of that is 5 lakhs today. Okay. Present value of perpetuity, amount to 1 I have written divided by R. What is this amount to 1? Amount at the end of first year. Now they can tell something like today 50,000 was invested in business which is going to give you 10% more from the first year onwards. 10% more from first year onwards. So you're going to take the value at the end of first year and then you divide it by the discounting rate. Seventh one. 50,000 to be received every year from the end of year 1. Till previous example also it was there. And it will grow at the rate of 5%. You will get 50,000 at the end of year 1. After that, every year 5% more you will get. Now, present value of growing perpetuity. Formula is amount divided by R minus G. R is what rate? Rate minus growth rate. So 0.1 minus 0.05. Don't you think if something is going to be stagnant forever and if something is going to be growing forever, the value of that today should be more? If I tell you, boss, invest in my business. every year you'll get 50,000. Or if your friend tells, invest in my business, every year you'll get, next year you'll get 50,000, but every year that 50,000 will keep growing. Whose business will you plan to invest? Your friend's business. But now that friend's business and my business, do you think the value you have to invest will be same? Value do you have to invest is same. Today we are thinking it's same. So tell me, the value of the company, is it going to be same? Somebody giving you same amount and somebody giving you growing amount, who will be higher in value? Growing amount. Therefore, can you see present value of growing perpetuity has become 10 lakhs with the same amount, but it has become 10 lakhs. Clear? So these are few formulas which you have to remember. Capital employed, which we already have seen. Capital employed, now we have this habit. Capital, when we tell, no, automatically what comes into our mind is share capital. Capital employed is amount put into business. That is from shareholders as well as from outsiders. So capital employed is equity plus debt. Clear? In equity, you have share capital and reserves and surplus. Obviously, when you're doing this, you have to remove that fictitious things minus preliminary expenses, other things, whatever it is there. Okay, total assets minus current liabilities is also one way of calculating capital employed. We already saw this when we calculated book value per share. Clear? Now, one more formula that we have to understand, interest coverage ratio. What is this interest coverage ratio? Again, interest comes and sits in the denominator. Numerator is EBIT, before interest. By paying interest, how much am I able to generate? How much earnings am I able to generate? By paying interest, how many times EBIT is generated? More, it is better. If it is more, it is better. Now imagine your EBIT is 10. Interest is 10. What does it mean? That means you have exact amount to pay your interest. That means the lenders are little scared, because the moment it becomes 8, they don't have money to pay you. Are you getting this? So therefore, higher the coverage ratio, better it is. From whose angle? From the lender's angle. They'll be very happy. Imagine EBIT is 1000, interest is 10, 100 times coverage. Even if company fluctuates a little also, no problem. Nothing will happen to us. Now, interest and fixed dividend coverage ratio. Interest and fixed dividend means which dividend? Preference dividend. Correct? That is also fixed in nature. Whenever you see preference share capital, you will always see one percentage return. Now, PAT, profit after tax, okay, plus interest. Like, sir, wait. When it was only interest coverage ratio, we took EBIT divided by interest. Correct? Here we are taking PAT, profit after tax, because for dividends, profit after tax is applicable. Now, interest you will add back. You add back the interest, that time you actually get that same thing, but it is after tax. Okay, divided by interest and preference dividend. Is this clear? So now this is ability to generate profits from your fixed return bearing liabilities. Sorry, fixed interest bearing liabilities. Clear? So this is the ability to generate. Again, they will not ask you this ratio. This ratio will be given, and using that ratio, maybe we will have to calculate PAT or we'll have to calculate interest. So we need to know the formula. Now, capital gearing ratio. Capital gearing ratio is a comparison between fixed capital and fluctuating capital. Fixed capital and fluctuating capital, not in totality, in terms of payment to them. This is debt and preference share capital, fixed return bearing debt, it is liabilities, and here it is equity share capital, reserves and surplus. They are fluctuating. We might give them, we might not give them also. So basically, debt plus preference share capital divided by equity plus reserves and surplus. Now, lower the better. Why lower the better? Imagine here I have 100 rupees and here I have 100 rupees. That means 1. And here I have 100 rupees and here I have 1000 rupees. That means it is 0.1. That means the tension to pay fixed returns to some people is not there in my head. So this is lower, better it is as per books. In reality, debt is good thing. If you're doing business, debt is good thing. If you are already the shareholder, debt is good thing. Are you getting my point? If you are outsider, then you should tell that equity is a good thing because you want to enter. Are you getting my point? It's basically from perspectives. If you are already equity shareholder, you are like, debt is good thing. We don't want more people to come and share the dosa with me. I will only eat the dosa. Correct? But if I am already eating the dosa, if I'm already eating the dosa, debt is good thing. If I'm outside and looking at the dosa, then I should tell that guy, equity is good thing. I also want to enter and share the dosa with you. Are you getting this? Okay, so capital gearing ratio in books, lower the better. interest assumptions. Now, always assumed as per annum. Now, when they tell 6%, okay, 6%, that is per annum only. They don't have to tell you it's per annum. 100 basis points means 1%. Now, when they tell interest has grown by 200 basis points, that means 2% increase. That is the word which financial institutions use. Now, why I am telling you this is, ICA will frame questions like this, okay? 6% interest. This I don't have to worry, only 6% per annum it is. Now, 6% interest monthly. It is still per annum. It is still per annum. If they tell 6% interest quarterly, can you see that comma there? Interest rate is 6%, but payments are monthly. Payments are quarterly. It is still per annum only, 6% per annum. You'll have to do 6% divided by 4 or 6% divided by 12. Clear? Now when they tell 6% per month, then it is per month. 6% per quarter, then it is per quarter. Otherwise, the interest rate is always per annum in the question. Clear? Now, maths basics. I don't know why it is there. Okay, I only made one mistake here. A plus B is equal to C. Okay, numbers. We will not have equations, but A plus B is equal to C. Now C is equal to, sorry, A is equal to, this is actually C minus B. When this B goes this side, that positive becomes negative. Just to tell you that positive becomes negative, how to use is equal to sign. Same thing applicable to balance sheets also. When asset comes into liability side, becomes negative. Liability goes into asset side, becomes negative. A into B is equal to C. Now, if you want to find A, this B goes this side. So, it becomes C divided by B. Becomes divided. Okay. 20 to the power of 5 means what you will do? 20 into 20 into 20 into 20 into 20. Correct? But if I tell 20 to the power of minus 5, you will do 1 divided by 20 to the power of 5. Clear? And if I tell you root 20, in fractions it is 20 to the power of half. 20 to the power of half. If you see any number 20 to the power of half, that means directly you can take root 20 in your calculator. But if I see 20 to the power of 4 by 5. Sir, simple sir. 4 by 5 is 0.8. So we'll write it as 20 to the power of 0.8. Okay, how to find now from here? Actual method as per maths. If you are in high school, what they taught you was using logs. Put log on both sides, then calculate as per log table. Then to remove the log, again do anti-log and remove it and come back to normal. Okay, and when that log comes to the other side, it becomes anti-log. All those things. But obviously, log tables are not given to you in the exam. Okay, so what you can do is this calculator trick. Calculator trick. Now, press 20 in your calculator. 20 to the power of 4 by 5. I'll tell you how to calculate this. This will be required. This will be required in some chapters. Now, there you can't go in search of log table. 20 in your calculator you take. Press this root sign in your calculator 12 times. Root sign in your calculator 12 times. 20, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay, you're getting some number. Correct? Press minus 1. You're getting one very, very small number you're getting. Correct? No. Then multiply that into what was there over here. 4 by 5. So into 4 by 5. You got some number. Correct? Correct. Now plus 1. Add that 1. Now, that time you divided. No. I mean you rooted it, right? So now you have to square it. Into is equal to 2 times. 3 times. 4 times. 5 times. 6, 7, 8, 9, 10, 11, 12. How much did you get? 10.9875. How to use this, we'll discuss when we go into chapters. Okay. How to use this, where it will be relevant, everything we'll discuss. But this is the calculator methodology. If at all, when you're squaring, it is not directly full number, whole number. If it's not there, then you will have a problem because we don't have log tables. Yes, I think with that we are done with the basics. We are done with the basics of FM or just basics, maths and all, not even there, that we have to know. Now we'll go into our first chapter, mergers, acquisition and corporate restructuring. Okay, this we have to discuss in detail. Obviously, we will not finish discussing the concepts completely, or we might not start solving problems also today, but we have to discuss this in detail. This is our first chapter. Almost every time questions are asked from this particular chapter, and it's one of the easy chapters. Now, if you see in your index in your study material, it is towards the end. Okay, it's towards the end, but we'll start with this because what is there at the starting? No, its intensity is very high, so we'll not go there. Now, basics of FM already we discussed, earnings per share and all we already discussed. I'm not going to discuss that. Now, what is covered in this chapter? First of all, tell me what is merger and acquisition? What is mergers and acquisition? One company taking over another company. One company buying another company. One company purchasing another company. Correct? Now, like, sir, what is this? This is already there in FR. This is already there in FR. Correct? It's there no in FR. It's there in Inter also. Correct? Now, I'll tell you one thing. There is one guy here and there is one guy here. Two people from two companies, top management officials. They have met. Now both of them, they have shook hands. Once they shook hands, merger is done. They have decided that merger is done and they have gone ahead in life. When the merger is done, post-merger, accounting, what to do in the books of selling company, what to do in the books of purchasing company, this will be done by whom? This will be done by whom? FR. This will be done by FR. Accounts. FR is just one fancy name for accounts, that's it. Okay, financial reporting, accounts only it is basically. Okay, FR. Now, what did you do? If you see your FR, this question, no, or mergers and acquisition, directly it starts with A Limited takes over B Limited. Correct? A Limited absorbed B Limited. Correct? From there only the question started. Now, whether they should absorb or not, or after absorbing, these shareholders, what is their situation? Those shareholders, what is their situation? Who is going to talk about that? AFM. That means pre-merger analysis is done in AFM. Okay. Should we pay cash? Should we give them shares? In FR, what will be there? Directly, 10,000 equity shares are issued, 2,000 preference shares are issued, 5,000 debentures are issued, 10 per share cash is given. Correct? Directly. Now, how did they decide that? When they did the pre-merger analysis. That is done in AFM. Now, what we are going to do over here and what is done in FR actually has connection, but cross-connected topics are not there. Imagine ICA. Calculate the swap ratio and then you go and do amalgamation. Two subjects got linked with each other. Correct? So, what is covered in this chapter is the pre-merger deal. Is the pre-merger deal going to be beneficial or not? We have to check whether it is beneficial or not. Now, can you think of some mergers? Every day there are some mergers. Can you think of any mergers? Few years back, all the banks got merged into SBI. There was State Bank of Mysore, everything got merged. Correct? And Vodafone Idea is very common. It became VI. Correct? Then I think recent history, if you see, Zomato got merged with Blinkit. Now you're thinking, no, Blinkit is already Zomato's own. It was not Zomato's. It was Grofers. There was a company called as Grofers which became Blinkit. Zomato took it over. Okay. Zomato and Blinkit and so many other things. Okay. IDFC Bank and IDFC Limited. Two things got merged recently. So many mergers are there. Basically, it's like we are actually right now, whoever is attending offline classes, we are sitting in the land of mergers. Okay. Bangalore is actually the place where startup hub it is right now. Now, I'll tell you why mergers acquisition became very, very commonly thought of topic. Even when people are post-qualification thinking, no, what department I want to go to, many of them are thinking, I'll go into mergers and acquisition. They want to specialize in mergers and acquisition. Logic is because there are so many mergers and acquisitions. Because you guys or the current generation is not thinking like how your grandfathers thought. If your grandfather started a business, no, he never thought of selling that business in his life. If he started the business, his intention was to grow the business and give it to the future generation and go. Everybody's alarm is ringing. Change your alarm timings. Okay. Now, current situation, right? Nobody is actually starting business to grow it till their retirement. They are starting business to grow it till a point where somebody, big fish, will come and eat you. They want to just exit with some premium. If big fish is not coming and eating you, then there are bakras. Who are the bakras? Public. Go to IPO, public will become Bakra. You got your money, exit. Correct? No, that only is happening. No. Actually, everybody is seeing IPO and just going and investing. They are not reading what is there in the prospectus. In basics, we studied prospectus. In foundation or something, law, we have studied prospectus. But we are not focusing on that. Most of the prospectus, if you see properly, where the amount that is raised is going, not to invest in business, to pay the previous people. That means you are filling somebody else's stomach. You are thinking you are going to, your money will be used and it will grow. No. Especially Zomato, if you see, right, when they went into IPO, around 90%, I don't remember the exact percentage, but around huge percentage, more than 50% was to pay the previous owners or previous lenders. That means of your money, 40% only will be put into business. That means you are going to be Bakra only. Correct? No. So nowadays, people who are starting business, they just want to grow in revenue. They don't care about growing in profit. They want to grow in revenue, and then somebody bigger person will come and eat you, and then you retire and chill. Then you start one more startup and do the same thing for next 5 years. Correct? No. Because nobody bothers about profit. If you think, okay, specs people, lens cut. Correct? Lens cut is actually in loss, right? I mean, recently they showed profit because they want to go into IPO. That profit is full bakwas. Okay, full bakwas profit it is. Selling investment and all, they made profit. Okay, are they mutual fund company here to consider that profit? Nothing. If you remove that, they are still in loss only. Why that loss? Actually, company is good. Company is good. You know why they are in loss? Because of their marketing expense. If you don't have YouTube premium, no. If you don't have YouTube premium, then you will get specs. You know why? Because when you're using YouTube without premium, every fourth ad will be lens cut ad. Then you are like, I'll go and buy lens cut ad. Are you getting a lens cut? I'll go and buy specs. So basically, that is the amount they're spending on marketing. Okay. Logic is simple. Nobody is happy, or what do you say, happy with the profits which they are making on their own. They want to expand. They want to grow. And the competition is high. So basically, these days, sales happen because of marketing. You get Instagram ad 10, 1% will click on that. 10 means 2% might click and 1% will buy. That is how sales is happening basically. Okay, but your grandfather didn't think like this. Your grandfather is like, no need of ad and all, word of mouth. People should be talking good things about us. Then people will invest. Okay, they'll come and buy my product. Once he purchases my product, he should be my loyal customer. He'll be coming to me only. Are you getting my point? If you have your grandfather still alive, okay, if you see, if at all he is in moving condition, then the grocery which he'll purchase, he'll purchase from that same shop. He will not change the shop at all because that is the loyalty. But if you are buying that grocery, you will order it on Swiggy Instamart. Correct? One, because you are lazy, and one more, you are getting offers there. Correct? Your grandfather is not lazy. He likes to walk. He likes to go and talk to the shopkeeper. Kashtasukha, they'll be talking for some time. Okay, then the purchase will happen. That loyalty. So that business mindset is not there. That is why mergers and acquisition, okay, very common. And when it is very common, you should be very happy as commerce professionals, right? You should be very happy. If it is very common, that means people will be there doing it. If people are doing it, they don't have idea. They only know we want to buy the company. Then all the things we will do it, and then we'll send one big bill. Correct? No. Yes. Now, mergers and acquisition, if you go into Big Fours and all, you might end up in mergers and acquisition also. Okay. Actually, frankly speaking, it's not that big a department. Okay. But money is there. Because people are dealing in crores of buying and selling. Fees will be in lakhs. That is why money is there. That's it. Otherwise, if you think of growth and all, nothing, you'll be doing the same thing but you'll be an expert in that. Okay, but if you go into some income tax or something, new types of notices, correct? Every time new types of notices, you'll feel, wow, what I thought income tax department person, I never understood him only. Okay, that fellow is thinking from different angle, but there also haram is okay. Okay, I shouldn't be telling, but there also haram is. Even if everything is correct, still they will take a bribe. Still, recently somebody was telling, they are paying their GSTs properly, they are paying their taxes properly, everything as per system, everything is correct. They sent many notices, these people also replied, they went and met also. Finally, the officer was like, so many times we met, we put so much effort, something you give us. This is like telling, ayo, amma, taye, Give something at least. Correct? No. Okay, but it will change with all these faceless things coming. No. Okay, then they can't do anything. No, in video calls. But GST, still everything is possible in GST. They'll send notice. They'll only tell you how to reply to that notice. Yes, you don't have to do anything. I actually have few clients. Okay, because I'm always into teaching. I have few clients. Sometimes I get notice. What I only do is, no, I don't bother wasting my energy on that notice. I go straight to GST department, sit with the officer. I say, tell this is the notice, tell how to reply. Okay, he'll only tell what to reply, what to show, what to change, everything he'll only tell. Okay, then I'll reply like that only. He'll approve. Okay, I'll tell client, okay, I don't want to be part of that bribe. Okay, I'll tell client, please go and make this payment to him. Okay, I don't want to take and then 10% only give to the income tax officer, keep 90%. I don't want to do all that because I will that fast money goes fast also. Okay, I don't want to do that. So I tell client, say he's asking this much, you go and give, it will be sorted. But imagine, you don't have to actually put so much effort. Go directly and ask him, he'll only tell you. But I'm telling you, do ethical practice because there is money. In ethical practice, there is money. I'll tell you how. If client doesn't get notice or client doesn't get to pay penalty rate, then client will stay with you only. If you have done your work properly, you will reply to the notice. There might be many replies and counter replies, but that is the situation. I mean, sometime when I was doing articleship, someone told me that you can only be a successful chartered accountant or a rich chartered accountant. You can't be. I mean, what is that? You can either be a good chartered accountant or a successful chartered accountant. You cannot be both. They said. Good chartered accountant means who is following all rules. Successful means who is not following rules but is making money. But now you can be a good chartered accountant and a successful chartered accountant because everything is getting digitalized. So paying bribes will reduce. Okay. Now you make them follow the rules. Let them pay more tax so that 4x penalty won't come later. Yes. Let's not worry about that. Tax, DT, why we are worried? We are AFM. We are only telling buy the company. After that, we are going home taking the fees. Correct? No. If company goes into loss, I am not responsible. Hey, today P ratio was 10 when I told you the valuation. Later on, Trump did something, P ratio 1. I am not responsible. Clear? Now, find out the benefit to shareholders based on given swap ratio. What is the swap ratio? Swap ratio, very common point of mergers and acquisition. Swap ratio means exchange ratio. This exchange ratio is not the forex exchange which we are talking about. Exchange ratio means for the shares that you have over there, how many shares will I give you over here? Clear? Now find out the benefit to shareholders. Now I told you pre-deal analysis, pre-deal. We are not talking about post-deal. Post-deal will be spoken about in FR. So when we are talking about pre-deal analysis in terms of earnings, in terms of market value. So in terms of earnings, what will be the benefit to the shareholders? How much earnings will be more? In terms of market value, how much the company's market value has grown? This is the major question from AFM. Major question. We'll see how to solve that. But one of the major things that we are going to learn is this. Now, what should be the share exchange ratio? This is called a swap ratio. In swap ratio, we have something called as equitable swap ratio. Equitable swap ratio means what? I am also happy, you are also happy. Win-win situation. Correct? This is like a win-win situation for both. Equitable swap ratio. Maximum swap ratio means what? First of all, two companies are there, right? One company is called as purchasing company. Other one is called as selling company. That was what we have studied in CA Inter. But here we'll use the words called as, one is called as acquirer company. Other one is called as target. Other one is called as target company. Now maximum swap ratio means that guy is not listening to me only. I told boss will be in win-win situation. I am also happy, you are also happy. He's like, no. I am too good. Who are you? Okay, he is telling I am too good. Then I will go to a level of paying more and more and more to him. But I'll go and pay more and more and more to him as long as I am not sad from tomorrow. What does that mean? That means I will keep what I was getting earlier, same thing. Whatever benefits are there, everything I'll give it to him. Whatever benefits are there, I'll give it to him. Both of us joining together, our earnings are going to increase. That extra earnings to them. Okay, then I'll decide my swap ratio. But I want to get the same earnings per share what I was getting earlier. That is maximum swap ratio. That means taking the target company and keeping it on the head. Taking target company and keeping it on the head. Minimum swap ratio means what? Nobody is ready to buy him. Nobody is ready to buy him. Okay, now full ball is in my court. Correct. Now what will I do? Whatever I tell, that guy has to listen. Otherwise, he has to go into internal reconstruction. Amalgamation won't happen. So now what will we do? We will give them what they were getting earlier. That's it. Extra nothing. That means they will get the same amount. They will not have any growth. Is that clear? They will not get extra EPS or they will not get extra market value. This is market maximum and minimum swap ratios. Both can be asked in the exam. Now, how to save a loss-making company? Restructuring. This was nothing but internal reconstruction. Internal reconstruction, which was there in CA Inter, which was asked for good amount of marks. Nothing. Go on passing journal entries. Correct. Every journal entry, one thing will almost be common. Capital reduction account. Correct. That was one of the easy things which gave us huge amount of marks, right? That internal reconstruction is there. Obviously, we are not going to pass journal entries. Easy part. Here also it's easy only. But this is like one small 5% of the chapter. Okay, 95% of the chapter is the first two, what we are going to see over there. Clear? Now, we'll start with the basic concepts. We have a lot of time, right? Yes. Basic concepts. We'll try to finish as much concepts as possible today. Tomorrow we should start with the solving problems of mergers and acquisitions. Now, swap ratio is also called as exchange ratio. Swap ratio means what? For everything that you have over there, I will give you something in my company. If I call this swap ratio and if I write 1:4. 1:4. You saw, no? You read it, no? When I wrote that number, you read it, no? 1:4. 1:4. If you read it as 1:4, no, you can always end up in a very confused state of mind. You can always think that in different angles when we go further, you may get confused. So 1:4 will not read it as 1:4. This will be read as 1 share for every 4 shares. 1 for 4. This semicolon which is put, no, will not read it as is to. It will be read as for. 1 for 4. That means 1 share in this company for every 4 shares held by you. Clear? Now swap ratio. How many shares of acquiring company will be issued against every 1 share of target company? How many shares of purchasing company for every 1 share of selling company? How to read swap ratio? Okay, common mistake, reading swap ratio 2:3, 2:3. Okay, convert way of reading, 2 shares to be issued for every 3 shares in target company. 2 shares for every 3 shares. Okay, just read it like this. Now you can read it as 2:3 and also still solve correctly. There is nothing wrong in that. But somewhere you might end up with confusions. So when it's written like that, 2 for 3, that means if you have 3 shares there, you will get 2 shares here. Clear? Now, synergy. Synergy means what? Synergy means what? One company was there, A Limited. One more company was there, B Limited. One company was there, A Limited. One more company was there, B Limited. These both joined. After they joined also, no. Their earnings are same. What is the point of joining? There's no point of joining, right? After they join, maybe this fellow has different technology. Because of that, earnings are more. If here earning is 10 rupees and here earning is 4 rupees. And after joining, if I tell that their earning is 16 rupees, 10 plus 4 is actually 14 rupees, but it is 16 rupees. That means 2 rupees is synergy. Synergy in earnings. Synergy in earnings. Clear? Synergy can also be in market value. If earnings increases, market value will obviously increase. Correct? Now this 16 into P when you do, you will get market value of higher market value. Let's say P is 10. 160 you will get market value. So that means what I'm trying to tell you, if earnings increases, market value will surely increase. Now, earnings remain same. Possible. Earnings remain same. There is no growth. But overall company earnings will be more because both the earnings got merged with each other, clubbed with each other. Now, earnings increases, market value should increase. But earnings doesn't increase. Can the market value still increase? Yes. Why? Because the earnings of the target company came to acquiring company. Acquiring company's reputation is more than target company. So their PE multiple will be more. Can you see how PE is coming and playing an influence over here? Now, if I tell over here, there is a comprehensive example, but for that we have to learn other concepts also. Now, if I tell you 100 and if I tell you 20 and this is earnings Okay, this person's PE is 10. This person's PE is 6. So 10 into 10, their company's value was, market value was 100. And 20 into 6, market value was 120. Sorry, 1000 and 120. Clear? So this is the situation. Can you see their market value is 100 and 120, 1000 and 120? Okay. So if I total this, you feel, sir, after they are clubbed, it should become 1120. Oh, by the way, I forgot to tell about this. Every page has this, okay? We are going to become chartered accountants. Simply, manifestation. Okay, when you keep reading that again and again, no, universe will align itself. Because little, after coming to CA, little we have to believe in universe, God, all those things. Maybe before coming to CA, you didn't believe in God, but after coming to CA, surely you will believe in God. There are a lot of people, okay, I don't know if you all are like that, but there are a lot of people in foundation and all, I find, foundation, inter and all, a lot of people will be there who don't believe in God and all this mindset, okay, that they have. I'm like, God, I'm not going, I believe in God, okay, I'm not going to force you to believe in God, but you chose the wrong course to take that risk. Okay, you chose the wrong course to take that risk, because now this course can suddenly make you believe in God. Okay, that's why, at final level, I think everyone will be believing God. Already we have seen those tough days. If at all, inter days were also easy, articleship will make you believe in God. Yes, now 1120. Can you see that there is no increase in earnings? I'm telling no increase in earnings at all. After these both are merged, can you see their total is 1120? That means their total market value should be 1120. But actually, if you see, their total earnings are 120. 120. Now 120 will get multiplied by 10 and this becomes 1200. What happened over here? This fellow's earnings got merged with this fellow and this earnings came and sat in this company and this company's reputation PE multiple is 10. So now 1200. Can you see? So therefore you are actually, when you see over here, you are getting a synergy of 80. Without even having increase in earnings, we have synergy of 80. That is because this fellow's 20 was getting multiplied by 6. Now it got multiplied by 10. That means extra 4 PE multiple is basically 80. Clear? So their synergy, their earnings got multiplied with our PE. So our PE is higher. Now imagine if this was inverse situation, then it would have been ulta also. It could have been ulta also. Clear? So this is the situation, 80. Okay. And what is this 80 now? Synergy. This I told you just to prove that without increase in earnings also you can have increase in market value. Now if I tell you after merger, the earnings is 140, then I don't have to tell you market value has to go up, no. Now 140 into 10 will become 1400, correct? So 1400 and 120 difference, you have 280 synergy. 280 synergy. Now this 280 synergy came because of two reasons. It came because of increase in earnings. Increase in earnings is 140, correct? And then also because of increase in PE for the target. Okay, now we'll not bifurcate it. It's not possible to bifurcate also. So 280 is the increase in synergy. So if earnings increases, market value will increase. But if earnings doesn't increase also, the market value can increase because of change in PE. Is this clear? Basically, it's simple. Okay, the target company had less reputation, but they were earning 20. Now when they got merged with us, there is no target company only, but their earnings came and sat with us now. Now their shareholders are sitting in our shareholders list, but now their shareholders will be valued based on our company's valuation. So our company has a better reputation. So their earnings also gets now multiplied by our PE. That is why that extra market value will be created. Now, synergy means excess amount over and above simple sum of two numbers. Synergy could be either in earnings or in market value or both. Clear? Now, synergy in earnings means EAT minus EA plus ET. What is this EAT? Earnings of acquirer and target together, not earnings after tax. Okay, maybe I should have written it in a different manner. It should actually look like this. EAT is equal to EA plus ET. Okay, EAT will create confusion. Earnings after tax, you'll feel EAT is equal to, sorry, what I'm writing? EAT minus EA plus ET. What is this EAT? EAT is earnings of merged firm. AT is merged company. Okay, EA means what? Earnings of acquirer. ET means what? Earnings of target. Clear? So this is the situation. Synergy in market value will be VAT minus VA plus VT. What is VAT? Value of merged company. What is VA? Value of acquirer. What is VT? Value of target. Is this clear? Are you clear with this? So this should be the formula for you to calculate synergy in earnings, synergy in market value. You actually don't need a formula, okay, because that formula will get completely merged with a lot of other concepts and then we go further. But otherwise, basic calculation of synergy is this. Now you can also have synergy given in question only. Some questions directly they can give you synergy. What will happen? We'll discuss when we go further. Next, our next important thing, post-merger EPS, combined EPS or EPS after merger. Now EPS before merger, what is the formula? Earnings available to equity shareholders divided by N, number of shares. That was the thing, correct? So now post-merger also, that formula basic should be same. Earnings available to equity shareholders, but earnings after merger, everybody's, divided by N. Before N was only acquiring company shares. Now you have issued some shares to target company. So if there is share offer, okay, what will happen? Earnings EATA of acquirer plus EAT that is of target plus synergy in earnings. Acquirer's earnings plus target's earnings plus extra earnings that we are going to make. That will be the earnings available to equity shareholder now. Divided by NA. What is NA? Number of shares which are there in acquiring. Plus, some people also call it as delta NT. Okay, we'll not use delta and all. We'll try to simplify the formula. It's basically NT into swap ratio. NT into swap ratio. If it is 1:4, that means how many shares were there over there? We have issued 1 share for every 4 shares. So 0.25 we have issued. So now that also comes and sits in our shareholders list denominator. So basically this formula is also earnings available to equity shareholders divided by N. But earnings available to equity shareholders after merger divided by number of shares after merger. Is this clear? Are you clear with the formula? Okay, now when you're calculating earnings, remember not just adding to earnings, you have to even add the synergy. The extra earnings also belongs to us now. Are you getting this? Now sometimes what will happen, imagine I have the technology to manufacture, I have the technology to dry cocoa. To dry the cocoa, I have the technology. I dry and supply the cocoa to one more company which manufactures chocolate. One more company has the patent from dairy milk to manufacture the chocolate. They don't know how to dry the cocoa at all. We give them the perfectly dried cocoa with which they can manufacture the chocolate. Now they have the patent. Now I cannot manufacture chocolate. Even if I know the recipe, I cannot, because tomorrow I'll get notice. Because patent is with them. Now they are earning by selling chocolate. We are earning by drying cocoa. Now both of us merge. What will happen? Everything happens over here. So automatically there will be more earnings. Some of the cost cutting can happen because of this merger. So therefore, this synergy you have to add when you are calculating the total earnings. Is this clear? Now, NA means number of shares of acquirer. NT means number of shares of target. Okay. Now, what did we learn? We learned the formula for what? EPS, post-merger EPS, if it is a share offer. If it is a share offer. If it is a cash offer. What is a cash offer? Settled in cash. That means we'll give you your worth, but you don't come and sit with us. Okay, we'll give you your worth. Take the money and go away. This was something in Inter was making it amalgamation in the nature of purchase. Correct? Now here, remember, if it is cash offer, this cannot be there, no. If it is cash offer, the concept of swap ratio only is gone. One share for 4 shares, 1 share for 8 shares, that concept only is not there because it is a cash offer. We are just giving them money. Now, see this. Still the formula is earnings available to equity shareholders divided by N. Still it is same. Now, EATA, that means earnings after tax of acquirer, earnings after tax of target. Their earnings also comes here. Plus synergy in earnings, that also comes here. Correct? Huh? Now, minus. Remember, AFM always thinks we are Bikari only. I told you this. We don't have money anywhere. Moment cash offer comes, we are assuming that we are going to take a loan and give that money. We don't have single rupee with us. So, actually, it is basically opportunity cost which we have to calculate. So, if at all we are paying cash, that we lose the opportunity of putting that cash somewhere else and earning money. If at all I put 1 rupee into my business, I get 10% return. Correct? Now, if that 1 rupee goes away in paying somebody, that time what will happen? After tax interest percentage or opportunity cost percentage, whichever is given in the question, into cash paid. This is your loss. This is your loss. That's why the loss is subtracted from the earnings. Are you getting this? So earnings available to equity shareholders divided by N only, but our earnings plus their earnings. Both of us merged, we got extra earnings. When we got extra earnings, we got this extra earnings because I did some spending. What is the spending? I gave him money. To give him, when I gave him money, I lost money. That is the opportunity cost which is gone over here. That divided by NA. Why I wrote only NA over here? Because we are not giving them shares. Whatever shares were there in acquiring, only that remains. Is this clear? So what did we learn now? Post-merger EPS of, post-merger EPS if it is shares offer or if it is cash offer. Now, if it is shares offer, let's not look at the screen. Let's try to understand. Our base for EPS is always same. What is that? Earnings available to equity shareholders divided by number of shares. Weighted average, but here we are in AFM. Okay, divided by number of shares. Now, earnings available to equity shareholders after merger. Okay, if it is post-merger and if it is share offer, I gave them shares and I acquired them. Now, our earnings are still there. Their earnings came and joined. When both of us joined, we did better things. So, we got synergy. That also came. Now, this is my earnings available to equity shareholder. Divided by, my shares were already there. Plus, to get them, I have issued shares. So, our shares plus not their shares. Plus their shares into swap ratio. Is this clear? Now, if it is cash offer if it is there, I am not giving shares, I am giving them money. So, when again, basic formula is same. Earnings available to equity shareholder divided by number of shares. Our earnings plus their earnings plus synergy. All these three things got added together. But to get their earnings and to get this synergy, I paid them cash. That cash could have put into my business. I lost some money there. Or for paying that cash, I have taken some loan. For that, I have to pay interest. So when I pay interest, that money goes out. So minus interest rate or the opportunity cost rate into the cash paid. Divided by number of shares. Only the number of shares which are there over here are there because we are not going to give them any shares. Now I have a very interesting question. Formula you got? No. Why it is after tax interest percentage? Interest percentage 10% SBI, but if 30% is tax rate, here we will be taking only 7%. Why after tax interest percentage? What? Yes, because if there is interest, tax will reduce. EBIT minus interest. That time EBT, right? Now, if interest is not there, EBT and EBIT will be same. It will be higher. Now, suddenly interest comes over there. Earnings before tax goes down. So, because of interest, expense, you know this, right? Put more expenses, tax will reduce. Okay. Now, if there is an extra interest, extra expense, automatically the tax benefit will be derived. That is why it is after tax interest rate over here. Okay. Opportunity cost percentage, they are only telling you. So you take the percentage directly. Don't do after tax for opportunity cost percentage. Because when they're telling you opportunity cost, that means tax, everything is considered and that opportunity they're telling you. When they're telling you interest rate, they're not telling you the opportunity, right? Interest rate, opportunity comes when you remove the tax rate only. Is this clear? Are you following this? Yes. Now, post-merger MPS or post-merger market capitalization. Now, what was the basic for calculating MPS? What was the basic for calculating MPS? EPS into P ratio. Do you remember why we recollected FM? Straight away, first chapter only it will be impacting us. EPS into P ratio. Another one was what? Earnings available to equity shareholders into P ratio. This also in totality. Correct? EPS into P ratio will give you market price per share. Earnings available to equity shareholders into P ratio will give you market cap or market value. Correct? Or we can also do what? EPS into P ratio into N, number of shares. EPS into P ratio got market price per share into number of shares. So different ways to calculate the same thing. Now this is our base. That's not going to change. Now if post merger P ratio is given or it is assumed to be same as acquirer P ratio. What does it mean? Post merger P ratio, if they tell you, boss, their reputation, your reputation, both will change the P only. We saw no in this example. In this example, we saw that we took the post merger P as 10 only. Imagine in the question they tell you post merger P is 12. That means your reputation will go up because of the merger. So then you take 12 only. But most questions they'll be silent. They will not tell you what is the post merger EPS. That time, I mean post merger P. That time you are going to assume that the post merger P is going to be the same as acquirer's P. Clear? Now post merger P is given. It is assumed to be same as acquirer's P. If shares offer, if it is shares offer, what you'll do? Post merger P ratio into post merger EPS. That's what we did just now. Or post merger P ratio into earnings. P ratio into earnings. So therefore EATA, earnings of A, earnings of target plus synergy in earnings divided by number of shares. But number of shares of ours plus swap ratio into their number of shares. Can you see same formula just expanded in different forms? That's it. Okay, now if it is cash offer, again post merger P ratio into post merger EPS if you have direct dip per share. Now or post merger P ratio into earnings of acquirer, earnings of target plus synergy minus after tax interest percentage or opportunity cost percentage into cash paid divided by NA. So same thing what we should do for EPS. We use that in the numerator of the MPS and divide it by number of shares. Okay, is this clear? Are you following this? Now, if synergy in market value is given or if it is computable. Now let's not worry about this. Okay, ignore this. I'm just writing over here refer table. I'll give you one table which you have to write. Okay, that table will discuss all the synergy effects, how synergy will impact. Now, format to calculate benefit to the shareholders. Commonly asked question. They'll ask benefit to shareholders. That time it is better to use this format because I see everywhere they are using this format. So we'll use this format. Now, how it is asked, you have to see. I say, right? They don't ask any question, same question in different ways. They'll tell find impact on EPS, MPS of acquiring and target companies. Or they'll tell whether shareholders will be better off or worse off. Just like that, they'll frame the question. Ultimate thing is what? Calculate the impact on the shareholders, benefit to the shareholders. Now, how is it done? Compare pre-merger EPS or MPS and post-merger EPS or MPS. Now, there are some intricacies, small things there which we have to understand. Let's not discuss that as just theory. Now, basically, if I were to tell benefit, boss, before my EPS was 5, now my EPS is 6, 1 rupee benefit. Before market price per share was 20, now the market price per share is 25. That is the benefit rate. That is what we are supposed to calculate. For whom? Acquiring company also, target company also. Acquiring company people will be like, after acquiring them, more people are there to eat the same dosa. Now we should not go down, right? They'll want to know what is their EPS as well as their market value. Now, target company will be like, we were getting some money, we were eating some dosa. Now, bigger dosa will get or smaller dosa will get. We'll get to know. So, basically, this is happening pre-deal. This is not happening post-deal. Imagine already the company is taken over. After that, what can be done? Only accounting can be done, right? So, pre-deal analysis will be done and then it will be presented to both the shareholders. Obviously, the shareholders of acquiring company, okay, they will ask the benefits. So the management of acquiring company, they'll go to some person who can calculate this benefit and give. Shareholders of target company, they'll go to their management. They will go and ask some CA over there to do it. So both of them will present to their people. This is the situation. Now both will carry that sheet and come for the discussion. If the discussion goes well, merger done. Are you getting my point? So basically it's like, I was about to give an example, but it's not that. Okay. I was about to tell you like, it's like your, when you go to street side vendors and do bargaining. Okay. You know what is a lower cap. Till where you're ready to, till where you're ready to pay. More than that, you will not be ready to bargain only. He also in his head knows his lower cap till where he can go down. That is exactly what will happen between two shareholders now, two companies now. Now, this bargaining example doesn't make sense if you're talking about your mother bargaining. If your mother bargaining, that example will not suit, because that bargaining thing came in my head. Okay, but when I was about to tell, I remembered how mothers bargain. Then it would not make sense at all, because if the the street side vendor tells 1,000 rupees, you will ask for 800 or 900. Mother will directly ask for 100 rupees. Directly she'll tell 100 rupees. When she tells 100 rupees, two people will be in shock. One shopkeeper, one more you. Both will look at your mother like this. Because you are feeling, my mother is directly hitting the ego of that baby. Directly questioning, why are you doing business itself? Now, one more thing is there. That was priced at 400. When he saw your mother coming, he also made it 1,000. He also knows your mother will come and ask for 100 only. He made it 1,000. Then finally your mother will buy that item for 300 and come. You will be shocked. You would have paid 900 and come. You would have asked for 800. He told 900. You paid 900. You will be very happy. 100 rupees I negotiated. Okay, but you can't bargain like that, right? Directly 100 rupees only. Many times I was like shocked. And if they don't tell anything, no, they have one more technique. They'll start walking. When they start walking, no, 100% shopkeeper will call back. He'll be like, Amma, bunny. I don't know. That is a crazy level of thing. But I feel bad, okay, sometimes. Street side vendors. We go and bargain like crazy with them. Then we'll go to mall and buy and come. Without even bargaining anything, premium pricing. Then we'll be like, hey, no, sir. In mall, no offer was there, sir. 5,000. Okay, they cut like this and then they wrote 2,000. You don't know that actually it was 1,500. They cut inside and they made it 2,000 for you. This is actually the deal, right? So sometimes, recently only I decided that street side vendors, I will not bargain with them. Especially vegetable and fruits, I will not bargain. I'm like, they're also doing business with difficulty, right? Because that same vegetable you go and buy from Spar, you'll be paying premium pricing. Just one sticker will be there on the apple. Same apple you'll buy a street side person. Okay, so let's not do that. Now, this is our situation. Post-merger EPS and MPS will be compared. Okay, this is a table. I'll not discuss this table at all because it will be plain discussion now. We'll take one example and we'll discuss that. Now, see, gain or loss. See, basically, it is what? Post-merger EPS. Okay, minus pre-merger EPS. Gain or loss per share, number of shares, you'll get total gain or loss to the shareholders. Post-merger EPS, you're getting 5 rupees. Pre-merger EPS, you are getting 4 rupees. 1 rupee into number of shares, you'll get the total benefit. That calculation you have to do for acquirer as well as target. This is a very commonly asked question, benefit to shareholders. Benefit to shareholders. You need to know whenever they use the word, are the shareholders better off? That means they're asking you to calculate benefit. Or directly they might also ask you. Now, swap ratio computation. Swap ratio we saw, no? Now, swap ratio, how will you compute? It's always the factor of target company and factor of acquiring company will be used, correct? But always put the target company on top. Basically, if you are not getting confused, no, always remember when you're going to buy the company, no, you're going to keep them up. Once they join, no, you'll put them down. Correct? No. When you're going to purchase their company, you'll talk good things about them. So, always the target company's things will be on top. Okay? Relevant factor of target company. Now, this can be based on EPS, it can be MPS, it can be based on book value per share, anything. So, if it is EPS, no, then you will write EPS of target company divided by EPS of acquiring company. Clear? If it is MPS also, you will do like that. If it's book value also, you will do like this. Now, EPS, MPS, book value and all, are they positive things about the company or negative things about the company? Positive things, right? Now, sometimes a swap deal, okay, can happen because of a negative item. Negative item means what? Negative factors. For example, if banks are swapping, no, then they might be like, how much NPA you have, how much NPA I have. Correct? Based on that. So whenever it is, I have written somewhere, yeah, whenever it is a negative, see, sometimes swap ratio formula is reversed. When swap ratio is based on some negative ratios, when lower number of such ratios are considered better over higher number of such ratios, then like gross NPA ratio, debt equity ratio and all, numerator and denominator will get swapped with each other. Then acquiring will be on top, target will be below, which is very, very rare. Okay, negative ratios are very, very rare. Usually it's based on earnings, market value, all those things. So relevant factor of acquiring divided by relevant factor of target. Is this clear till here? Now, do not make mistake of using total data. That means total earnings, total market value. It's always per share basis because total came because of per share only and number of shares. Number of shares are different in these companies. So you cannot use the total data. Always the swap ratio will be calculated based on per share basis. That is EPS, MPS, BVPS. BVPS is book value per share. Clear? Now sometimes what will happen, one person in the management, board, he'll be like, swap ratio should be based on earnings. One more person will like, earnings, whatever it is, P will make the ultimate difference. It should be based on market price. One more person is like, what book? Earnings and market price. Ultimately, we are seeing financial statement. It should be based on book value. Now, to keep three people happy, what they will do? They might be like 30% of this, 40% of that, 30% of this. Okay. So everything you are giving weightage. So that time what you will do? Weighted average swap ratio will get. Based on EPS, MPS and book value per share. These kind of questions are also there. Clear? So what you have to understand, whatever swap ratio, target on top, acquiring below. But if it is negative information, then it is acquiring on top, target below. Clear? And if it is multiple information, take weightage of each of those and then you will get the weightage. Is this clear? Any doubt till here? Anybody? Swap ratio. Okay, basically if it is EPS, what you do? EPS of target divided by EPS of acquirer. Now, after that, maximum swap ratio, and only one other topic we have, that is minimum swap ratio. After that, done. We'll not start questions today because we have to still do some examples. Now, maximum swap ratio means what? That time I told you something about it when we were learning what is there in this chapter. Maximum swap ratio means what? What is maximum swap ratio? Maximum I can go till where? I will go till where? Till a point where I don't start crying. Are you getting my point? My shareholder should not be unhappy, with this merger deal. So maximum swap ratio means you give all the extra benefit to them itself. You will be earning the same thing what you're earning before. So here, from the point of view of acquirer, 100% synergy gain shall accrue to target. That means whatever benefit is there, it will go straight into the pocket of whom? Target. Hence, post-merger EPS or market price should be set equal to acquirer's pre-merger EPS or market price. What does it mean? Acquirer was getting 10 rupees per share. After merger also, he'll get 10 rupees per share only. He'll get 10 rupees per share only. Who is going to get benefit? The benefit will be for the target because it is maximum. If I'm talking about minimum, no, it is from whose point of view? From the view of target. That means minimum means what? All benefit I'll keep with me. What you are getting yesterday, I'll give you the same thing today. So here 100% of synergy gain shall accrue to the acquirer. Hence required post-merger EPS should include full amount of synergy accruing to acquirer only. So acquirer actually he'll be benefited. When you do that benefit table, no, acquirer will be benefited. The target will be remaining at the same position if it is minimum swap ratio. That means if you are doing swap ratio based on EPS of target divided by EPS of acquiring, both will be win-win. Both will be equitable swap ratio. That means both will be in the same situation. Clear? Now, there is a table methodology to calculate. Okay. And also there are formulas to calculate. Okay. Now, see the formula. Maximum swap ratio, revised EPS of target divided by revised EPS of acquirer. Why it is written revised EPS? Because all the benefit is given to them. So their EPS will change. Now, if you see the formula for minimum swap ratio, EPS of target divided by revised EPS of acquirer. In minimum swap ratio, who is going to keep all the benefit? Acquirer is going to keep all the benefit. Is this clear? Are you following this? Now, if the swap ratio is based on market value, revised market price of target, including whole of synergy, and here it's only market because all the benefit is kept by whom? Target. And here it is going to be market price divided by revised MPS of acquirer. Now, simple. Don't overcomplicate things. Now it's looking like simple formula and like too much to memorize. We'll do that. We'll understand the formula itself. We'll solve problems. Now, just remember one thing for now. Forget about by-hearting the formula. All those things you forget. In fact, the table methodology is also there. Okay, it provides better presentation. Okay, when question is for like 7 marks and it's only maximum swap ratio and minimum swap ratio, then just doing in formula and finishing in 2 lines, I see also will think, right? So better to present it in a table format. Now, when you do it under table format or if you do it using formula, answer should be same. You cannot tell institute, no, I did the as per table format. So swap ratio is 2 shares for 5 shares. I did as per formula. So I'll give you 3 shares for 6 shares. Or you cannot do that, right? That's not possible. So this is basically a method of presentation which ICA follows very often. So both are there. You should know to solve both. If the question is on a bigger topic and swap ratio is just a small working note, then you can use the formula and finish it off. Now, For now, just remember these things. First, if it is maximum swap ratio, that means who is the happier person? Target company. Acquirer company shareholder will not be happy also, sad also. He'll be getting the same thing as what he was getting before, whether it is in terms of earnings, whether it is in terms of market value. If it is minimum swap ratio, who will be the happier person? Acquirer. So target will be having the same thing what he was getting before. So when you're computing maximum swap ratio, remember whose EPS will change? Targets. Whose MPS will change? Targets. If you're calculating minimum swap ratio, whose EPS will change? Acquirer. Whose MPS will change? Acquirer. These are the things that you have to remember. And one more thing that we have to remember is the most important thing: post-merger EPS. Post-merger EPS, if it is share offer, ultimate base for this calculation is what? Earnings available to equity shareholders divided by number of shares. Now, post-merger, earnings of acquirer plus earnings of target. When these two joined, something extra came. Synergy, that also added. Divided by number of shares of acquirer plus the shares which you have issued to target. Shares you have issued to target in what ratio? Swap ratio. So, their shares into swap ratio. Clear? If it is cash offer, then earnings of acquirer plus their earnings came here, plus the synergy also came here. But all this to happen, what we paid? Cash. When we paid cash, what we had to do? We had to pay interest. So because we don't have money, because we are in AFM, correct? No. So therefore, what happens? Interest rate, after tax interest rate or opportunity cost percentage into cash paid. That time that is an outflow that you'll minus, then you'll divide by number of shares of only acquirer because we didn't give any shares. Market price when we are calculating, simple, EPS into P ratio. But post-merger EPS into post-merger P ratio. Post-merger P ratio is not given. So what will you do? You will take the P ratio of acquirer only as the P ratio of target. A P ratio of post-merger. Because we are assuming that same PE will continue for acquirer. Unless it is given P ratio after acquisition is something else. Clear? Or what you will do? You will overcomplicate it. That is P ratio into earnings divided by number of shares. Basically, you're doing the same thing. Clear? Yes, that should be it with the concepts on a overall level. Now we have to solve problems. Okay, we have to learn with some examples and a lot of other things we have to discuss. I think you can take a small break. You can take a break for 15 minutes, 10 to 15 minutes max. We'll start in that. Okay, welcome back. Let's continue. So whatever we have discussed, we'll try to understand it with some example now. Now, mergers and acquisition. Look at this table that I have given. I told you refer table now that time for one more formula. Now see this table. This is pre-merger. Okay. This is post-merger. And effect of merger. Effect of merger means what? Because of merger, what extra can happen? Synergy. Now, if I take EATA, that is earnings after tax or earnings available to equity shareholders, whichever it is, okay, of acquiring company, and this is EATT, and that is earnings of target company. If you divide this by their shares, you will get their EPS. If you divide this by their shares, you will get their EPS. Correct? Both the companies' EPS. Now, if you multiply into PE and multiply into number of shares, you will get their market value before merger. All this is before merger. If you multiply into PE and if you multiply into number of shares, you will get their market value before merger. To that, if you add the synergy in market value, if it is given in the question, this can happen only if it is given in the question, you will get the market value directly. But if you don't know the synergy in market value, then you can't take this route. No, you can't take this route and calculate the market value. That time, what will you do? Sir, not done, sir. I have some issues with that. No issues. Do it tomorrow. No problem. You're absent, but you have learned the concepts of today. No, that's more than enough. Okay. Don't worry. Don't tell them, but don't worry about it. Okay. EATA plus EATT plus synergy in earnings. Now, synergy in earnings can be given. If it's not given, obviously, you're going to take synergy in earnings as 0. Clear? When you add both the earnings, what will you get? Earnings of acquiring and target after merged. Okay. Divide by NA plus NT into swap ratio. This we already saw in the formula. You got the EPS of acquiring and target company. That you multiply into P ratio. That you multiply into number of shares. That time you'll get the market value of target company. This is the route you're going to take usually. If synergy in market value is given, then you can't take this route. No, directly you add it, you'll get the market value of acquiring and target. Clear? Just to like simplify the formulas, I made one table. That's all. Okay. Now, if it is cash offer, what will happen? Now see over here, same for everything, same, but synergy which is there, from that you'll subtract the after tax interest, that is opportunity cost you're going to subtract. That time you'll get the EAT divided by NA only, because swap ratio is not there. You'll get the EPS. Now assume loan borrowed, because to pay the consideration we don't have cash. I told no, we think that we are bikaris in AFM. We don't have money for anything. Whenever money is spent, that is because of loan. Now here again, when you're adding, if at all directly you're adding plus synergy in market value minus cash paid. Are you getting it? From earnings, what gets subtracted? From earnings, what gets subtracted is the loss. Correct? That is the opportunity cost. But from market value, what gets subtracted? The cash paid. Correct? Market value is basically the liability side of the share of the balance sheet, right? The value of the shareholders. When you add this, what will get subtracted? The entire cash paid will get subtracted. Here, the opportunity cost will not get subtracted. Are you getting this? So usually you will take this route. You will take this route to calculate only if the synergy in market value is given. And when synergy in market value is given, what you are going to minus, not the opportunity cost, the entire cash paid only is going to be subtracted. Clear? So basically it is PE. PE of acquiring company will be taken as PE of acquiring and target together. This we already discussed if question is silent. Cash paid will reduce the market value. Whenever you pay cash, market value of that company will reduce, because obviously assets will reduce. No. Now, ways to compute market value of acquiring and target. EPS of acquiring and target into PE of acquiring and target into N of acquiring and target. This we already saw. Or market value of acquiring plus market value of target plus synergy in market value minus cash paid. So basically in this table, you will take this route. If at all this route is not possible, okay, then you will take this route. That time synergy in market value has to be given. Clear? Yes, all this is already there in the formula, so I don't think you need to write it again. It's there in the formula. Now, this is the example we are going to take. Comprehensive example. Based on this example, we will discuss everything. Now, first, I'll give you time to write. Wait. First, you see what and all we are going to do with this example. A limited, I've taken it as acquiring, and B limited is taken as target. Clear? Now, EAT, 1 lakh for A limited and 40,000 for B limited. N is the number of shares, 10,000 shares and 8,000 shares. Clear? Now, 1 lakh divided by, what happened? 1 lakh divided by 10,000. If you divide this, can you see you're getting the EPS as 10 rupees? And for these people, 40,000 divided by 8,000, you're getting the EPS of 5 rupees. P ratio should be given in the question. It's given as 10 times and here it is 8 times. EPS into P ratio will give you what? Market price. 10 into 10, 100. 5 into 8, 40. This is the base example. Using this example, and swap ratio is taken as 0.4:1. Okay. It is example. It's not based on their EPS. If you take based on EPS, what will happen? 5 divided by 10. 0.5:1 would be there. Can you see 5 divided by 10? It would have been 0.5:1. Swap ratio is 0.4:1. Now, compute in terms of earnings. No synergy in earnings. Synergy in earnings is given. Both. And third case is compute in terms of market value when share offer is given and when cash offer is given. So, we have question number 1 to solve, question number 2 to solve, 3 and 4. Clear? And what and all we have to calculate in these 4 cases? We have to calculate benefit to shareholders. Remember the table I didn't explain fully. I just kept the table. That table we have to learn. And then swap ratio based on EPS. That is fair for both parties. Win-win situation. Maximum swap ratio and minimum swap ratio from all 4 angles. And when we are doing maximum swap ratio and minimum swap ratio, we will do it with the table format also. We'll do it in the formula way also. Clear? Yes. I want you to take down this question. Please write this question quickly in your notes. Done now? CA Final students, I thought fast you like. Please write this entire question. Done? Can we start? Yes. Can I start, guys? This base question is going to be same, okay? For all the 4 cases, we'll keep the same base question and we'll try to understand from all angles. Now, first thing, what we have to understand, swap ratio is 0.4:1. So, if I'm just going to add over here itself, what is the shares issued? Shares issued will be, how many shares are there in the target company? Target company, you can see that there are 8,000 shares. So this is basically going to be 8,000 into 0.4, that is 3,200 shares. How many shares are issued? 3,200 shares. So you know, if it is share offer, 3,200 shares. If it is cash offer, we need more information, which we will see later. Okay, now first thing we will discuss is this one, benefit to shareholder, and our first case is no synergy in earnings. There is no synergy at all in earnings. Now synergy in earnings and synergy in market value is different, and we saw also that time that if there is no synergy in earnings also, there can actually be a synergy in market value. Okay, now understand this. I told you that table which we have to learn. Whenever they ask benefit, this table has to be replicated in the exam. Acquirer target. What does this table start with? Post merger EPS or MPS. Correct? Post merger EPS or MPS. Now, first sub question we told that we will discuss in terms of earnings and not in terms of market value. So post merger EPS we have to calculate. Now pre merger, what is our earnings? 1 lakh. And here it is 1 lakh 40. Total is 1 lakh 40,000. If synergy was there, what we would do? We would add synergy also divided by number of shares. How many shares are there over here? 10,000. Here 8,000. But we have issued how many shares? 3,200. That means 13,200 shares we are going to issue. So 1,40,000 divided by 13,200. How much is it? 10.61. No? Okay. I think 608, right? 60. Okay, whatever. Now that is your post-merger EPS. Now, the table told us first you have to put the post-merger EPS. Correct? Can you see the post-merger EPS over here? 10.606. I have taken the third decimal also. No problem. You can keep it 61. No issues. 10.606. 6. Correct? 1,40,000 divided by 13,200 shares. How did we get 1,40,000? Earnings of acquirer plus earnings of target plus synergy. Synergy is 0. No synergy was the first question. No synergy in earnings. Clear? So now here if you notice the table, only here the amount is there. Here amount is not there in target. Post-merger EPS is not put in the target column. It is put, but it is put in a different way. Adjusted equivalent EPS or cash offer price. Cash offer price is not there. Here it is EPS only. Post-merger EPS into swap ratio. All those things are written, right? Now, next thing is not EPS. It is adjusted EPS. Now, understand this simple thing. I have one share. Okay, imagine I have one share in target company. Now, when I went to acquirer company, okay, I became part of acquirer company. I'll get the EPS of theirs, and their post-merger EPS is 10.606. What is that? 606, right? Yes, 10.606. Now, I had one share where? In target company. Now, when I go to acquiring company, I'll not get one share there. I'll get 0.4. That means of the 10.606, I have only this much. Are you getting my point? I cannot write post-merger EPS for them also as the 10.606. They will get 10.606 per share, but when they come here, they are getting only 0.4 share. So therefore, their equivalent EPS, if you see 10.606 into 0.4. So their equivalent EPS is only 4.24. Are you getting this? Now, these people, they are already shareholders, acquiring company. Now their post-merger EPS has gone to 10.606. Target company's shareholders came from there to here. There they had one share. Now they'll get 0.4 share. That means now if the 10.606, they'll be eligible for how much? Only 4.24. Per share, they'll get 4.24. So 4.24 is what they're getting. So whenever you calculate, you will be writing adjusted EPS for target. Acquiring company, you'll write directly post-merger EPS only. Now, acquiring company before, you have the question in your book, right? Before, what was their EPS? 10. Target company before, what was their EPS? 5. So if you see 10.606 minus 10, gain is 0.606 and 4.24 minus 5, loss is 0.76 per share. Clear? Sir, you told no, sir, if one person will always be at no profit, no loss, that is when we are calculating maximum and minimum. Here swap ratio was given in the question 0.4:1. So therefore, if you see one person is gaining, one person is losing per share. Multiply into number of shares 10,000. You got 6060 as the total gain. And multiply into 8,000. Now you're like, sir, here not 8,000, 3,200 shares. It is 8,000 shares only. Already this is brought down to the fractional part. Now both if you take into fractional part, you will go in the wrong direction. So 4.24 per share according to their original shares. Clear? So this will be 8,000 shares itself. That is the number of shares which target company had. So this all the things are given in the question. You got 6080. Can you see? It's actually this person's profit is this person's loss. That 6080 should be 6060 only. But rounding off difference. Okay, we have got 10.60, many other decimals, and here 4.24. I mean, this 10.606 only into 0.4. So again, here rounding off has happened. So therefore, can you see this person's gain is this person's loss? Why this has happened? There is no synergy, right? Their earnings, our earnings, both got merged. So therefore, if somebody is losing, somebody has to gain. Their earnings was there, our earnings was there, both got merged. Now it is our total earnings. If at all somebody is getting more now, automatically it has to go from somebody else's pocket. So therefore, when there is no synergy, gain of acquiring company will be the loss of target company. This is your point of verification, whether your table went in the right direction. Just your point, when you calculated this, imagine you got 2,000. Then you know that you have made some mistake. That is just a point of verification. Clear? This is the benefit to shareholders. Now remember this. No synergy in earnings. No synergy. I told you right that time. Maximum swap ratio when you are calculating, we are telling boss, I will stay happy with the current situation only. Whatever extra is there, I'll give it to you. Minimum swap ratio when you are calculating, we are telling boss, you be happy with what you are getting only. Whatever extra, we'll keep it. But if there is no synergy, what extra is there? If there is no synergy in earnings, there is no extra, right? So when there is no synergy in earnings, there is no need to calculate maximum swap ratio or minimum swap ratio. Now you are like, sir, There can be synergy in market value. There can 100% be synergy in market value. But our question, if you see, first question, we are going to compute in terms of earnings. In terms of earnings, we'll calculate all these points. In terms of earnings, when there is synergy, we'll calculate all these points. In terms of market value, when you calculate, maximum swap ratio, minimum swap ratio will be there. Are you getting this? There are two angles, from earnings point of view or from market capitalization or market value point of view. From earnings point of view, when you are calculating, there is no synergy. So if there is no synergy, there is no maximum swap ratio or minimum swap ratio. Whatever is the equitable swap ratio, that only will be the maximum and minimum. Win-win situation only will be there. No. Now see, no synergy in earnings. If you see over here, swap ratio based on EPS. EPS of target company is how much? 5. EPS of acquiring company is how much? 10. 0.5 is to 1. 0.5 is to 1. This is the swap ratio which is equitable. Equitable means what? Benefit to both. Now, maximum swap ratio and minimum swap ratio same as above, as there is no synergy. Because if there is no synergy, you will not have anything to add to anyone. So it will be the same. Now, 0.5 is to 1 is equitable swap ratio. Equitable swap ratio means what? Nobody is gaining also, nobody is losing also. That means if you take 0.5 is to 1 and calculate your benefit table, it should be same. There should not be a loss situation. Now, just for your understanding, here, post-merger EPS for 1,40,000 divided by, how many shares were there over there? 8,000 shares. So, swap ratio, if it is 0.5 is to 1, it will be 4,000 shares. So, this will be divided by 14,000 shares. 1,40,000 divided by 14,000 shares. This will be 10 rupees. Before also he was getting 10 rupees. This will be no gain, no loss. And this fellow was getting 5 rupees. He was getting how much? What was his EPS? 5 rupees. Okay, now 10 into 0.5. 10 into 0.5, if you do adjusted EPS is also 5 rupees. 5 minus 5 will become 0. Can you see how there will be no gain or loss if it is based on earnings and if it is based on equitable swap ratio? Maximum, minimum is different. Clear? This is our discussion when there is no synergy. If synergy is there, again things will be recalculated. Any doubt with this benefit table? So what you are doing, take the post-merger EPS. Post-merger EPS, how will you do? Post-merger earnings divided by post-merger number of shares. That time you will get the post-merger EPS. Put it only for acquirer. Put it only for acquirer. Take the post-merger EPS and multiply it into the swap ratio. You will get the adjusted EPS for target. Then pre-merger EPS will be given in the question. Take it and you will get the gain or loss. Multiply into number of shares. You will get the total gain or total loss of the shareholders. Now you see this table. Can you see that table? Actually makes sense when you have numbers in front. Any doubt with this one? Anyone? Offline, online? Anyone? Do you have any doubt? No. Now we have to repeat this process for the next situation when there is synergy, and then we have to see it also from the market value point of view. Yes, I want you to quickly write it. Don't go for neatness, just write as fast as possible. Less neat when practicing means more problems can be solved. In exam, just be presentable. Now that this benefit table will be same, numbers will keep changing. Done, guys? This is case 1. What is case 1? Case 1 is when there is no synergy in earnings, and when there is no synergy in earnings, we calculate the benefit to shareholders and we calculated the swap ratio, equitable swap ratio. Maximum minimum is not there because there is no synergy in earnings. Now, what was case 2? Case 2 is when there is synergy in earnings. Okay, but synergy was not given in the base question. Now we'll add the synergy to the question. Finish fast. Then we'll continue. Oh. I told you, no bear, no bull, only bear. Market opening only 1% less. 800 points already fall in Sensex. But when this war ends, you just see the way it will go up. Now it's running only because of emotion. Just because of people's emotion, that's it. One person heard news that Strait of Hormuz is closed. Over. People will start pulling out the money and then gone. Yes. Now, next case. What is the next case? When there is synergy in earnings. Now, synergy in earnings, I have given the number as 20,000. Okay. Synergy in earnings, 20,000, just a number. It can be anything. But obviously, this number has to come from the question. In some way or the other, it has to come from the question. Now, when I'm doing the benefit table again, number of shares are same, no, because swap ratio will not change because of synergy. Now, what happened? Earnings EAT of acquiring, EAT of target plus synergy should have been added. Plus synergy 20,000 divided by 13,200 shares. I think you should get 12.12. 1,60,000 divided by 13,200, 12.12. This is the post-merger EPS. Clear? Now for target, what you will do? You will not take post-merger EPS. You will take the adjusted EPS. So this becomes 12.12 into 0.4. That is 4.85. Now see this. Here this person is gaining 2.12. Here this person is losing 0.15. Correct? Now multiply into number of shares. Number of shares, what was the existing? That one you are going to multiply, not after the merger. Into 10,000, you got 21,200. Into 8,000, here you got 1,200 loss. Can you see verification point? 21,200 and 1,200 loss. If you see net 20,000, that is synergy. That is synergy. In the last question, here if you see the net, okay, now because of rounding off, you are not getting it. Here if you see the net, it is nil. Because when you are not getting anything extra, one person who is losing, another person should gain, right? Now, for example, if you have only one dosa kept and 4 people were eating it, and now one 5th person joined. Now, if at all that 5th person is gaining, the other 4 are losing, or somebody in that other 4 should lose. Correct? Now, imagine if you have 4 dosas and that new person is coming in, and when new person is coming, he is getting 2 more dosas with him. That time what happens now? Automatically, if somebody is losing overall per share, if somebody is losing, somebody should gain. But overall, if you see that gain, if you see, it will be 20,000. It will be 20,000. Now, tell me one thing. If full 20,000 should be sitting over here, if full 20,000 should be sitting over here for acquirer, that means we should offer what swap ratio? Minimum swap ratio. Minimum swap ratio. And if this full 20,000 should be sitting over here, then what swap ratio we should have offered? Maximum swap ratio. We have not offered both. We have not offered equitable swap ratio also. What we have offered? 0.4:1. We have offered, given in the question, 0.4:1. Did you understand this benefit table? Now, swap ratio we have to find out. First one, equitable swap ratio. What is the EPS of target company? 5. What is the EPS of acquiring company? 10. So 5 divided by 10, how much you are getting? 0.5:1. Clear? Now, tell me one thing. If I have to calculate maximum swap ratio with formula, The table form presentation also we have to do, but if I have to do it with formula, tell me in maximum swap ratio, benefit goes to whom? Benefit goes to whom? Target company. Full benefit goes to target company. That means target company's EPS will change. Now target company, what is their earnings? See the question and tell me, is it 40,000? Target company's earnings is 40,000. But if full benefit should be given to them, now this 20,000 also will go to target and it will get divided by their shares. How much is their shares? 8,000 shares. So now how much is their EPS? 7.5. Earlier what was their EPS? 5. So now full benefit, if you give them, their EPS will become 7.5. But our EPS will remain 10 only, because we are happy with what we are getting earlier. So can you see how formula works? 7.5 divided by 10, 0.75 is to 1. Did you see formula method that you are going to do? Okay, if it is not formula, you have to prepare table. Now see here, 40,000 plus 20,000 divided by 8,000 shares. Now if it is minimum swap ratio, then I am keeping all the benefit for me. I am giving him bare minimum. So now if I see over here, my earnings was 1 lakh. Plus I will keep the synergy of 20,000. So divided by my number of shares were 10,000 shares. 12. That means my EPS should be 12 and his EPS will remain 5. In the earlier case, my EPS will remain 10 and his EPS will become 7.5. So now the formula, if you see, 5 divided by 12, 0.417 is to 1. 5 divided by 12, 0.417 is to 1. Is this clear? Now, it is like a homework for you guys. If you want to check, sir, maximum swap ratio, if I prepare benefit table, how it will look. Minimum swap ratio, if I prepare benefit table, how it will look, you can do it. Now, if you want, I'll just show it over here itself. I'm not going to solve it, but I'll show it to you. You can try it at home again. Now, maximum swap ratio is, we found out, it was 0.75 is to 1. 0.75 means 8,000 shares were there. Correct? Huh? 8,000 shares into 0.75. That means how many shares we are going to issue? 6,000 shares. Now take this 1,60,000 divided by 16,000 shares. 10 rupees. Can you see, because of maximum swap ratio, this fellow's EPS remained at 10 only. So this will become 10, this will become 10, this will become 0. No benefit for this person. But if you see target company, 10 rupees into 0.75, 7.5, and this EPS was 5, that makes it 2.5. Net benefit is 2.5 into 8,000 shares. Can you see how full synergy went to target company? This is what we were discussing. Now, if you prepare benefit table, it should look like that. Now, minimum also, I'll do it over there only. 0.417, right? So, 8,000 shares into 0.417. 8,000 into 0.417. Are you getting 3,336 shares? Minimum swap ratio, 3,336 shares only I would have given. Now, if it is 3,336 shares, this denominator will be 13,336 shares. So now if you take 1,60,000 divided by 13,336, are you getting 11.99, which is 12? Can you see this became 12? This is 10, 2 rupees, 2 into 10,000, 20,000, full 20,000 will come and sit over here. That 12, adjusted EPS, 12 into 0.417. 12 into 0.417 will be 5. This will be 5. 5 minus 5, 0. No benefit will be given. Can you see how the benefit table will fluctuate and will align with the logic what we were discussing? Okay. Now, benefit table is prepared based on what? The swap ratio of 0.4 is to 1. Then you are calculating what is the equitable swap ratio? 0.5 is to 1. What is the maximum swap ratio? 0.75 is to 1, and minimum swap ratio is 0.417 is to 1. Now, formula method, just remember one thing. You already have existing EPS given in the question. If it is maximum swap ratio, EPS of target company will change. To their earnings, add the synergy and then calculate EPS. So their earnings was 40,000. You added the synergy of 20,000 and then you calculated EPS. Earlier what you did, 40,000 divided by 8,000, you told EPS is 5. Now if you are calculating minimum swap ratio, target will remain same, acquirer will change. So what you do to acquirer's earnings, add the synergy and calculate the new EPS. So acquirer's earnings change to 12. Is this clear? Are you clear with this? Now the same maximum and minimum swap ratios we also have to learn with that table method which is given, because it's again your what to say, identification of the question in the exam. Okay, if the entire focus is on calculating this only, then you can't just do this 2-line formula and finish the question. No, imagine 7 marks. Then you have to present it in a better way. That's all. Okay, so please write this. Then I'll show you the tabular format also. Target, yes. Online students, please keep posting your doubts. If you have any doubts. And please go and spend some time on just revising, okay? Because in every chapter of AFM, no, it will be divided into 2 parts. Now today you had minimal writing. Now only you started writing. The concept discussion will be first part. After that, when we go to problem solving, there will be some 70-80 problems which will be just going on discussing. Correct? So the concept part you have to go and revise. Then problem solving will become easier. Done, guys. CA final, CA final. So full top speed. Don't write like how you do watching, but you know, when you get these manual ledgers and manual bills and all, the way you watch, bill will be turning. Sometimes we don't even look at the number. One tick. You know, whatever discrepancies you find in those watching, ultimately at the final stage, partners will do the adjustment. Simply for working paper purpose, you are preparing that. Done, no? Yes. Now, same maximum swap ratio and minimum swap ratio, we have to learn with the help of the table as well. This is the table. Okay. Now, see how this table works. Now we are talking about earnings. No? So, we'll not worry about market cap. Market cap tomorrow we'll see, because I think we won't have time to do the case 3 and case 4. It's already 9:26. So, post-merger earnings. Post-merger earnings. Okay. You know how to calculate post-merger earnings. Earnings of acquirer, earning of target and the synergy. Post-merger earnings, okay, divided by required post-merger EPS. How will you get the required post-merger EPS? Depends on whether you're calculating maximum or minimum. Okay, required post-merger EPS, you divide that. That time you'll get the total number of shares. Basically, we are coming in reverse order. Total earnings divided by the shares, this much is the divided by the EPS, this much is the number of shares. If out of this much number of shares, acquirer already is holding some shares, balance you give to the target company. Are you getting this? This is like a reverse calculation presentation table which ICA follows. So what we are doing till now, what we did, we calculated benefit and all that from number of shares point of view went to the total. No, here what's happening? We know the total earnings. Earnings divided by number of shares will give you EPS. We don't want that because we are trying to find the number of shares itself. So earnings divided by EPS. EPS we can fix because we know benefit should go to whom. So when we fix the EPS, divide by the EPS, you'll get the number of shares. This number of shares, it is after merger. If it is after merger, this much number of shares. Before merger, this much number of shares. That means differential number of shares can be issued to the target company. With that, you'll get the maximum swap ratio or the minimum swap ratio. This is a reverse calculation methodology. Otherwise, the formula method is there. Now, you can't tell I'll learn one method and go to the exam because you don't know which method you'll have to apply over there. If presentation has to be neat, you have to do this only. And in fact, this is the better methodology. Formula directly if you're doing, if the attention is fully on that, and if you write in 2 lines, they will not give you 7 marks. Clear? So now, and I hope you have seen recently some negative marking and all they're doing. Okay, ignore. First we have to study, no. Then the negative mark. Students, no, who are writing the exam, okay, who are attending class for Jan attempt and all, they are asking, sir, what to do with this negative? I'm like, first you study, no. If you write only, no negative marking. Otherwise, 0, no negative marking. Yes. So now, see this table. I'll give you time to write the table. Okay, focus fully on only the maximum swap ratio. Don't focus on the minimum part. Post-merger earnings. There is no confusion. Earnings of acquirer was 1 lakh. Earnings of target was 40,000. Synergy was 20,000. So post-merger is how much? 1 lakh 60,000. Maximum swap ratio means benefit should be given to whom? Target. Maximum swap ratio means benefit should be given to target. That means acquirer will be getting the same. That means EPS will remain at 10. EPS will remain at 10 only. Okay, benefit, how target will get the benefit? Because target will be getting, number of shares will be different. That's how target, we have already seen that in the benefit table. So now 10, when you divide this, you get 16,000 shares. That means post-merger, total shares are 16,000. Pre-merger, total shares were 10,000. That means how much can be issued? 6,000. 6,000 was the shares that you're going to issue. But how many shares were there over there? 8,000. 6 divided by 8. Can you see you're getting that 0.75 is to 1? Same 0.75 is to 1 you're getting. Clear? Now, if I do the same table can be used for minimum swap ratio also. Minimum swap ratio, post-merger earnings is how much? 1 lakh plus 40 plus 20. 1 lakh 60,000. Clear? Required post-merger EPS. Now, benefit should go to whom? Benefit should go to whom? Should go to acquirer. Benefit should go to acquirer. So, acquirer's EPS cannot sit at 10 rupees. Acquirer's EPS has to rise up. And acquirer's earnings was 1 lakh. And plus the synergy will go to acquirer. Divided by acquirer's number of shares. So now acquirer's EPS should go to 12 rupees. If 12 rupees only, acquirer will be benefiting from that. So 1,60,000 divided by 12 rupees, you're getting 13,333 shares. Before merger, the number of shares were 10,000. That means how many shares can be given to target? 3,333 shares. So 3,333 divided by 8,000, you will get the same 0.417:1. Is there a rounding off issue? No, 0.417:1. Did you understand how it is? How it is done? What we are doing in formula, no, that only simpler actually. Here what we are doing, taking the earnings, dividing by the EPS, you'll get number of shares. Oh, this much already issued. Balance you issued to target company. How much you issued to target company when you get to know how much you issued, how much was there. That is the swap ratio. Number of shares issued for number of shares which were there. Swap ratio, 5 shares for 6 shares. So therefore, you will get the swap ratio this way also. You need to know both the methods. There is, no compromise on that. You need to know both the methods. Now, one more note I have just written. Maximum swap ratio, no gain or loss for shareholders of acquiring company. Minimum swap ratio, no gain or loss for shareholders of target company. Clear? That is one thing that you have to remember. I think when we just did roughly and we saw that all synergy was going into target, and in minimum swap ratio, all synergy was going into acquirer. Yes, please write this. This tabular format also you need. What you can do is, wait, you can save some time when you're writing. You can do one thing, tabular format you write, then you make one column maximum swap ratio, minimum swap ratio, and fill the numbers like that. Otherwise, you'll have to rewrite the information, no? Because in this entire table, what is changing is EPS, and because of that, number of shares are changing. make one column maximum swap ratio, make one column minimum swap ratio, and enter the numbers. That time you should reach these ratios 0.75:1 and 0.417:1. Yes, is it done? You're making the 2-column format, no? So can I scroll till here? You have written no both. Okay. If I scroll till there, you can write this note also. So that should be it for the day, guys. See you tomorrow. Yes, good morning. Welcome back to AFM. Second day, day 2, right? So did you go and revise yesterday? Yes. So let's quickly revise whatever we have been doing yesterday. The basics of FM will not revise. That you have to go through once. Okay, all that present value, how to calculate and all those stuff. Mergers and acquisition we started, and directly what we have to understand, mergers and acquisition is actually a pre-deal analysis, not a post-merge. I mean, what is a post-merger? What we are going to do, that is going to be directly dealt with in FR. Here we are doing pre-merger. Pre-merger, the analysis is going to happen. And swap ratio, the first thing that we discussed is swap ratio. Swap ratio is what? The number of shares issued by the acquiring company to the target company, and it has to be read, if it is written like this, 2 for 3, that means 2 shares for every 3 shares held. Okay, then we have synergy. Synergy means what? Synergy means what? Extra, something extra. Correct? It can be in earnings also, it can be in market value also. So basically the benefit that is derived from this merger is called as synergy. Correct? Now post-merger EPS we have to calculate. Now if it is a share offer, post-merger EPS, if it is share offer, what will you do? Earnings of acquirer, earnings of target you will add, and the synergy in earnings you will add, and divided by number of shares of acquirer plus number of shares of target into swap ratio. That will give you the post-merger EPS if it is a share offer. If it is a cash offer, what will you do? Earnings of acquirer, earnings of target plus synergy in earnings divided by number of shares of acquirer. Done. That's it. Minus. Yes. After tax interest rate or opportunity cost into the cash paid. Okay, that you have to subtract from the earnings. Now post-merger MPS. MPS is just going to be EPS into P ratio. Correct? Now you can have the small formula EPS into P ratio, but post-merger EPS into post-merger P ratio. Now post-merger P ratio, what will you do? If nothing is mentioned in the question, the post-merger P ratio will always be the P ratio of acquirer only if nothing is mentioned in the question. Clear? Otherwise you can take the expanded formula. What is the expanded formula? Calculating full market value and dividing by the number of shares. How will you calculate the market value? P ratio into whatever you used as earnings in the EPS formula. That is earnings of acquirer, earnings of target plus synergy. If it is cash offer, you will subtract that. Opportunity cost also you will subtract. Clear? Then synergy, we have seen that table. We'll discuss that table once again. And then whenever there is benefit, okay, they can ask it in different forms. But whenever you have to calculate benefit to the shareholder, what we will do, we'll have to prepare this table. Now, in the material which I have given, solutions are already there. Now, but if you notice, ICA, right, in study material, they never follow consistency in solution. Correct? One place they will do one thing, they'll present in different ways. Now we'll try to keep it uniform, because when answer you'll get, but if you're following 5 methods for 5 different questions, then you will not be confident about getting that answer for the 6th time. So this table will always be used. Whenever that benefit requirement is there, this table will be used. What we are doing basically, benefit means what? Post-merger and pre-merger comparison. That's it. Post-merger EPS or post-merger MPS minus pre-merger EPS or pre-merger MPS. But when you're taking the EPS or MPS for target, you're not going to take that existing EPS or MPS. You will take equivalent or adjusted. What you will do, you will take that post-merger and multiply it with the swap ratio, whatever was there. Because if they had 1 share over there, they are not getting exact 1 share. So the portion only they will get as earnings. So that you will compare and multiply into the number of shares, you will get the gain or loss. Clear? I think for 2 questions we had done that yesterday in the example portion. Now, swap ratio computation. We have 3 types of swap ratios. One is equitable swap ratio. Equitable swap ratio means what? win-win situation based on EPS it is. EPS of target company divided by EPS of acquirer company. If it is based on MPS, MPS of target company divided by MPS of acquirer company. Always the factor of target company will be in the numerator and the factor of acquiring company will be in the denominator. Unless there are negative ratios. If there is NPA, debt equity ratio and all, that time it is negative ratio. That time this formula will get inversed. It will be relevant factor of acquirer divided by relevant factor of target, which you should remember, which is very rare event. Okay. Now, after that we saw there is something called as maximum swap ratio and minimum swap ratio. What is maximum swap ratio? All the benefit will be given to target. So the EPS will be same. EPS will be maintained as same for acquirer. Acquirer it will be same. And if it is minimum swap ratio, all the benefit will be given to acquirer itself. Acquirer will keep all the benefit. So the target company will have a situation of no benefit, no loss. Clear? That is maximum swap ratio and minimum swap ratio. And for that we had a formula. So what will you do if it is based on EPS? Relevant EPS, but it is adjusted EPS of target, because all the benefit is given to target, and EPS of acquirer will be denominator. But if it is minimum swap ratio, EPS of target will be as it is, but EPS of acquirer will be adjusted. That is if you are using the formula. Otherwise you are going to use table. In table when you are using the, just remember you are using the table and you are doing reverse working. Reverse working means what? You are taking the starting point as post merger earnings. Total earnings you do. Earnings divided by number of shares we used to get the EPS. Earnings divided by EPS. Now this EPS has to be set. EPS has to be set. How will you set the EPS? If it is maximum swap ratio, then all the benefit is given to target. So the post-merger EPS will be same as the pre-merger EPS, because acquirer will not get any extra benefit. So you will divide it by the EPS. If it is minimum swap ratio, then you have to calculate all the benefit will be given to whom? Acquirer only. So acquirer will not take his existing EPS. Acquirer will want extra EPS. So you'll add the synergy and then calculate the EPS. Okay, that time when you divide by EPS, you'll get number of shares. These number of shares are after merger. So after merger, this many number of shares. Before merger, this many number of shares. That means the differential is the number of shares that is issued to target. And using that shares, you can get the swap ratio. This table format also you should remember, and also the formula you should remember. This is from earnings point of view I have told. If it is from market price point of view, same thing. Instead of dividing by earnings, you will be dividing by market price. Entire formula will be just changed. Instead of EPS, you'll put market price per share. Clear? Now that is it, and we were solving examples, right? Now before that, let's look at the table once again. Remember the table we had discussed. Earnings of acquirer, earnings of target, add the synergy. You will get the earnings of acquirer and target together. Divide by the number of shares after merger. Okay, you will get the EPS after merger. Multiply into P ratio, multiply into number of shares, you will get the market value. This is the way to calculate market value. But if synergy in market value is already given, then you can't calculate this way. What you will do, you will calculate individual market values, and then you will add the synergy in market value. That time you will get the market value. Clear? Usual route is this, but if synergy is given, then you are going to take this route. Is this clear? Now, then we took this comprehensive example. Let's quickly revise, because same data will be used for today's other two questions also. Earnings after tax was 1,40,000. When you divide by 10,000 shares, EPS is 10 and here EPS is 5. P ratio is 10 times and here it is 8 times. So 10 into 10 makes it 100. Here 5 into 8 makes it 40. This is the data that we have. Using that data and also the data that the swap ratio is 0.4:1. Compute in terms of earnings. No synergy in earnings, and synergy in earnings is there. And synergy, I think we had taken the synergy yesterday as 20,000. Clear? Next, we have to calculate in terms of market value. In terms of market value, when there is share offer, what will happen? When there is cash offer, what will happen? We will have to see that. Clear? Now, and all these four cases, one case, two case, third one and fourth one, we have already seen first and second. But what we are supposed to calculate? Benefit table, benefit to shareholders. And then based on EPS, maximum swap ratio and minimum swap. You were there yesterday? But what about yesterday's class? Okay. No, but Did they give you access to yesterday's class or anything like that? Because some of the basics we have already discussed yesterday. Yeah, just watch that. Because all this we are discussing formula, right? Yesterday we had studied that in detail. Fine, but you'll be able to catch up. It's a simple chapter only. Now, shares issued, see over here, the swap ratio was 0.4. Number of shares was 8,000. 8,000 into 0.4, that means 3,200 shares are issued. Clear? Now, if the synergy, no synergy is there in earnings, what will happen? Whatever was there earlier, that only will be there. Now, post-merger EPS will be, how did we get this 1,40,000? 1 lakh of acquirer and 40,000 of target divided by, how did we get this 13,200? 10,000 shares of acquirer plus 8,000 into 0.4 gave us 3,200. This is the post-merger EPS. But we can't take that only and put it for target, because target is not getting 1 share for 1 share. He is getting only 0.4 share. So 10.0606 into 0.4 will give you 4.24. Clear? Now, pre-merger EPS was 10 and 5 given in the question only. Subtract this, you will get this is the gain. Subtract this, you will get this is the loss per share. Multiply into their existing shares, not the one which is allotted to them now. Existing shares, that time you will get this value. Because there is no synergy. My earnings, your earnings got merged. Now if somebody is losing, somebody has to gain. Clear? If there is 6060 here there should be equivalent loss. You are getting 6080 because of all this rounding offs which we have done over here. Clear? Now, swap ratio based on EPS. EPS of target was 5, EPS of acquirer was 10. Divide, you got 0.5 is 2. 0.5 for 1 share. Now, when there is no synergy, okay, there cannot be maximum or minimum. There cannot be, because maximum minimum concept only is what? If there is gain, you keep it or I keep it. Correct? So if there is no synergy, there is no maximum swap ratio or minimum swap ratio to be computed. This 0.5 for 1 share is there, no? That only is the maximum and minimum. Clear? That's why we didn't have to prepare one more table to calculate that maximum and minimum. Next we saw synergy in earnings is 20,000. Now, already acquirer had 1 lakh, target had 40,000, synergy is 20,000. So our total earnings right now is 1,60,000. Divided by how many shares? 10,000 shares of acquirer plus 3,200 shares issued. You got 12.12. Clear? This is the post-merger EPS. Can you take 12.12 directly for target? No, you have to take adjusted or equivalent. So multiply into 0.4, you get 4.85. Clear? And this is the pre-merger EPS minus. Now if you see, this fellow is having gain, this fellow is having loss. Now when you multiply, you got 21,200 here and you got 1,200 loss. Can you see the net of this is 20,000? Why 20,000? Because 20,000 was the synergy there. So total synergy is 20,000. So therefore, one person is gaining little more than the synergy. So that means other person has to lose. When there was no synergy, if one person gains 1 rupee also, other person will lose that 1 rupee. But here, if at all there is synergy, and here if you were getting this number as 15,000 without even doing any calculation, you should know that other side the number will be 5,000. Because total synergy is 20,000. If one person is gaining 15,000, other person is gaining, okay, 10 extra there, other person is gaining 5,000. Clear? Now, if at all here I would get the number as 24,000, automatically you should know that the other company is losing 4,000. Is this clear? This is just your point of verification, okay? When you finish the table, you should know that just to check if you have done any clerical mistakes. In exam, calculator will not support us sometimes. It will not listen to us. Correct? No. We will be doing correctly only, but calculator when we press, it will be giving wrong numbers. So these are some places. Everywhere you can't verify like this. Sometimes your calculator has to support you. Now, swap ratio, we know already 0.5:1. Now this maximum swap ratio, we'll discuss this formula again. We did it towards the end of the class, right? Now, maximum means what? All benefit is given to target. So, target's EPS will not be 5, which was given in the question. Target's EPS will be 40,000, which they had, plus synergy will go to them, 20,000 divided by 8,000 shares, which they had. So, now it became 7.5, 0.75:1. Minimum swap ratio means all the benefit will be kept with acquirer only. Acquirer had earnings of 1 lakh. Synergy also give it to them. So now it became 1,20,000 divided by their existing shares. You get you get 12, which is 0.417 for 1 share. Clear? Other route was what? Usually, how do we calculate EPS? Earnings divided by number of shares. Now, what we can do, earnings divided by EPS will give you number of shares, because EPS, you know what you have to fix. So now here, if you're following the tabular format, just remember this post-merger earnings was 1,60,000 because of acquirer, target and synergy when you added. And if it is maximum swap ratio, the acquirer company will not have any benefit or loss. So their EPS will remain same as before 10. When you divide that, you got 1,60,000 shares. If 1,60,000 shares, and earlier there were only 1 lakh shares, that means 60,000. Sorry, my bad. 16,000 shares. So 6,000 shares are issued. So 6,000 divided by 8,000, that means the ratio was 0.75 for 1 share. Same thing you get in the formula also, but you have to decide when to use what. Now, if format is for minimum swap ratio, earnings are same, but what will be the post-merger EPS? Post-merger EPS has to go up because the acquirer has to gain, and it is 12. Directly I have written 12 because in the formula stage we have discussed it. That is basically 1 lakh plus 20,000 divided by their number of shares, 10,000. So 12 is their EPS. Divided, you got 13,333 shares. Right now there are only 10,000 shares. That means 3,333 shares can be issued. Clear? And again, you will get the same ratio. And then we also wrote this note. Maximum swap ratio, no gain or loss for the shareholders of acquirer company. And minimum swap ratio, no gain or loss for the shareholders of target company. Clear? The third one and fourth one we had not done. What is the third case? Now we have to calculate in terms of market value. In terms of market value to calculate, they asked two things. When there is a share offer, when there is a cash offer. Now, in terms of market value, share offer. 10.606. Do you agree that that is the EPS? We just calculated 10.606. How did we get 10.606? Earnings per share was 1 lakh plus 40,000 divided by 13,200 shares. Correct? Now you're like, sir, what about that synergy in earnings? That is over. Individual case it is. Okay, individual case. Now we are going back to the original case. There is no synergy. So 10.606 is the post-merger EPS. They did not tell us anything about post-merger P ratio. So P of acquirer only will be considered as P after the merger as well. So this, when you multiply, you will get 106.06 as your market price. Can I take this as the market price for target also? No, I should take adjusted market price. So 106.06 into 0.4 will give you 42.42. Clear? Now, pre-merger their EPS was 100. Pre-merger their MPS was 100 and MPS was 40 here. When you do that, you will get the gain. Both the parties are gaining. When you multiply with the number of shares, you will get their total gain. You got some random number. Can you do the verification over here for this? You got some random numbers. No. There we saw, oh, no synergy. That means it should match. It should be 0. Synergy, that means it should come to 20,000. Here the 60,600 and 19,360. Okay, you are getting something close to 80,000. Correct? Now this should be the synergy in market value. This should be the synergy in market value. Synergy in market value was not given to us directly, but it is there. Synergy in market value is not given to us directly. Yesterday I told you, synergy in market value can happen because of two cases. One, earnings increases, obviously market value will increase. Second, earnings, in this case, earnings has not increased at all, but still there will be synergy. How? The earnings of target will now get multiplied with the P of acquirer. Nothing but earnings of target will now get the reputation benefit of acquirer. Now, if you go back into our example, okay, 40,000 was the earnings of acquirer. Earnings of target. But the P of target was only 8 times. So this 40,000 would get multiplied into 8 times when they were in target company. Moment they got merged, their P changed to 10 times. So now this 40,000 will get multiplied into 10 times. That means extra 2 times benefit. 40,000 into 2. Can you see the synergy being 80,000? Can you see how that 80,000 came over there? Again, 40,000 earnings, total earnings into 8 times. That means the market value of this company is 3,20,000. But when their company got merged, now their 40,000 will get a PE multiple of 10. So 40,000 into 10 will make it 4 lakhs. Can you see their value has gone up? So that means 80,000 is the synergy in market value. Clear? Only because of two cases you can have synergy in market value, unless and otherwise it's given in the question. Two cases. Earnings increase, obviously there will be synergy in market value. Otherwise, earnings does not increase. But P ratio is higher for the acquiring company, so automatically there will be a synergy. So can you see that 40,000 into 10 minus 8, that is going to give you 80,000 of synergy. Everyone clear with the synergy of 80,000? Now can you see in our case, when we are solving, are you getting this total to be 80,000 only? Can you see 80,000? Yes. Now, swap ratio. They said equitable swap ratio. Equitable swap ratio based on what now? No. Now it is based on MPS. This entire third case is solved based on what? Market values only. Based on MPS. When you are calculating based on MPS, pre-merger it was 40. Post-merger it is 100. So therefore 40 divided by 100. This is going to be 0.4 for every one share. So can you see 0.4 for one share? Now, maximum swap ratio and minimum swap ratio you have to calculate. Again, the formula remains same. Target company divided by acquiring company. Target company, what was their market price per share? It was 40. Can you see over here? It was 40. Now, all the benefits should be given to whom? All the benefits should be given to target company. Target company before 4 lakh into 8, their value of the company was 3 lakh 20,000. Now that synergy of 80,000 also will give it to them only. 80,000 divided by number of shares. Now their price, market price should be at least 50. So now 50 divided by 100, you get maximum swap ratio of 0.5:1. Now if it is minimum swap ratio, all the benefits should be kept with whom? Acquiring company. Now acquiring company right now, what was their their earnings? 1 lakh. 1 lakh into 10. That means 10 times. Now their market value became 10 lakhs. And they will keep that synergy also of 80,000 divided by 10,000 shares gives them 108. Can you see? You will get 0.37:1. Obviously, the swap ratios will not be same when you calculate in terms of earnings and when you calculate in terms of market value. Clear? And the benefit or loss table also will not be same when you are calculating from earnings perspective or when you are calculating from market value perspective. Is this clear now? Now, same thing we have to do with the table. What will you do with the table? What will you do with the table? What were you doing with the table? You are taking the earnings and dividing it by EPS, getting the number of shares. Now you can't take earnings. You will take the market value divided by market price. You should get the number of shares. Then the differential you will get. Clear? Now if you see post-merger market cap, earnings is 1,40,000, 1 lakh of acquirer, 40,000 of target into P multiple of 10. So post-merger market value is 14 lakhs divided by market price per share. If it is maximum swap ratio, the acquiring company will have no benefit, no loss. So their market price will be same as before. If it is same as before, their market price was 100. Divide, you got 14,000 shares. Earlier, how many shares were there in acquirer? 10,000 shares. 4,000 shares will be issued. For how many shares you are issuing 4,000 shares? For 8,000 shares. Can you see you are getting 0.5 for one share? And that only we got with the formula as well. Now, if you are seeing minimum swap ratio, earnings are going to be same. So market value is going to remain same. But benefit is to be kept with whom now? Acquirer. Acquirer, if he is going to keep benefit, you know their earlier market value was 10 lakhs. To that you are going to add the synergy of 80,000 divided by the number of shares. You will get 108. Divide by 108, you got 12,962. Decimals I have rounded off. 12,962 shares. Clear? Earlier 10,000 shares. So that means you are going to issue 2,962 shares. You are issuing 2,962 shares for how many shares? 8,000 shares. So can you see 0.37 for one share? You will get the same thing with the formula. You will get the same thing with the table as well. But you just have to decide based on the question which one you are going to use. Clear? Yes. I think quickly you can write this. When is your attempt? Jan 28. Still there, no time, right? Other courses and all, if someone tells their exam is in Jan 28, they'll be like, oh, that's so far away. But in CA Final, Jan 28 seems very nearby, right? I'm telling you to put pressure on the September 26 7 people. There are September 27 people. You are September 27, right? Sorry, September 26. So you just joined articleship then. That 6 months study period is. Little pressure is good when studying, no? Whoever came yesterday are there in class, right? We have an extra person online. So I was thinking, did someone go from offline to online? Did everybody revise yesterday? Today is what? Tuesday, right? Sunday we'll have a test, okay? Merges. Not for too long, maybe like half an hour. One or two questions. But finding questions for test is also difficult for me. Because all articles and PYPs, if it's there in material, it will be like leak paper, no? So we have to go to our brother, ChatGPT. That's what I say is doing. We discussed no yesterday. Today morning, someone sent one of my old students sent a message asking, "Sir, which paper do you think will be difficult in May 2026?" What do I tell? Because last time audit was difficult. This time AFM was difficult. So they're trying to do some prediction. Next time will FR be difficult? FR usually doesn't come difficult. FR comes lengthy. FR comes in such a way that they put the food on the plate, but you should not be able to eat it. FR lengthy paper is like going to a function and not eating food, even though they are serving food. Yes, can we continue? Can I scroll down for the table? I think till here everyone finished. How many colors are there? Three. In finals also, students use multiple color pens. Better to understand in future. But I think in finals they don't use Whitener and all no, in their notes. These colors. For men, the colors are very few. For one girl is there. We should ask her. For girls, colors are many, right? There are many different types of colors, right? You don't relate to that. For guys, it's very simple. Blue, green, yellow, red. In blue, there will be many blues for girls. Other day, someone told magenta. I was like, when they showed it, for me, it was like brown or red. Done. This happened when I was studying for CA Inter. Okay, we used to go to one library, and that library was for namesake government library, but only CA students used to go there. Like 98% crowd was CA students, 2% crowd was these people who are studying for this UPSC. 98% was CA students only. So there, once I was using these highlighters. We use highlighters. Our theory books will be full of those highlighted. Last, when we are revising, everything will be highlighted only, because we don't know what everything is important. So I was using this yellow and blue and green highlighters. Okay. So one girl came and she asked, "Can you give me fluorescent highlighter?" I'm hearing that word for the first time in my life. I didn't know only there was something called as fluorescent. Okay. Now girl is asking, right? Impression should not be spoiled. So I am like, you know what to do, how to tell, I don't know fluorescent. So then I asked what, she said again, give me fluorescent highlighter. Now I had 3, yellow, blue and green. All 3 I held in the hand like this. Like, I asked only fluorescent, and she took fluorescent and she went. That day I understood that is fluorescent highlighter. Yellow. Next, when I went to the stationery shop next time, now I knew a new word, right? I had to flex it, no? So I went to the stationery shop, uncle. I am buying stationery from that shop like from childhood. It's near my house only. So I know that person. I told uncle on the fluorescent highlighter. He's like, what? I said fluorescent highlighter. Uncle didn't understand. Then I told uncle one yellow highlighter. He's like, yellow? Ah. Then he removed and he gave. That time I felt very good. Uncle, being in that business, still didn't know fluorescent. Women, you have to understand them. Correct? No? I'm asking him because he's married. The end of this guy. ಅವನು ನಂಬಲೇ ಇಲ್ಲ ನೀನಂತ. What man? That fellow cannot be married, is it? Why you turned with this fellow? No chance. Oh, again there is a typo, right? Minimum ratio. Yes, can we continue? One more case we have. What is that one more case? If there is a cash offer. If there is a cash offer, we need extra one more information. What is that information? If it is cash offer, how much cash you paid? Now you know it is 0.4 for one share and all. We had the exchange ratio given. Now, if it is cash offer, we are taking that example as 45 rupees per share. How much is the cash offer? 45 rupees per share we are going to give. That means, how many shares were there in the target company? 8,000 shares into rupees 45. 8,000 shares into 45 gives you what? Today I forgot to get my calculator. What is the answer? 3.6 lakhs. So 3.6 lakhs is what you're paying. Now suddenly when you see this, you should remember one thing. If you had gone from earning side, no, you have to calculate opportunity cost. But if you are going from market value side, you don't have to calculate opportunity cost. What you will calculate? Directly cash paid, full amount will be subtracted when you are calculating market value. Now, benefit table, post merger MPS 104. How are you going to get 104? See, I have done it over here. 1 lakh plus 40,000. There is no synergy. We go back to the base question. 1 lakh plus 40,000 into 10. 10 is what? 10 is our P ratio. This was the market value. This was the market value. Market value will reduce whenever cash is paid because cash is an asset. Asset reduces. So now what happens? 8,000 shares into 45. That is reduced. That time you will get. Why do we need simplified? I think 10 lakh 40,000. Huh? 10 lakh 40,000 divided by 10,000 shares. That means your post merger MPS is 104. If at all I had done post merger EPS, if the earning side was asked, then I would not do 8,000 into 45. I would do 8,000 into 45 to get the value into opportunity cost percentage. That should be given in the question. Okay, that percentage when I multiply, that will be subtracted from earnings. Clear? It is basically like from the market value, asset is subtracted. Okay, because asset is going down. And from the earnings point of view, the expense is subtracted. Clear? Divided by 10,000 shares, you get 104 as the post-merger MPS. Can I take 104 only for the other side also? No. What should I do? I should not take any percentage. Before I used to do 104 into 40%. Correct? Here there is no swap ratio only. For that person, what we are going to do? Cash paid. What is the cash paid? 45. That person is not coming and becoming shareholder over here to compare his post-merger MPS with pre-merger MPS. That person is taking money and going. When he's taking money and going, he will compare that money taken with what? With this pre-merger MPS. Market price was 40. I sold in the market. I sold the shares in the market at 45. 5 rupees profit. Are you getting my point? I mean, that cannot happen these days. But just example. Okay, these days we'll be selling at loss only. Okay, stop loss will be hitting. Okay, so but yesterday Trump gave some statement. So they have paused for a few days. So that impact we have to see today. What will happen? Huh? Impact will be good, I feel, no? Because and gift nifty has gone up. Hope. Indian stock market person is sitting with hope. Yes, cash price 45. Pre-merger MPS is 40. So they have made 5 rupees per share as the benefit. So basically his 40 rupees share, he sold it and he got 45 rupees cash. Clear? Now, why we are not writing post-merger MPS for target company? For target company, there is no post-merger MPS. Post-merger, he is not the shareholder only. Post-merger is not the shareholder itself. So there is no concept called as post-merger MPS. Directly you will write cash price or cash paid. So 45, here you are getting 4 rupees gain, here you are getting 5 rupees gain. Multiply, can you see 40 you got? This, it need not be 40, it can be anything, but this should total up to 80,000. It should total up to 80,000. Now you're like, sir, wait. That fellow is not coming here. No. How still that synergy is there? That fellow is not coming here. But that fellow's earnings is coming here. That fellow's earnings comes and sits with us. And that now gets multiplied into 8. Into 10 when it was getting multiplied into 8. So there is a post-merger synergy for whom? The shareholders. Who are the shareholders left? Only acquiring company. Clear? So this should be the total gain or loss. Post-merger MPS we already calculated. Now, what about swap ratio? That entire system of swap ratio, maximum, minimum, nothing to be computed because we don't have itself. I just wanted you to know from the other angle. So I added one more what if question here. If opportunity cost rate was 10%. Okay, if opportunity cost is given as 10%, then post-merger EPS will be 1 lakh plus 40,000 and whatever cash you have paid into 10%. Divided by 10,000 shares, 10.4. It should be 10.4, no, because MPS was 104. It should be 10.4, but in case earnings side, if they would have asked the question, you would have done like this. Post-merger MPS is 10.4 into 10, you will get 104. Swap ratio not applicable. Okay, but there is something that is applicable. Maximum cash offer. What is that? Swap ratio is not there. Maximum, minimum swap ratio is not there. But max to max, how much can I pay that person? Now I have decided to pay 45 per share. No. Now maximum how much will I pay? Now when I'm telling maximum, how much am I going to pay that person? That means whatever that 80,000 gain came, I should give it to that person only. Correct? So 80,000 gain also should go to that person. If it is minimum swap ratio, that 80,000 gain will be kept with me. So the concept is same, but it's not called, sorry, not minimum swap ratio, minimum cash price. Concept is same, but the calculation is slightly different. Okay, so here what you're going to do, 40 rupees into 8,000 shares, because their market price was 40 before. Plus you give all the benefit to them. Divide by the number of shares, 50 rupees is the maximum price we could have paid. Because synergy in MPS is given to the target company. If it is minimum cash offer, that synergy will be kept with us only. So they will get only their market price. Their market price is 40 into 8,000 shares. Divided by 8,000 shares, that means they are going to get 40 only. No need to calculate also actually for this. Directly you see, they were getting 40, give them 40, finished. But if you want a formula, this is how you will calculate. Are you getting this? So minimum cash price is what? Saw the market price 40, pay them 40, done. Maximum cash price is what? Market price is 40, but we will give them the synergy also. The synergy which we will get, that also we will pay them for that. So 80,000 divided by 8,000. 10 rupees we are going to pay for synergy. 40 rupees we are going to pay for the existing market price. So total amount that we are going to pay is 50 rupees. Is this clear? Are you following this? So maximum swap ratio will not be there, but they can ask a question. What is the maximum price that can be paid to the shareholders of target company? Or what is the minimum price that can be paid to the shareholders of target company? Or they can also frame it like that. Frame it in a way they can tell what is the amount that has to be paid to the target company such that the target company shareholders are not at loss. That time what you are going to take? Maximum or minimum? You are going to take minimum. They said the target company shareholders are not at loss. That means they are going to get the same amount. Clear? If they tell that target acquiring company shareholders are not at loss, that means you are going to calculate the maximum price. Clear? Yes. Please write this. That should be it with the example part. Okay. After that, there are some few note points which we have to discuss, and then we go directly into problem solving. Everyone was telling gold is precious, you should hold it and all. It is falling like anything, right? Yeah. But it's good not to buy physical gold and keep it. Is good. It's always valuable. Yeah. I feel that ETFs are not safe. They are just paper money, right? All this silver ETF and gold ETF, always it's scary. Like for trading, fine. But I don't think it's a long-term investment perspective, not a good idea. Better than that is actually investing in this PhonePe gold. You know, PhonePe, you can buy gold. You'll get the same gold rate. Yeah, all the apps. And you can convert that into ornaments also if you want. You keep putting like 20 rupees, 30 rupees in that PhonePe gold. Later on, if it becomes 1 gram, 2 grams, right, you can actually redeem it. That is better than ETFs for long term. See, current market is exactly like this merger and acquisition question only. Earnings is 1 lakh, right? P is 10. Market value is 10 lakhs. Correct? Earnings is still 1 lakh only. Earnings is not getting affected. P went down to 6. P went down to 6 because of market situation. So that doesn't make the company a bad company, no. When market changes, earnings are good. And in fact, earnings are growing also. So it will recover. But we don't know when. Everything is in Donald Trump's hands. But what, man? Donald Trump's overconfidence went no. I don't know who is right, who is wrong in the war. But Donald Trump's overconfidence that he thought in 2-3 days he'll finish Iran, no. They're still attacking. And that Qatar, that LPG, this thing, manufacturing unit of Qatar, they bombed that only. Actually, that vice president is also not supporting Trump. Actually, I understood that vice president's logic, okay. And I understood Trump's logic also. Trump will not be able to become president again because they have that rule that only 2 terms. So Trump's term is over. Whatever it doesn't matter, and is already 78. Okay, doesn't matter. He's seen his full life. Now that other guy is young actually. He doesn't want reputation of the party to go bad. Because if party remains in good reputation, next time he can become president. This fellow is spoiling the reputation and going. Yes, can I scroll till here? I was seeing on news, okay. Iran's drones, UAE was intercepting it and destroying with missiles. Yeah, it was costing 10 times more than the drones. They are sending drones. These people are spending 10 times more to intercept it and destroy those drones. But my friends who are working in Dubai, right? If I see their stories, I cannot make out that there is a war only going on. They are still having fun. Huh? They don't let the information. UAE made this thing, no, that if you put anything of war videos and all, you'll be. That has always been UAE. There are crimes happening there, but just doesn't come out. That's all. People think Dubai is very safe. But you should appreciate that one complete desert, they made it into a tourist hub. Because he doesn't have oil. Dubai doesn't have oil. All the oil is with Abu Dhabi. So if he has to survive, people has to come and spend money there. So usually the UAE people, I mean, a lot of Indians are there in Dubai, but Dubai usually, from money point of view, they don't like Indians. Because Indians earn there. They send everything to India. They don't spend. There, one person working in Dubai will be sharing in 5 sharing house, sitting in 5 sharing house. But here he will build one big house. They like these other Europeans and all. They'll come, earn, spend there only. One of my family friends is there, okay. He's there in Dubai from 30 years. Now that guy is actually, he's like, hardly he has any education. He went, back in the day, he went to Dubai. He is actually working as a supervisor in Sheikh's house. One of the Sheikh's house is the supervisor of the kitchen. So he has to ensure that always the material and all is purchased. And here he has like a mansion. In India, no, his house you should see. It is like almost Sheikh's house in India only. Like that. What he used to do, Sheikhs, they don't understand numbers, no. They have too much, so they don't care. What this guy does, simple math. Billing is done for 100 kgs. Only 900 kg and 90 kgs will come to the kitchen. 10 kgs setting. And like that is making money. And food and all, nothing. Taking from the Sheikh's fridge only and going home in the evening. Yes, done. Now, there are some other important points from examination point of view which we have to discuss. Okay, this I'll give you this material. You can write it or you can just keep it with you. Now, notes for exam. Just remember, some of them again might feel silly, but we have to look at that. Usually in the question, first column is acquirer and second column is target. From our examples and all, that is what we saw. But I say, they like creativity. Now, there can be one ICA surprise where first column is target and second column is acquirer. Now, imagine you have a situation, acquirer, target. 9 questions you see like this only. Acquirer, target, and you have EPS written over here, 10, and you have EPS written over here, 6. Then they ask exchange ratio. You will just do 6 divided by 10 and you'll write 0.6 for one share. Correct? All that they will do, same question they will give. Heading, no, slowly they will write target here and acquirer here. Clear? Now it's illusion. 9 questions when we have done like this, no. 10th question will not even go to look at the heading. Directly we look for numbers. EPS, okay, got 6 divided by 10. Now when you do 6 divided by 10, you will be completely wrong. This is exactly what they do even in FR also. FR, many questions previous year, current year column they'll give. Suddenly the columns will be interchanged. Now one place, first column is current year. Actually first column should be current year and second column only should be previous year. But in questions, there will be questions where previous year is first column, current year is second column. So just be careful. And after knowing all the concepts and cracking the question, just because of the heading, we should not lose marks. Okay, next. Gain or loss to shareholders. When we are talking about gain or loss to shareholders, always prefer in terms of market value. Okay, when you're calculating gain or loss to shareholder, that benefit table when we are preparing, if they don't tell, if they just tell, compute the benefit to the shareholders of this company or shareholders of this company. That time, the benefit table you always prepare based on market value. If nothing is told, but if P is not given in question, then what you can do? Then market value only is not possible, no. There is no P in the question. That time, compute gain or loss in terms of earnings. Are you getting the difference? Now, one more thing that you have to understand. If they tell, now you saw this chart, okay? Okay, sir, always you have to prefer in terms of market value. If P is not there in the question, you have to do it in terms of earnings. In one question, P was there. Okay, that means we have to do in terms of market value. End of the question, they told, compute in terms of earnings. Are you getting my point? Okay, if they tell earnings, it's based on earnings. If they don't tell anything, then it is based on market value. But if they don't tell anything and P is not given, then you will do it in terms of earnings. What are we talking about, gain or loss? The benefit table. Remember the benefit table we had to prepare? That one. Clear? Now, next. In swap ratio computation, when you are calculating swap ratio, if basis is not given, then compute based on MPS. Compute based on MPS. Else, follow the question. Clear? Now, if they tell you there should not be any loss in earnings for both parties, if they tell you there should not be any loss in earnings for both parties, then you cannot calculate based on MPS. No, you have to calculate based on EPS. Is it clear? So, if nothing is mentioned, you will always be doing it based on MPS. Otherwise, you will just follow the question. Do you want to write it? Or will you write it later? Okay, right. There are many columns actually. So write fast. Okay. Let's go further. Now, some more points that we have to understand just from examination point of view. If question is silent, PE of acquiring company will be the PE of the merged entity that we have already discussed or written somewhere else also. Now, if in question, PE, if they write something like adversely affected. Adversely affected means what? Is it doing good things or is it doing bad things? Bad things. If they tell adversely affected, then PE should reduce. So they might tell, for example, PE of acquirer is 10 and they tell if PE is adversely affected by 20%, that time the PE of the merged entity should go down and it will become 8. And I told you, if they don't tell you the PE of the merged entity, that time you will take the PE of acquiring company only as the PE of the target and acquiring company after merger. Some questions are there, very, very few, where they tell you that the PE is adversely affected by some percentage. So you reduce that percentage, not add, you have to reduce that percentage. Clear? That means adverse means what? Bad. That means reputation is going bad. If reputation is going bad, then PE has to reduce. Next, synergy in earnings. Okay. Synergy in earnings is basically additional benefit from acquisition. Okay. Join hands, there is more benefit that we have seen. Synergy in market value is what? Due to increase in reputation. Now, synergy in earnings is basically when both of them are joining hands, the technology or the prowess of the company is increasing. So they're able to produce more or they're able to earn more. That is synergy in earnings. Synergy in market value is what? Earnings might be same, but because both of them have joined hands, suddenly the reputation has increased. That increases the market value. That is basically target earnings will be multiplied by acquirer's PE. The 40,000 into 2 which we did know. That 2 is basically 10 minus 8. 10 was the PE of acquiring company. 8 was the old PE of target company. So synergy in market value is due to increase in reputation. Synergy in earnings is additional benefit. It can be because of anything. Yesterday we discussed some examples and all that. This fellow has the raw material. What is that? Chocolate example, right? He's able to dry the cocoa and the other person has the patent to manufacture the chocolate. So when they join hands, automatically they will have higher earnings. Clear? Next. Now question terminologies to remember. All this you have to remember. They will frame it like this. They'll just tell calculate NPV of acquisition. NPV of acquisition. NPV terminology usually we see in a chapter called as capital budgeting. Correct? Now NPV of acquisition means gain to acquirer. Because who is doing the acquisition? Acquirer is doing the acquisition. So NPV means what? Net benefit. Benefit table, but from whose angle? Acquirer's angle. If they tell NPV of acquisition, always remember it is you have to calculate the gain to acquirer. Now gain in terms of what? Gain in terms of what? Market value. If they don't tell anything, it's always market value. If they tell earnings, then only calculate earnings. Clear? Now, they can tell cost of merger. Compute the cost of merger. When they tell you cost of merger, the cost is for whom? Acquirer. Now you feel, no, cost of merger means we have to calculate PC. Purchase consideration. If you think from amalgamation point of view of INDES, or AS. Now, cost of merger, you will always think what you are paying. It is not that. Cost of merger is your cost is that fellow's benefit. So benefit of target, gain of target. Remember we did one question where we got one person is getting gain, one more person is getting loss. So if one person is getting gain, for other person it is cost. So cost of merger, you will always calculate the gain to the target company. Now true cost of merger, when they use the word true cost of merger, that time also it is gain to target company. They can use the terminology cost of merger, that is also gain to target. They can use true cost of merger, that is also going to be gain to target. Is this clear? Now, net cost of acquisition. All these three things are same. Gain to target. They can tell cost of merger, true cost of merger, net cost of acquisition. Basically what you are going to lose, everything you are going to calculate the gain to target. Now, total gain from merger. Total gain from merger, total benefit from merger. Benefit from merger is always going to be synergy. Now see different ways to ask that. Gain from merger, synergy. If they tell total gain from merger also, if they just tell gain from merger also, it's always going to be the synergy calculation. Gain from acquisition, merger, everything same, it is also going to be synergy. This is like same question, but they change the terminology when they ask in the exams or in RTPs. Now, maximum exchange ratio acquirer can offer without dilution of EPS or MPS. Maximum exchange ratio acquirer can offer without dilution of EPS or MPS. Whose EPS or MPS should not get diluted? Acquirer's EPS or MPS should not get diluted. That means we are going to calculate maximum swap ratio. That means all benefit is given to that person. Clear? Now, if question provides pre-tax profit, some questions will be there. Now again, same illusion. Okay, 9 questions you will see PAT. Suddenly one question will be there, pre-tax profit. Be careful when you compute EPS, subtract the tax, get the post-tax profit and then calculate the EPS. Is it clear? Okay, don't blindly think that the profit that is given is profit available to equity shareholders. Okay, just check if it is pre-tax profit. Now again, same thing can happen in one more way. 9 questions will be there where they will tell only PAT or EAT because there are no preference shareholders. If there are no preference shareholders and you're going to tell EAT, now suddenly one question, it will be EAT only, but one line will be there. There are 9% preference share cap. There is 9% preference share capital. Are you getting this? So these are like points where I'm trying to tell you, please don't get adjusted to the routine of solving. 9 questions. Now I don't have to see certain information in the question. Directly start solving. Don't do that because there only ICA plays. Okay. 9. Effects on EPS, share price, right answer in rupees and in percentage. If they tell what is the effect on EPS, is the EPS increasing or is the EPS decreasing? That time you write the answer in rupees also. If it's a 4-mark question, write the answer in percentage also. How much percentage increase and how much percentage decrease. Next, computation of synergy in market value. Synergy in market value we already know, but again we will discuss. Market cap is PEAT into EAT. PEAT means what? PE after merger. EAT means what? Earnings after merger. Earnings after merger, how you will get? Earnings of acquirer plus earnings of target plus the synergy in earnings. Synergy in earnings. That 80,000 synergy which we saw today, no, that will not be there. That is synergy in market value. So multiply this, you will get. And this you already know. If you don't have, you will take the acquirers only. Increase in market cap is synergy. Okay, can be due to increase in earnings or due to PE change. Increase in earnings, we know. If at all there is increase in earnings, 100% the market value also is going to increase. If increase in earnings is not there also, still market value can increase because of due to PE change. Just now we saw 10 minus 8. Clear? Now, synergy in market value, if it is given in question. Remember I told you the table, you go like this. Okay, if it's not there, you go like this. So if synergy in market value is given in question, given amount only is synergy, given in amount, then what will you do? Directly add VA plus VT plus synergy. What is VA? Value of acquiring company. What is VT? Value of target company, and add that synergy, you will get the total market value. If it is given in percentage, VA plus VT you take plus increase in percentage. Now, you know why I wrote this? Because market value of acquiring and target 120. This is the market value directly. And they said there is a synergy in market value of 10%. Synergy. You know what is the mistake students are making? They are taking 100 plus, no, they are not doing that also. They are doing 100 plus 20 plus 10%. They are taking 122. Market synergy is not one person's market value increasing, combined market value increasing. So when you're doing synergy, you have to do 100 plus 20 and then you have to add 10%. It becomes 132. Are you getting this? So market value increase, or if you want to make it very complicated, you can also do like this. 100 plus 10%, 20 plus 10%. Then you can calculate the total. That you can do. But please don't apply the synergy percentage to any one person and leave the other person hanging like that. Clear? So remember this, whenever it is given in percentage, the percentage of increase should be to the combined value, not to the value of acquirer alone or to the value of target alone. If savings of future is given, If savings of future is given. Now what will you do? Synergy is equal to savings in future divided by capitalization rate. Now, what is the savings of future? Now, sometimes what, how they'll give you synergy, they will not tell you that today you're getting any gain. They're like, because of this merger, both companies will save 20,000 every year forever. 20,000 every year forever. Now, suddenly we have to go into the basics of FM and remember the perpetuity formula. Now, perpetuity formula, fun you see. 20,000 we will say, 20,000 divided by 10%. Got the answer. No. When you save 20,000, no, Nirmal Aunty is waiting there. Are you getting my point? When you save 20,000, Nirmal Aunty is waiting there. So savings in future, whenever they give, you have to ensure that it is after tax. You have to ensure it is after tax. Now, tax rate is not given in the question. Tax rate is not given in the question. Now what will you do? Assume that it is after tax. Assume that it is after tax and write one note. Okay, it is assumed to be after tax. But if at all they tell 20,000 and somewhere in one corner of the question there is a tax rate of 30%. Tax rate you saw till now for anything, it has no business in mergers and acquisition. That means if it is there in one question, it has some business. So if they tell savings, then you have to do 20,000 minus 30%. Is it clear? Okay. Now, if in question, increase in growth rates. Increase is given in with growth rates. That also we saw, right? Now see, for example, number of shares I have given of acquirer and target, 10,000, 5,000. DO. What is DO? Today's dividend. Today's dividend is 100 rupees. I think there was one chapter in FM, dividend, Gordon's growth model and all that you had, right? It was actually in finals. That dividend pricing was in finals. That went to Inter when they changed all this new scheme, old scheme they made. Okay, so 150. That is today's dividend. Now, KE, 15%, 15%. KE cost of equity, yesterday we discussed that. Okay, growth rate, 10%, 4%. Now, understand, forget about all this Gordon and all that. When we studied yesterday, okay, the basics of FM, when I was calculating that perpetuity, okay, that time I had written amount divided by rate, correct? But I had written amount 1. Amount 1 divided by rate. Amount 1 means what? Amount that you're going to get at the end of year 1, correct? D0 means dividend that you're getting today. That dividend will grow. So it will be 110 at the end of year 1. Clear? This we will discuss more when we go into security valuation. Okay, if growth rate of target is expected to accelerate to 8%, that means their growth rate was 4%. By joining hands with us, they are growing faster now. Possible, no? Imagine one shop is there. One guy is selling ice cream, Baskin Robbins. Right in front of his shop, one more person opens one shop. He is selling normal ice cream. No reputation, but he is also growing. He is also growing. But imagine if he merges with Baskin Robbins, don't you think his growth rate will accelerate? It can be both ways also. Okay. In one small town, if they open Baskin Robbins, nobody used to go there also. This fellow only was growing. Now Baskin Robbins joins with this person, Baskin Robbins will start growing in that area. So it can be because of that. So 4% growth rate has accelerated and it has become 8% after acquisition. Compute gain or loss to shareholders of both the firms. Swap ratio is 0.25 for one share. Now, see how the solution will be. P0. P0 means what? Current price. Current price. This is going to be D1 divided by K minus G. You're seeing it in different terminologies. It is nothing but growing perpetuity. It is nothing but growing perpetuity which we saw. So D1 is dividend not of today, dividend of future. So what was the price here? 100 rupees. 100 rupees is the price. 100 into 1.1 divided by 5% because 0.15 minus 0.10. 2200 is pre-merger market price of acquiring company. Now, to calculate any benefit, wait, I'll give you time to write, wait, I'll give you time to write. Okay, this is important, I'll give you time to write. Now, see, remember this, benefit table whenever we did only one thing, post-merger MPS, pre-merger MPS. Here, anywhere MPS is given. MPS only not there, no? So, we have to calculate the MPS of today. Now, we are like, sir, we are using D1 and calculating. When we are using D1 and calculating, how can you tell that it is the MPS of today? Isn't it the MPS of year 1? It is not MPS of year 1. We are using the information of future and we are calculating present value, and that present value is the MPS of today. Are you getting this? We'll go more into this when we go into security valuation, but can you understand? Even though we are not using D0, we are using D1. Okay, in the perpetuity formula, it was not amount, it was amount 1. Amount 1 was giving present value. Clear? So dividend of year 1 will give us present value. So 100 into 1.1 is the dividend of first year end, divided by KE is 0.15, growing perpetuity minus growth rate 0.1. You got 2200 as the MPS of the acquiring company only. Now if you are doing for target company, what will you do? 50 is the dividend, 50 into their growth rate is 4%, so 1.04 divided by their KE is 15%, so 0.15 minus 0.04 should give you 472.73. Are you getting this? Now, till now what we got? Pre-merger only we got. Till now what we got? Pre-merger MPS only. Now what we need? Post-merger MPS we need. Post-merger MPS. Formula will remain same. Now how will you calculate post-merger MPS? First we remember one thing. Okay, synergy in market value was not given only. Anywhere did they tell us about synergy in market value? Now what you will do? Value of acquiring company you know. Why you know? Because just now you calculated their market price per share. Value of target company we know. Why you know? Because you just now calculated the market price per share. So if you do 2200 into 10,000 shares and 472.73 into 5,000 shares, you will get it. But this column, now you can see there is a number here, but this column was not given anywhere. Okay, synergy was not given. If you get the synergy, you will get the total market value. If you get the total market value, you will get the market price per share post merger, because over here the swap ratio is already given. So denominator is not a problem for us. Numerator only is problem. Now, if you see further, computation of synergy. What did I do? I took 50. What is this 50? What is this 50? DO of whom? Target company. DO of whom? Target company. Now, here there is not going to be any change. These people are going to be growing also at the same rate. Everything is going to be same. What is going to be the synergy? This fellow's great growth rate will accelerate. This fellow is growing at 4%. Now suddenly he'll start growing at 8%. So now see over here, computation of synergy, 50 rupees dividend now will grow at 1.08 and subtract, you will get 771.73. Now 771.73 is not synergy. 771.43 is the value at the new growth rate, and the value at the old growth rate we have to calculate. Market value before growth rate increases 2363,750. How is that? Can you see 472.73? Okay, I didn't write the calculation there. I'll write it now. 472. Not 73, 43. How much was that? 73. 472.73 into 5,000 shares. Are you getting this number? 2363,650. The difference only is synergy. Difference only is synergy. Very important question. Now it might not be there in every question. It might be that one-off question which is there in mergers and acquisition. Are you getting this? So don't make the mistake of directly, lot of mistakes are there which you can make. Not only one. I'll tell you from starting where and all you can make mistake. First thing is ignoring this one question which is there in mergers and acquisition. That is one mistake. Okay. Because when we go there, we are totally clueless. Question will look like security valuation, but it is not security valuation. Question when you see, all this DO, KE, G and all, when you see the question, you'll feel, oh, it's a security valuation question. But when you start reading, then suddenly they'll tell gain or loss to shareholders of both firms. They'll give you swap ratio. Now you are in a fix because both the informations are there. Now here, first thing is ignoring this unique question. Now, simple, okay. If a question is unique in the study material or anywhere, that you should never skip. Because whenever ICA wants to give a surprise question, that will be the one. If question is repetitive in nature, that you don't have the guts to skip anyways. Are you getting my point? Basically, rule is don't skip anything. If something is not asked for a very long time, that it means it can be asked. So you should not skip that. If something is asked every time, then you take the guts. If you have the guts, you skip it. Okay, so basically you can't skip anything. Yes, so now let's understand this again. acquiring company and target company, anywhere earnings are not given. Earnings are not given. PE is not given. Market price is not given. Number of shares are given. Number of shares into market price will give us the market value. But we have to find that market price. And our question is to find the gain or loss to shareholders. When we have to find the gain or loss to shareholders, we need synergy. Now, to calculate synergy, we have different ways. How we were calculating? Value of acquiring company, value of target company. We know this. Then we will calculate value of acquiring and target together. Then if there is difference, that is synergy. That to do, we used to do earnings into P ratio. Earnings is also not there. P ratio is also not there. So now I can't do that. I cannot go in that normal route where I do earnings into P ratio and get the total value and then divide by the number of shares. All that I cannot do at all. So what I can do, I can only take value of acquirer, value of target, and add the synergy to that. To add the synergy, if synergy is given in the question, I would have gotten the market value of the merged entity, but I don't have that. So what information they have given? Growth rate of target is expected to accelerate to 8%. So basically the difference between this 8% and 4%, that is going to be synergy. This extra growth which will happen after merger, that is going to be synergy. Is this clear till here? Now, gain or loss to shareholder is nothing but the benefit table. Okay, benefit table. Swap ratio 0.25 for one share. That means it is given. So 0.25 for one share means if 5,000 shares are there, we are going to issue 1,250 shares. Clear? Now, pre-merger MPS is not there. Post-merger MPS is also not there. So pre-merger MPS, what will you do? D1 divided by K minus G. It is given by different people, but it is nothing but the formula of growing perpetuity. Now, first mistake. Okay, first mistake that you should not do is take this as D0. If you take it as D0 over here, you will be getting the wrong value. So you will take 100 into 1.1. That is their growth rate divided by KE minus G. Clear? And this person you will do 50 into 1.04 divided by KE minus G. You will get what? Pre-merger MPS of both the companies. What are you getting? Pre-merger MPS of both the companies. So here you got 2,200 and here you got 472.73. Now, post-merger MPS. Post-merger MPS, to do that, we don't know earnings. Now you're like, sir, can I use the same route and calculate post-merger MPS? I cannot. Can I use the same route? Because here D0 is 100 rupees. 100 rupees. Now after merger, we don't know what is going to be the earnings, and after merger, we don't know how much dividend we are going to distribute. So post-merger dividend, we cannot use, we can use that logic. Pre-merger PE will be post-merger PE. We can't use it everywhere. For PE, we can use it. Growth PE multiple we can use, but we can't use it for dividend per share. Okay, so what we are going to do post-merger to calculate, we will do value of acquirer. We know that. Value of target, we know that. To that, we are going to add the synergy. This we don't know. This we know because just now we calculated market price. This we don't know. So what will happen over here? Number of shares into market price, number of shares into market price. You got the value of both the companies. Synergy you have to calculate. Synergy, what you will do? They said that the growth rate is going to accelerate and it is going to become 8%. It is going to grow and it is going to become 8%. So now what you will understand? Calculate the market value with the new growth rate. Calculate the market value with the old growth rate. The extra is whatever is there is going to be synergy. Extra is going to be synergy. So what you are going to do? 771.43 is with the new growth rate. 1.08 I took over here. And this is 472.73 is with the old growth rate. That is pre-merger. The difference of 14,93,500 is going to be your synergy. That you add and you will get the total market value. This is the total market value of the merged entity. Divide by the number of shares. I told you 1,250 shares are going to be issued. So 11,250 shares now. You will get 2298.41. That is going to be the market price per share after merger. When you have market price per share after merger, benefit table should not be a problem. Okay. Gain or loss. This should not be a problem. This is going to be a cakewalk. 2298.41. You know you cannot take 2298.41 on the other side. You will take 2298.41 into 0.25 because 0.25 was the swap ratio. Then 2200, you only computed pre-merger MPS. 472.73, you only computed pre-merger MPS. Okay, you will get difference. This is going to be your synergy. This is going to be your synergy. Now you can't verify this synergy because PE multiple, it's not because of PE multiple, no, it's because of growth. Okay, if you total this, what are you getting? If you total this, what are you getting? Yeah, but what is the number? 984, 100 plus 509, 350. 93, 450. It was the same thing what we calculated. So from PE angle, we cannot calculate synergy. So from some angle, we have to calculate. So basically, just remember one thing. If there is no gain or loss for any shareholder, that means if there is no synergy, then both should not gain, both should not lose. But if somebody is gaining, that means somebody is losing. If there is synergy, then both can be gaining. But both gaining, the total of both the people's gain should be the synergy amount. But if somebody is gaining more than the synergy amount, that means somebody is losing. Are you getting this? This is your verification point in every benefit table. The 11th one will go later. I think you have a lot to write. From which point you have not written? Fourth. I can have a tea and come back, I think. What? You're actually going to have tea? Nicely, all used to get up, no? Article shift at 8 o'clock, 8:30 and all. I'm sure there are people who are getting up at 9 o'clock also to reach office at 10, 10:30 if they're staying close by. Suddenly system changed. Yesterday, the call option people, the amount they have lost. No, the put option people would have gained yesterday. Yeah. Yeah. Any broker app if you use, when you go to F&Os only, they'll give you a disclaimer. No? They lose money like anything. So you should do option trading only on days when you know you are going to gain. You should not do on every day. Those people become addicted to it. Whoever does F&Os, no, they get addicted to it. You should do like maybe like when this war is going to end. That time you know it's going to raise, right? Those are the days when you should capitalize. You know, Kotak Bank, they made that error. Kotak Demat, they made an error. One guy, they put he had some 20,000 or something in his margin account. Okay, they put some 1 crore or something by mistake, and with that he traded, and he made some profit, some big amount of profit he made. Okay, and then they took that 1 crore back, and they took the profit back also. He went to court. Then they said that you made the mistake of putting 1 crore. Now you can remove 1 crore. That extra profit what he has earned with the skill. So they had to return that money to him. So after that, every day I'm refreshing my Demat account and seeing if there is any 1 crore by mistake. 6 done. Now this and all, no, when you're writing, you can save little time, okay? Which gain to target, there are three. So you can club them and together once you can write gain to target, just to save time in class. I don't know, in articleship also, I know articleship students who are losing money because of trading. They go to office, someone will be there in their office who will tell, this can change your life. I think your office, if they get to know, they will shout at you, know, for they have some rule in their office telling that if you trade, we will not take you as articles, something like that. But still, you guys are doing it, but that's a different thing. No, their logic is simple. Like I told that heart surgeon story yesterday, no. Their logic is simple. If these people are trading, 100% they will not work, no. Their head will be there only. Yes, can I scroll till sixth one? Six done? Yes. Yes. Clear? You finished? The 10th point is the most important one, okay? Others are like small errors which you can make, but 10th one, be very careful when you write that example. There's some new inter batch starting. Now you feel, no? Inter, nothing is there. And you're in inter, you also are studying. Like, what is there in inter? Finals is the real deal. Your one FR textbook, I think, is equivalent to the entire group of inter, I think, no? Yeah, that's what FR, the total pages of FR is equivalent to the entire group of inter, I guess. Advanced accounting, law, and tax. If you add also, I think it will not be 2,800 pages study material. Around 2,800. Group 1 of inter. Tax is 1,800. Oh, tax is there. That's what you think. That's what ICA made you think. Yeah, the big ones have to repeat. No, consolidation and all has to come. It has to be there. Such major concepts there, right? No, man. You could have gone little later also. You know why? I'll tell you, sit. Last month I was taking class for them. When you take inter and foundation classes, no, these people very distracted there. They keep getting up and going to drink water and all that. I give crazy build up to them. I told, see, you guys don't have discipline. You should see final students. They never get up. Okay. And first day when they're entering only, you got up and, and went. All my build up which I gave for final students, it went around day one only. Can I scroll till 9? Even though FR is very vast, right? Previous day pressure will not be there for FR because it's the first exam. You will be studying last 1 week FR only. The previous day pressure will be there. I'll tell you. I mean, from my experience of writing finals, is for DT. That is madness, man. I don't want to go back to that day, previous day. DT will know everything, okay? Because you'll be doing it in articleship. You'll like that subject, okay? In fact, it was one of my favorite subjects in inter. I mean, sorry, in final also. But thing is, previous day, right? You can't revise DT. You'll spend days, the entire day, night also you have reached. Then you realize, oh, DT got over. Then you realize, oh, international taxation still there. Very vast. And you can't skip points. When you read DT, you will feel, oh, this point also is important. Every point is important. GST is manageable. GST I was able to revise like 5 times on the previous day because I was using one of the author's chart book. So very nicely they had done the chart book, and 5 times I revised GST on the previous day. Yeah. Very, very good, right? What? Yeah. That I got to know after I came here. I have suggested his chart book to so many of my inter students. Whoever they tell they find tax difficult, no, I say GST is just his chart book. But some people who try for rank, no, they're not happy with that chart book, okay. But I was not trying for rank. To clear, right, that chart book is crazy. They're like some notifications and all are not there in the chart book and all. Someone told me recently. But doesn't matter. I was not one who was looking for rank. Like when I got my results, I never checked that merit list also. I was not even thinking that I'll be there. But whose chart book, sir? I can't tell you, sir. I can tell you off the camera. Okay, sir. You can contact me outside classes. I'll tell you whose chart book. Can I scroll till here? Yes. Till here? Yes. Please write this example very, very carefully. And DT also. DT everyone knows, right? Almost everyone is referring one person only for DT. Like huge market is captured by that person. In fact, I didn't even purchase the classes of that person. DT, nothing. I didn't purchase class, just purchase that compact book. That's enough. And watched all the marathons on YouTube. I mean, that's because I used to like DT. So naturally, I was interested towards DT. So I knew most of the things. So it was very good for me. Like PGP panel in 3.5 hours, it's done. Master question is there. And some super 30 question and all he'll release. In that one total income question comes, that runs into 3 pages. Yes, can I scroll till here? How do you know that he was here before? How do you know that he was here before? How do you know that he was in ArivuPro before? Oh, is it? Yeah, yeah. It seems he made those chart books in those huge chart papers, physically writing it initially. Crazy, right? Then he digitalized it. Yes. Can I scroll till here? Till here? Foundation times means you are associated with ArivuPro for 4 years. Once after AFM gets over, FR will start. Or you completed FR. And no, I was taking AFM in the regular batch last year, you're telling. I was taking AFM there. No, I was taking AFM here only. No, that audit was going on there. Ah, yeah, yeah. You saw me maybe I was taking foundation that time. In Koramangala, I was taking foundation. Ah. No, no, no. When you saw me in Koramangala, I was taking foundation. That was in the evening, right? Mashmi Marathon or something. Because by the time I started AFM, Malleshwaram branch was set up. Audit, few days it was in Koramangala and then in few days it was here. Until here. That is not a nice place to study, no. I mean, branch, I'm not talking about the branch, the locality. Malleshwaram is peaceful to study. When you go out, you see trees, nice weather. Koramangala, when you go out, you'll forget studies. You won't believe, man. There was one foundation batch I took, okay. In that, 80% students were from all these colleges, Christ, Joseph's, and all this different, all the big colleges which are there, Jain and all those things, okay. And classes in Koramangala, it's from 4:15 to 9:15, no, evening. So on Friday, right? Sorry, Saturday. Saturday, the students used to come to class. When they used to come to class, right? I used to feel like I am their driver or something. They used to be dressed up like as if they're going for a function. They used to come to class. From class, directly they used to go to party. Then Sunday I should keep morning class, okay? Because Sunday holiday, no. Those people will not come to class on Sunday. Directly they'll appear next in class on Monday only. Yes, until here. Can I scroll till this part? Total synergy. What a coincidence. Today Inter FM only started. And here we are doing AFM. But I'm tired telling people, okay, actually Inter FM and AFM finals actually doesn't have any connection. Only some formulas you study there, that only. This is entire different game only. People think that it's just an advanced level of FM. It's not. Maybe FR is an advanced level of advanced accounting. Because amalgamation, consolidation, it's almost what you have studied. Basics remain same. But this is different. What you have in FM about derivatives? Nothing. About Forex. Capital budgeting. That is common, yes. And capital budgeting, they brought it over here. They made it advanced capital budgeting. Done, guys. Online students, good morning. Wake up from sleep. It's hot, right? Fan speed was 1. Yes, can we continue, guys? Everyone finished? Now, next, some more small concepts which we have to discuss. In question, if P ratio in question is given, then you have to ignore synergy. You have to follow that only. Okay, in this case, if you use P, synergy will be there. Okay, that is basically, if you use P of acquiring company to be the P of merged entity, then synergy will be there because that P will increase. Clear? Now in question, if they tell considering market price of target reflects its true value, this can be one terminology that they can tell. What are they telling? Considering market price of target reflects its true value. That means its real value is already there. Then don't apply P of acquirer to the earnings of target, because if you apply P of acquirer to the earnings of target, automatically it will be more than the existing value. So VAT will just be VA plus VT. Value of merged entity will just be the value of both the companies, as target is already correctly valued. Because if you go from earnings angle, what will happen that time? The earnings will get multiplied into PE. And when earnings get multiplied into PE, what will happen? It will increase. It will increase the market value. Here they have already told market price of target reflects its true value. That means it's correctly valued. So you just add the values of both the companies, you will get the value of the merged entity. Is this clear? No. Like if in the question they tell ignore synergy, you are going to ignore synergy. So you can't multiply. In the question, if they tell its true value, then again you cannot multiply. Because in both the cases, if you multiply, synergy will get created. Synergy will get created. Now see, in that question, you did 40,000 into 10. That's why synergy got created. Okay, if you not do 40,000 into 10, if you would calculate values separately and you just add the two values, that time synergy would not be there. Is this clear? Now, 13. Shareholding percentage of acquirer and target after merger. Okay, it's basic. You should be able to know. Shareholding percentage. What will you do? Think. Don't even look at the screen. Think. What will you do? Number of shares which are there for acquirer divided by total number of shares after merger. Number of shares which are issued to target divided by total number of shares after merger. So number of shares of acquirer divided by total shares of the company after merger. Number of shares issued to target divided by total number of shares after merger. In our base example, we had issued 3,200 shares. So if you are using that example, you will do 10,000 divided by 13,200 over here. But here you are not going to do 8,000 divided by, you are going to do 3,200 divided by 13,200. Clear? Because sometimes they can also ask what is the shareholding of acquiring in the merged entity, what is the shareholding percentage of target in the merged entity. So it's basic math. It's not even, you don't even have to memorize this formula. It is just basic math calculation. Clear? Now they can ask one more thing, promoters holding percentage. Promoters holding percentage. Who is promoter? Let's go back to basics. Who is promoter? One who started the company, right? Okay, who was there at the time of incorporation. Now, unless and until they tell you, you have no idea about the promoters. Now, in this question which we solved, basic question, 10,000 shares were there. In that, do you know how many shares are held by promoters? We have no idea. So, if they tell only, we'll get the idea about that. So, some questions are there. They tell you promoters holding percentage we want to find out. So, what will you do? Same thing, number of shares held by promoter divided by total shares in the company. Now, if at all the 10,000 shares, if I tell 2,000 shares were held by promoter, then you'll do 2,000 divided by 10,000. 20% shares are held by promoter. Is this clear? Now, promoter holding percentage in merged firm. Promoter holding percentage in merged firm. Don't even look at the formula. Think. Promoter holding percentage in merged firm, what will you do? Number of shares of promoter in acquiring company plus number of shares issued to the promoter of target company. Not number of shares of promoter in the target company. Number of shares of promoter in the acquiring company plus number of shares issued to the promoter of target company divided by total number of shares. See, number of shares held by promoter of acquirer plus number of shares issued to promoters of target divided by total number of shares after merger. Okay, these questions are also there where they ask you to check the promoters percentage and all. That's why we need it. Clear? But otherwise, I don't think it's any complicated concept or something. Even if you had not written this or if you had not studied this, in the exam, if you think you'll be able to crack that. Okay, 15. If turnover to be computed. Okay. Inventory turnover ratio, debtors turnover ratio and all we studied yesterday. If turnover to be computed, both should be given in the question. If it's given in the question, use inventory turnover ratio. Why you should use inventory turnover ratio? Because inventory turnover ratio will give you total sales. Debtor turnover ratio will give you only credit sales. Clear? That's why, remember yesterday we discussed the formula. If both are given in the question, use inventory turnover ratio. Debtor turnover ratio is given just to confuse you. Because if you use debtor turnover ratio, you will get credit sales. Then to get the total turnover, you have to search for cash sales in the question. Clear? So reason debtors turnover ratio will give credit sales only. Now inventory turnover ratio gives you cost of goods sold. It doesn't give you turnover. So you have to, therefore total sales can be computed. But don't take that number which you get by deriving only. That number is not the answer. That number is just cost of goods sold. To that you add the profit percentage. If they are giving you turnover ratios, somewhere in the question they should give you profit percentages also. So based on that profit percentage, you will calculate. Clear? 16. MPS is basically EPS into P ratio. Now if you are just breaking down this formula, EPS and P ratio, if you are breaking down, EPS is basically earnings available to equity shareholders divided by N, and P ratio is market price per share divided by EPS. Clear? Now EPS can also be calculated in a different way, that is book value per share into return on earnings. Book value per share. Okay, book value per share into ROE. ROE how we calculated yesterday? How did we calculate? Yesterday we calculated return on equity. There was one formula which we studied yesterday. How did we calculate ROE? Return is what? Earnings divided by what? Total what? Share capital and reserves and surplus. Share capital and reserves and surplus. Okay, but when you are calculating, you have to remember one thing, fictitious items you have to remove. Okay, that is equity shareholders fund divided by N, book value per share. ROE we know, earnings available to equity shareholders divided by equity shareholders fund, or also EPS by book value per share. Now, if in question, if acquiring company, if they mention like this, if acquiring company is considering allowing target company 25% holding in the merged firm, compute swap ratio. Now, Did you understand what's happened over here? Till now, swap ratio, they told 0.25 for one share, maximum swap ratio. If they tell acquiring company wants to give 25%, not for the number of shares which are there over there. They want to give 25% of the merged entity. Are you getting my point? Now, if I take, for example, here, number of shares in acquire 3000 and number of shares in target is 5000. If the language is not like this and language is regular, that time what you will do? 5000 into 0.25, you will tell that 1250 shares. Correct? This is what you will do. But this is not like this. Here they said they should have 25% of the merged entity. We are not giving 25% for what they are holding now. We are giving them 25% of the merged entity. So in this case, what you're going to do, 3000 is there. That will remain 3000 only. That cannot change. Now, if 3000 is there and it's going to remain, and if 25% we are going to give to them, this should be 75%. This 3000 is basically, now acquiring company has all shares of their company. So now this 3000 is actually 100%. But by giving them 25% of the merged entity, this 3000 will be only 75%. So how much is 100? Cross multiplication, you should get the answer. 4000 shares. Therefore, the shares issued are 1000. And using the shares issued, you can always find the swap ratio. Clear? These kind of languages are used. So don't get adjusted to the normal. You should remember this. Clear? Again, I'm explaining this. If they tell only like this, otherwise directly, if they tell 25% is given to target company of the merged entity, that means in the merged entity, the original shareholders of acquiring company have only 75%. So if that is 75%, how much is 100%? You'll get the answer. Next, 18. Minimum price promoters will be ready to accept to give up the controlling interest. They can frame the question and they can use the language like this. What they're telling, minimum price promoters will be ready to accept, okay, to give up their controlling interest. Now see, what you're going to do over here, market price of target we know, which will be given in the question. Number of shares held by promoter also we know. Which, see, first of all, who is going to give up their controlling interest? Promoters. But which company is promoters? Target. See here. They are losing their control, no. They are giving up their company, no. So market price of target into number of shares held by promoter. Now understand this. Now what will happen, basically promoter of target company will be there who is having some good control in their company. Now by merging, they will not get that same control over here because here somebody is already ruling. So they will lose that control. They have to give up that control now. To give up that control, what will they expect? Imagine I'm a promoter sitting in XYZ Limited. What will I expect? I'll be like, boss, market price is there. Give me that money. Okay, I'll give up my shares. Give me that money, I'll give up the shares. But there is one more catch here. This promoter will be sitting and that promoter will also be getting some salary in some other position in the company. Correct? He'll be getting some salary. He'll be part of the board also. So he'll be getting some remuneration. By giving up the shares, I have to get the value for the shares that I'm getting. But by giving up the shares, I'm losing the position also. So I'm losing the salary also. So don't you think I'll tell boss, you pay me for the shares and also pay me for the loss of salary that I'm going to get. Going to have. Correct? So it's not just this. Otherwise it is just this. No, market price into number of shares. Give them the money. Their position is gone. This is the minimum price you have to give them. Minimum swap ratio. What was the minimum swap ratio? Existing what they are getting, that they should get. Correct? Synergy and all they don't want. Minimum swap ratio is existing what they are getting, that they should get. So minimum price promoters will be ready to accept is whatever is the market price. But that promoter, other than that, he was getting something. So present value of remuneration received by promoters. This is again going to be perpetuity only. Because by losing the position today, he is losing the potential of getting the salary forever. Correct? So what you will do? Imagine his salary is 2 lakhs per month. You will do 2 lakh divided by, if the the rate is 10%, perpetuity you will calculate, it will become 20 lakhs. That 20 lakhs also you will add and then you will tell this is the minimum price that I have to pay. Are you getting this? Okay. So again, only if the question frames sentences like this, you are going to think like this. Otherwise, we are going to think regular only. Minimum price promoters will be ready to accept to give up the controlling interest. Why will I be ready to accept only the market price when I'm even losing the 2 lakh salary. That 2 lakh salary, not 1 year I'm going to lose. I'm going to lose forever. When I'm going to lose forever, it becomes perpetuity. Then you will calculate the present value of perpetuity. Is this clear? Now, 19. Value of acquisition. Okay. Value of acquisition, if they tell. Value of acquisition means what? Basically, it becomes what is the merged entity? What was our value before? What is the value of the merged entity? What was our value before? This is the value of acquisition. Because of acquisition, this much value got added to our company. Clear? It is not synergy. Okay, value of acquisition is not synergy, but value of acquisition is including synergy. Are you getting my point? Value of acquisition is equal to synergy, but value of acquisition includes synergy also. Why? Value of acquisition is basically whatever came from there. Whatever came from there, their value came plus one extra value came. Clear? So VAT minus VA will give you value of acquisition. Increase in value of acquiring company after merger. Clear? Are you getting this? So if at all for our existing question, if I would have done this value of acquisition, no, it will not be 80,000. If you are thinking, it will not be 80,000. It will be 4 lakhs. It will be 4 lakhs. How I got this 4 lakhs? Full value, that is basically 40,000 into 10. That is what is coming this side. Are you getting this? So we'll just check VAT. What was the VAT over there? Earnings was 1 lakh plus 40,000, 1 lakh 40,000 into PE of 10. I think that means VAT will become 14 lakhs. Minus what was VA in that? 10 lakhs. Can you see it is becoming 4 lakhs? This is what I'm telling. If they use the word value of acquisition, don't get fooled and think that, oh, value of acquisition means from acquisition what we got. From acquisition what we got is not synergy alone. We got total value. Whatever extra we got added to our company. So increase in value of acquisition, acquiring company after merger. Is this clear? Now, 20. Value of original shareholders. Value of original shareholders. This is another terminology that they can use. Now understand this. Okay, this is not pre-merger market price or market value. If they tell value of original shareholders, don't come to a conclusion. Oh, value of original shareholders. Original shareholders means acquiring company. That means their pre-merger market value. That is not value of original shareholders. See, value per share, VAT plus, VA plus VT. Value of acquiring plus value of target you take. Divide by the total number of shares after merger. Ignore synergy. This is actually total bakwas. But somewhere one question is there in merger. ICA has done like this. They have used the word value of original shareholders and they have just taken two values of both the companies divided by the total number of shares. Then they said, oh, value of original shareholders, number of shares of acquirer into value per share plus number of shares issued to target into value per share. They are telling this is value of original shareholders. But does it actually make sense to the terminology used? So even though it is bakwas, motherboard, we have to listen to them. No, one question is there somewhere. I can't remember exactly where. One question is there where they have used the terminology as value of original shareholders and then they have just taken VA plus VT, ignoring synergy completely, divided by the total number of shares after merger. You got some per share value. Then they are telling, okay, for example, if I take 10 lakhs plus 3 lakh 20,000. 10 lakh plus 3 lakh 20,000. How I'm getting this 3 lakh 20,000? Because in our original question it was 40,000, P was 8. So divided by, I think 13,200 shares. How much are you getting now? 100. 100 is the value per share. Now what will you do? Number of shares of acquirer into 100. Number of shares issued into 100. So basically synergy completely out of the question. So basically whatever was there earlier, that only will be there. Okay. So even though it doesn't make sense, just remember this. One-off question somewhere they have written telling that value of original shareholders and ignoring synergy they have calculated. Okay. They have completely ignored concepts there. Original means they are telling synergy came now before. Without synergy, what would have been the situation? So just remember this point. If they use the terminology, because I say if you see the pattern, right? If there is something that does not have logic also, but if that same question comes in exam, same thing they will give. Same answer will be there in suggested answers. Okay. So just write that also, even though it doesn't make sense. 21. Purchase price premium offered. They can ask you one question. What is the purchase price premium offered? Offer price means what? What we are going to give it to them. Pre-merger market price of target is what was there before. Divide by the pre-merger, you are getting the premium. This any premium calculation you will do like this. For example, in that question which we solved, I think their market price was 40. What was their market price? 45. Which question? You are telling the growth question, I think. No. No, there was our original question. No, not cash. 40,000 into 8, 3,20,000. 3,20,000 divided by 8,000. How much is it? 40, right? 40. 40 was the market price. Now imagine I'm offering 45. In the cash offer, I gave them 45. So now this will be 45 minus 40 divided by 40 into 100. You'll get a purchase price premium. What premium is nothing but extra what you paid more than their market price. Okay, but you can get this in MCQ also. You can get it as a descriptive sub-question also. Okay, now free float market cap. What is free float market cap? Just now we studied the other side of that. Promoters. Promoters. Held by promoters, it is not free float. Now, not only promoters, okay. When you come to free float, no, don't think that total minus promoters will give you free float. Actually, other than promoters also, some of the shares will be there which are not free floating. Insiders. Basically, it can also be held by government and all. Held by government, held by banks and all. Okay, it will not be free floating. What is offered to public, that only is free floating. Okay, that is for general terminology. But in exam, it's always going to be only promoters. Other person is not there. So it will be total minus promoters for examination. But otherwise, see over here, even government can hold some shares. Now, do you think government which they are holding, they are giving it to public and tell, keep trading? They are not doing it. No, what is given to public, which is daily traded in, that is free float market cap. But exam, don't worry, government usually will not be there, only promoter will be there. Market price per share into number of shares held by non-promoters and government. Wait, 1 second. Did we... I think government should not be here, no? Because government becomes not free float. If I frame the sentence like that, it looks like even government is free floating. Okay, government is not free float, so it is held by non-promoters. Okay, next. 23. Purchase consideration, cost of acquisition. Now you're like, sir, this I already know. We have studied amalgamation. We'll do that only. No, we can't do that. Okay, that logic is a little different here. What you'll do is market value of equity shares issued to target. Okay, debentures, preference shares issued to target. Current liabilities or anything paid off. Now there are some liabilities. Either you take over those liabilities or you pay off those liabilities. So that also is going to be a consideration for you. Any other expense incurred like your realization expense and all you should have no. Okay, that is also going to be added because all this is going from your pocket. Minus sale of assets not required by acquirer. As soon as asset came, we are like this we don't require. We sell it. So there only you got some benefit. No. So that will be subtracted when you are calculating purchase consideration. And minus cash and bank balance. Minus cash and bank balance. But there is a catch over here. The catch is in the question, if they tell realization of stock and debtors. Realization of stock and debtors means what? The stock and debtors of the target company we don't need. Immediately we'll realize them. We get that money. That time you will deduct the cash and bank balance because you are getting immediate benefit. If they are telling no mention of realization of stock and debtors, that means we are taking over the stock and debtors and continuing. That means we'll get benefit in future. That time do not deduct the cash and bank balance. Are you getting this point? Okay, these are all one-off questions which can be there somewhere in some corner. So understand this again. Now listen, what you're going to do, whatever is going from your pocket. Equity shares are issued, preference shares are issued, debentures are issued, cash is paid. Cash is paid to whom? The old liability holders. And cash is paid for what? Any other expense, lawyers fees, CA fees, all that you'll pay. Okay, all that. And then you took over the assets. You're not doing net asset calculation of you're doing in FR. Okay, you took over the asset. If this asset is not required, you'll sell it today only. If you sell it today, your today's, it's basically like a cashback you're getting. You went and did some payment on phone pay or somewhere, you got on cashback, no, immediately your expense reduced, no. So you sold that asset, immediately it will reduce. Now it's about cash and bank. Cash and bank you have to look for in the question if the debtor and stock is realized or not realized. Realized means you got the debtor and stock, immediately you encash that debtor and stock. Encash means immediately you got the money. That time what you are going to do, you are going to subtract. If it is not realized, cash and bank balance do not subtract. Are you getting this clear? Again, some corner, some one mole, one question will be there. Okay, about this. Do not ignore it. Now, one more concept. Financial feasibility of acquisition. If they can tell financial feasibility of acquisition. So basically, present value of cash inflows from target company's operations post acquisition minus cost of acquisition. That is basically your NPV. If they tell financial feasibility of acquisition, they're like by acquiring the target company's earnings for next 8 years are given. Okay, target company will give us this earnings. Now what will you do? You'll take present value of that earnings. Now that earnings will be yours. But by getting it, by getting that earnings, you had to pay some money. That is your cost of acquisition. Subtract, you'll get your NPV. This NPV is basically for any investment decision. Now here the investment decision is purchase of a company. Are you getting this? Okay, so if they tell you year 1, year 2, year 3, year 4, this company has a life of 4 years. You have taken over that company and they are having earnings of 100, 80, 20 and 30. This can be earnings, this can be cash flow, anything. FCFF, all that we will see later. Okay, any of that can be there. Now what you'll do, you'll take present value of all these numbers and add the present value. That will give you the present value of cash inflows. Now what is your outflow? The PC that you have paid. That you will subtract, you'll get the NPV. If NPV is positive, go ahead. If NPV is negative, ignore. Okay, don't go ahead. Okay, after that we have some chintu-mintu concepts like demerger and all. We have to discuss that. But I think you have to write. From where? From 11, huh? That is a lot. Till 10 you missed, man. What you're writing from 11? To watch yesterday's class. Did you get the app access? No. You what on? Who is this? Is it? But that would be the regular class, no? It will not be this one. This one you won't get access, right? So you will not be able to watch yesterday's class. Today evening only it will come. You can talk to them in the break. Here only the academic team is there now. Because in that regular class, no, all these points I have not written. Today's class, whatever these extra points are there, no, that 11, 12, 13, 14, it's not there. What module? This extra examination points are there, no, it's not there. But for there we have solved a lot of questions. But anyways, you will get access of this one only. Yes, can I scroll till here? So what will happen today? You all got app access? No. Nobody got here in class. No, if you're coming to class every day, you don't need only the app. Oh, what do you want? I mean, later for revision, maybe, but on a day-to-day basis, you won't need. Yes, 12 done, guys. Now, somewhere these points which we have written now here, it will get cross-connected in the questions which we are going to solve, okay? Thirteen done. We'll share this material, okay? Whatever I've written. So if you have missed something in class to write, you can look into it and write. Unless you have to go back to the video, pause, and watch me. Now what time till office is? Huh? What 10? Till 10 o'clock. Because off season, no, you're shocked. 10 in off season. Notice is there, but still. Bank audit, sir. Bank audit is scam, no. You go there, just street food, no. Manager will give nice food. Will give nice report. Listed company subsidiary auditor. What on? Should not pick the call that time. I'm telling you, don't try to become the best article in your office. If you become best article in your office, no, then your CA final will get affected. You have to be the worst article in your office. That means get out as soon as possible from office so that your maximum time you should give for this only. If you try to do more work, they'll give you more work. Your goal is to complete CA final, right? Sir, they haven't added me to the group. Yesterday's class notes I didn't get. Yesterday, actually, I didn't share the class notes. Today, I'll share the class notes. Just contact that the number or the email ID. I mean, email will take time. So contact that number only. They'll call them and tell them to add you to the group. They'll add you. I always tell my students, okay, like there are other faculties who will tell that you have to treat articleship, you have to treat the office as your office and work. I tell you should not. You should treat the office as not your office. Because moment you start treating it as your office, then you will be working like a slave only there, right? Your CFN will get affected. Ultimate goal is to get that CA degree. Articleship is just part of the process. That's it. So find reasons. One day you'll get headache, one day you'll get leg pain. Some reason will be there to leave office. Find those reasons. Headache will happen. He's coming outside the glass and doing like this. In Koramangala, like this means something else only. I'm like, suddenly, what is he doing like this? He asked for tea. Headache you will get, leg pain you will get. Grandfather is not well. Some reasons you should tell and you should leave office early. No, leave office early means not like that on time. Leave office early means if the time is 6:30, leave at 6:30. Try to leave at 6:30. Because if the time is 6:30, they'll make you sit till 8. No. That you avoid, I'm telling. If you leave at 4 o'clock, then that fellow will extend your articleship, man. Don't do that. And now ICA has some crazy rule that leave rule is different. 12 days leave, no, per year. It is not 12 plus 12, 24. If you don't take leave in first year, it doesn't get carried forward to next year. Next year's to only 12. Thinking that you have carry forward leave, if you take, no, you have to extend articleship by 1 month there. Yesterday also I got messages. Negative marking. Yeah. But I told them, first you study. Don't tell hardly. Don't tell hardly. The number of people who are, because of the 2 marks, who are writing next attempt, no. Somebody's 40 would have become 38, no, because of the 2 marks. But the thing is, like people who are attending class, they should not worry about that negative marking now, no. That is what my point was. Students who are attending the batches now, they're asking about negative marking. I'm like, first you study the syllabus, no. Then you think, no, about negative marking. Now the positive marking only we are not getting, no. Done till here. $17. What? Yeah. They're thinking about it, it seems. Oh, luggage because carrying all the books. Then what, man? How many books do you have to carry? One of my old interbatch students, no. They had put one photo, okay, one day of everyone carrying luggages. Okay, one group, like 5, 6 are standing and group photo it was. First when I saw that, no, I thought they went on some trip. Then I read the information properly. Then I realized it was the IBS exam. Nothing, man. Take one, hire one tipper. You know the tipper. It will lift like this. That sand and lorry, truck. Hire that. Put everything directly outside this thing. No, exam center, unload it. Yeah, multiple trips you have to do. You have to go inside, keep the book, come back again, take more books. Oh yeah, that can be done. What am I thinking? Yes, that can be done, right? You can get the suitcase out. They'll allow it. But my point is, when so many books are there, do you even have time to search? For that also, there are people who make index. That guy Too good in index making. One guy is there. Can I scroll till here? 18. Yeah. They're putting a lot of effort to understand the index only. But if you crack that index, no, then the exam is easy.
You crack the index, you know the question, you go there, the question, same question.
They would have changed something, no?
Variable first and then contribution.
Oh, you're getting HCMP questions also?
Combination of now you need to, even if you have same numbers of the thing, you can't repeat the same. If the question is for 5 marks or 6 marks, you spend 20 minutes because you know the question. Okay, let me track it. You spend half an hour over there. Wow.
What about MCQs? They're coming easy. Oh, yeah. I heard that. A lot of people failed because of that last paper only this time. That's why Group 2 percentage result was very low. Group 1 was very high. Even though AFM came difficult in Jan, Group 1 pass percentage was very high. And the ranks, if you see, like 400 and all was the rank, I guess. The last rank was 410 or something. They got ranks even for as low as 400. Oh my god, still so many things are there. 19, 20, 21, 22. Can I scroll till 20? Can I scroll till 20? One done. No. I think now it should be done. No, 21. What about 22? Online students, even you have to write, huh? Don't be lazy. Don't rely on recorded backup. Yes, 22 should be done. Twenty-third done. 23rd. Done, no? 23. You can take a small break after this. Okay. The next concept that we have to study is demerger. Okay, demerger. Demerger is what? Till now we were studying about merger, right? What is demerger? There is a acquiring target and then this becomes a merged entity. This is merger. Now there is only one company, A, but it had multiple divisions. It got split off and there is a small company called as B Limited which is formed. Now A Limited is still there. B Limited is a new company which is a small portion of A Limited. It's like now basically all these automobile companies creating a separate company for their EV. For their EV segment, they're creating separate company. It's just like that. Or basically like what happened with Tata. Passenger vehicle and commercial vehicle, they got separated. Now it's there, but they're separate companies now. So demerger is basically same company going and forming another company. Now in merger, what happens if there is an acquiring company and if there is a target company? After merger, target company loses its identity itself. There is no target company only. Okay, but here acquiring company, when they form another company called as B Limited, this also is still in existence. This also will be in existence. Now part of the company is split off. Parties, demerged company and resulting company. Demerged company is the original company and resulting company is a new company that is formed. Shareholders of demerged company to get shares in resulting company also. Clear? So now what happens? Shareholders, they'll be like, boss, our company valuation was based on all these things. Now one portion is going away, so our valuation will go down. So compensate it. How will we compensate? Give me shares in that company as well. Clear? So all that will happen over here is shares will be issued of the resulting company to the existing shareholders also. Now restructuring. Restructuring, your favorite topic in CA Inter Advanced Accounting, internal reconstruction. of CA Inter. That's exactly what is going to happen over here, but we are not going to pass journal entries or anything like that. What they ask in the exam is benefits of restructuring. Okay, benefits of restructuring. Now, what we used to do in CA Inter is the same thing what we are going to do over here. What is internal reconstruction? Company is in trouble. Okay, now when they are in trouble, they are having losses. When they are having losses, they have multiple options. The options in front of them: one, merge with someone else. That means our company is gone. We don't want to do that. Two, liquidate. We don't want to shut the company. Three, solve the problem on your own. Third option is what? Solve the problem on your own. When you solve the problem on your own, what can happen? You can go to bank and tell, boss, give me more loan. With more loan, more funding, more profit. Correct? Then I can set off my losses. But bank will see your balance sheet and see loss there. They will not give you a loan. Then okay, fine. You'll go to some high net worth individuals and tell, boss, do you want to invest in my company? He'll see your financial statement again. Again, there is loss in that financial statement. Why will he agree to invest in your company when he has the option to invest in some other company? Why will he invest in your company? So that option is also not ruled out, but less chances are there. Now the third option is solve your problem on your own. Solve your problem on your own. Just like studying for CA final. No, when you're studying for CA final, there will be so many low days. You don't feel like, oh, so much is there. Okay, that time if you go and tell anyone, you will not get solution. Solution is internal only. That is internal reconstruction. Clear? So now what will happen? Existing people. That means go to the shareholder and tell, boss, I have to pay you 10 rupees. Please make it 6 rupees. Go to preference shareholder and make the same deal. Go to debenture holders, creditors, bank loan, everything. Make a deal with them to waive off some amount. When they waive off, no, you'll get some profit. Where is this profit? Only in books. It's a book profit that is getting created. That book profit will be enough to write off the loss which is there in the books. You're not getting any money actually. So for your working capital, you will not get money. For working capital, if you want to get money, you have to issue some more shares, or if you have to issue some more debentures and raise money like that. But otherwise, this is basically internal reconstruction is to present your books in a better way. When you present your books in a better way, now you're in your books, all those unnecessary items which was there in your financial statement gone. Now you go and present it to bank. Now at least they're happy that loss is wiped out. Now you can't hide this fact from bank, okay? Because if you remember your CA Inter, whenever you should prepare your balance sheet, now you'll write balance sheet of this and you'll write in bracket and reduced. You should write and reduced. That means you're not hiding from bank, telling that, hey, what loss? Nothing, no loss, see, nice balance sheet. You're telling that there was a bad day, but I only solved the problem. I'm coming to you with a break-even situation. So help me from here. Clear? So now benefits of restructuring can be what? Liability reducing or asset increasing. Clear? So reduction in liability, increase in asset. Those are the two benefits. Now utilization of the benefit, how will you use? What was the primary goal of internal reconstruction? To remove that loss from the balance sheet. So write off the P&L debit balance. Then what will you do? Write off fictitious assets, preliminary expense, debenture issue expense. All those fictitious assets we don't want. If you don't write off also, later it will get written off from reserves and surplus only. It will create more loss. So instead of that, write off now itself. Then creation of provisions. Now when you are doing internal reconstruction, it's not that you are only seeing the angle that we have to generate money, generate profits. We'll also see basically internal reconstruction is also showing the true and fair view of the company. No. So therefore, if you feel, oh, debtors, some people will not pay, you have to create provision. If you create provision, what? It will create loss. Provision is always P&L account debited. So therefore, this benefit will be used to create the provision. Because if you don't use this benefit, later on when you create provision, again you will be sitting in a loss situation. Last, decrease in asset. Some asset value has gone down. You want to revalue you want to reduce its value. That also will be utilization of benefit itself. Basically, all these things used to credit it to capital reduction account in your accounting, and all these things were debited to capital reduction in accounting. Clear? Now balance, after utilizing, if you had some balance, you should always transfer it to capital reserve. Now they don't ask questions on ledger creation or anything. I mean, they cannot ask. They don't know, they cannot ask because there's not accounting here. They can ask like this: what is the benefit of reconstruction? How was the benefit utilized from reconstruction? In fact, I think this is question number 1 only from study material. Okay, benefit from reconstruction. Okay, so what you will do, wherever assets have increased, wherever liabilities have decreased, that is the benefit created. And that benefit will be utilized for what? Writing off the loss, creating more provision, and for removing those unnecessary assets, fictitious assets. After that, if there is anything remaining, that will go to capital reserve. But in between all this, if some asset value has reduced, that also will be utilized from the benefit itself. Clear? Next, right issue. Okay, right issue was there again in CA Inter. Okay, there. Remember, you had one calculation. I think it's there in multiple places in CA Inter. Okay, right issue has now gone into CA Foundation actually. But in CA Inter in AS20, when you are calculating EPS, you will be having this formula. Okay, computation of theoretical post-trade price per share. Ex-rate price per share. Now they have made it post-rate price per share. Both are same thing. Basically what? After right issue, what is the price per share as per books? Theoretically, not market. Because we are telling, because of right issue, what is the impact on the share price? Okay, only on right issue, because of right issue, what is the impact on share price? Other things can also impact the share price, which we are not going to consider here. So here, number of shares prior to right issue into price per share before right issue. This will give you the value before right issue. From right, we got some value. Right shares into right issue price, that got added. Now divided by the total number of shares which is there after right issue, you will get one value. That is a theoretical value, X right. That means after right. Correct. Value of right will be theoretical post right price minus right issue price. Now imagine you got, okay, there is one example here. We'll see this example. Number of shares 800. Price per share before right issue was 2000. Right was given in the ratio of 3 for 8. 3 right shares for every 8 shares. Right issue price is 1600. If I take this example, now number of shares 800 were there and price was 2000. This is the value before. And 1600 is the right issue price. That means right shares are how much? 300 shares, because 800, no. 3 for every 8. Okay, so this is the value that is derived. This is the value that is derived. This was the value that was already there. Divide by the total number of shares. You get 1890.91. This is the value after right issue. 1890.91. But the shares are issued at what price? 1600. That means 290.91 will be the value of right. This will be the value of right. That means you can get an offer of right issue at 1600 and you can sell your right. You can sell your right inside this time 290.91. Are you getting this? So if I have a situation like this, price will be there, no, 1890.91 after right issue also. So now what I can do, if I sell it for 100 rupees, if I sell the right for 100 rupees, that guy will still make profit because he will pay 100 rupees to me and he will pay 1600 to the company. So totally he will spend 1700 rupees. Later on he can sell it at 1890.91. Is it clear? But can you sell it at 1890.91? No. That is because theoretically only you can sell it. In the market, if something goes wrong, it might be trading at 1500. Are you getting it? So as per books, when you are calculating, you will tell benefit or loss, but otherwise, actual benefit, we can't analyze that right now. Okay, now value after right issue. 1890.91 into 1100 shares, you get 20 lakh 80,000. Okay, cash paid. How much cash you will pay? 300 shares into 1600, 4 lakh 80,000. So 16 lakhs is your value. Now, if I'm an existing shareholder who had 800 shares, after getting the right shares, now I have 1100 shares. And after right issue, the value is 1890.91. So my total value is this much. But remember, value will reduce if you have paid cash. This is the value, but to raise the amount to this, you have spent 4,80,000 from your pocket. So your total, net benefit or net value is only 16 lakhs. Therefore, no impact on shareholders' wealth. Why no impact on shareholders' wealth? Because if you see over here, 800 into 2000 is also 16 lakhs. 800 into 2000 is also 16 lakhs. So by subscribing for the right shares, you did not get any extra value in your pocket. You just got extra shares. You will get extra value if this share price grows in the market in future. Right now you are sitting at same value. Only thing is number of shares, quantity has increased. Clear? Now, second situation, right renounced in someone else's favor at the value of right. Okay, you sold this right to somebody else at the value of right, not at 100 rupees, like how I told in the example, not at 100 rupees. You calculated the value of right, exact this amount, you have sold the right to somebody else. Now, value after right issue. Now, do you have 1100 shares? Do you have 1100 shares? You have only 800 shares because you did not exercise your right, you have renounced your right. So 800 into 1890.91, you get this value. Okay, whatever the calculation. Okay, calculation value. Now 290.91 was the value of right that you sold. That also gets added. Can you see? Still you are sitting at 16 lakhs. Still you are sitting at 16 lakhs. That means if you exercise your right also, if you renounce your right and sell the right also, still you will be sitting at the same value as per books. As per books. But imagine you got one mail of right issue. Okay, you were thousands of advertisement mails and all there were there. In that middle one right issue mail came from company. You forgot to see that only. Exercise period is over. Exercise period is over. Now we go into the third situation. Ignores right issue. Otherwise, nobody's crazy, right? They can renounce and sell it to somebody else. So why will they ignore the right issue? They have missed the information. Okay, earlier days it used to come by post. They missed that. Okay, they had gone out for some 2 months. That time they missed that letter itself. Otherwise, now mail, you missed the mail. Ignores right issue. Now, value after right issue, this 800 shares you still have. Now, 1890.91. Why 1890.91? Because it is the price after right issue. Now, even if you don't exercise your right, company wants to raise a certain funding, no? Company wants to raise the funding. They'll wait. Then they will renounce and they'll issue it to somebody else. It is not that if you have not exercised the right, like it's not like what I have to tell you is like it's not like share issue. You know that share issue which you studied in school, 11th and 12th and all. It's not like that. Share issue. Company issued the shares. Company did not get minimum subscription. So gone. It is not like that. If you don't exercise the right, also somebody will take those shares. They will just renounce it from you and they'll give it to somebody else. So the market price after right issue will still be 1890.91. This gives you this value. Okay, but here you are going to have a loss. Your valuation will not be 16 lakhs because you did not exercise that. So basically, if you exercise, okay, if you subscribe for the right offer, then what will happen? The value in totality has gone up. But to make it go up, you have spent 4,80,000 from pocket. So your net value is same as before right. So before right and after right will be same. Now how they can ask this in the exam or how they ask in question is, they will tell present and show how the shareholders' wealth has not diminished after right issue. They'll tell show how the shareholders' wealth has not diminished. So what you will do? Value before right issue 16 lakhs. Then you'll do this calculation. Value after right issue 16 lakhs. Clear? And right is renounced in someone else's favor at the value of right. Now if you renounce it at any price other than 290.91, no, then you will be in loss. If you renounce it exactly at that differential value, then only you will be in profit. That means why you will be in loss? Because the other party will be in profit. If you give it at 100 rupees, other party will get 190.91. So obviously you should lose 190.91. Is it clear? So this is like life, no? If you gain, someone has to lose. If you lose, someone has to gain. Okay, now ignores right issue. Value after right issue will be same thing. But the thing is, whatever the opportunity of earning 87,272 is there, you did not take that opportunity. So because of that, your valuation will not be 16 lakhs. 87,272 you lost. Clear? So if right is subscribed, no change. If right is renounced at the value of right, no change. But if at all you ignore the right issue, then there will be a loss that is going to be created. Clear? Then after that we have only one topic, that is buyback. I think you should quickly write this. From demerger, right? Done. That was to wake you up from sleep. When I asked done, suddenly he got shocked. Sudden sleep will go away. Tomorrow you have to come to class, okay? Don't take live online option. Then pakka you'll be sleeping full 3.5 hours. Yes, can I scroll till here? Yes, I'm scrolling till here. Done. This also done. Can I scroll till here? Until here. Yes, can I scroll till here? Done. The first case is completed. No. Yes, is it done? Can we go further? Okay, guys, done. This point we have also discussed. You can write it. Even if shareholder doesn't renounce the right, company will renounce the right as company needs money. They'll still raise their funding, whatever it is. It's not like an initial share issue where that minimum subscription concept doesn't come into picture here. Yes. Can we continue? Done. So many miscellaneous topics we have covered. One more is there, that is buyback. Okay, buyback means what basically? Company purchasing the share back from the shareholder. It's not a merger situation, but it is related somewhere, partial merger it is. That's why they have included it over here. In buyback, what happens? Company will offer, it's not a forced thing, company will offer the shareholder, boss, I am ready to pay a little higher than market. Are you ready to give your share? Usually it is done to increase the promoter's holding. Promoter want to increase their percentage in their company, or if they feel that market price is not proper, it is not properly valued in the market. So we buy back. When we buy back, what happens? Quantity, supply decreases, price will obviously increase. That is one of the reason. One more reason is we feel that someone is trying to take over the company in a hostile manner. Okay, slowly they are acquiring shares. So to avoid that, what we do, we only pay and we acquire the shares. That is avoided. So these are few reasons for buyback. Okay, we are not going into the accounting perspective of buyback here. In buyback, we just have to understand, see, number of equity shares after buyback is nothing but total equity shares. One second, not before right issue, right? Total equity shares before buyback minus number of equity shares bought back. Okay, simple calculation. How many shares were there? How many bought back? Remaining shares. Now, EPS after buyback will be earnings available to equity shareholders before buyback. But from that, what you will subtract? Minus after tax interest on loan borrowed for the purpose of buyback. That was not there only in accounts. In AFM, I told no, we are Bikari basically. Whenever we have to pay money to anyone, we don't have 1 rupee also. So now what we are going to do? Buyback. That means we have money will go out. When money goes out, automatically opportunity cost comes into picture. So we don't have money. So we are going to borrow loan and give them money. When we are going to give them money, interest will be there. So after tax interest will be subtracted. Then divide by the number of shares after buyback. This can also be a question. It's a miscellaneous topic item which will be there. Yes, last thing you're going to write, done, finished. Please write this buyback topic. We had to start actually solving questions today. But we just finished concepts now. Okay, done. Now, there were a lot of miscellaneous topics that we have covered. With that, the concepts of mergers and acquisition is done. Apart from that, now using these concepts, we just have to solve problems of starting material and then discuss RTP and PYPs also. Now, what we will do is, because we have done so many things, we'll quickly revise once. All the miscellaneous things that we have written, we'll discuss. See, from here, point number 1, we'll discuss everything. Before this, what we had? Post-merger EPS. Post-merger EPS, if it is share offer, what will happen? Earnings of acquirer plus earnings of target plus synergy divided by total number of shares after merger. If it is cash offer, what would happen? Earnings of acquirer plus earnings of target plus synergy minus after tax interest rate or opportunity cost rate into the cash price. Okay, divided by the total shares of acquirer only, because there is no shares of target there. Market price, nothing, EPS into PE ratio. If at all we can't take this angle for calculating market value, what we do? We'll take market value of acquirer plus market value of target plus the synergy in market. Okay, whatever is there. Then benefit table. Benefit table, what you will do? You will compare the post-merger EPS or MPS with pre-merger EPS or MPS. You will get the benefit. And there we have to understand, we will not take post-merger MPS or EPS for target, we will take adjusted post-merger MPS or EPS for target. And if it is cash price, there is no post-merger MPS or post-merger EPS. You will always be calculating only the cash paid minus the market price of the share. Clear? And we calculated maximum swap ratio and minimum swap ratio. In maximum swap ratio, the benefit is given to whom? Complete benefit is given to target. And in minimum swap ratio, complete benefit is kept with acquirer. Clear? Now, apart from that, we'll discuss this. Usually in exams, what happens? Acquirer target will be given and some ICA surprise can be, target can be first. So just look at the columns and be careful. That's all. Gain or loss to shareholders. Okay. Always it will be in terms of what? Market value. If P is not given in question, then it is going to be in terms of earnings. But if they tell in the question earnings, then you go in terms of earnings itself. Next, swap ratio computation. If basis is not given, you'll be doing it on the basis of what? Market value, no market price per share. Swap ratio always per share by basis itself. Okay, else you will follow whatever question tells. Next, if question is silent, PE of acquiring company will be the PE of the merged entity. Then fifth, if in question PE is adversely affected, that means PE is going to reduce. Whose PE can be adversely affected? Acquirer. Yes. Six, synergy in earnings. Synergy means what? Additional benefit. Now, additional benefit from acquisition. If both people join hands, what will happen? New opportunities will be there. There will be more benefit. But if it is synergy in market value, it can be because of earnings also. Otherwise, it is just because of the increase in PE. That means it is increase in reputation. Clear? 7. Question terminologies to remember. If they tell you NPV of acquisition, MPV for whom? For acquirer. So it is gain to acquirer. But if they use the word cost of merger, true cost of merger, net cost of acquisition, all this is gain to target. For this fellow cost means for that fellow it is gain. Total gain from merger or gain from merger or gain from acquisition. If they use these terminologies, it's always synergy. Then maximum exchange ratio acquirer can offer without dilution. Acquirer can offer without dilution. That means it's going to be maximum swap ratio calculation. That means gain everything is given to target company. 8. If question provides pre-tax profit, usually it is post-tax profit, but if it is pre-tax profit, remove the profit, remove the tax and then do all your calculations. 9. If question effect on EPS or share price is given, always if they tell what is the effect on EPS for the shareholder, then write the amount in rupees also, write the amount in percentage also. Because we don't know in the answer key whether it is in rupees or whether it's in percentage. Because effect can also be told 8% increase. Or it can also be told as 16 rupees increase in EPS. So we don't know, right? So always write in rupee terms and percentage terms. 10. Computation of synergy in market value. Okay. Market cap, it's just PEAT into EAT. Okay. Increase in market cap is basically your synergy. Okay. Can be due to increase in earnings also. It can be due to increase in PE also. We have seen both angles before. Now synergy in market value, if it is given in question only, what will you do? If it's given in question only, then you don't do from earnings angle. Then VA plus VT plus synergy. If it's given in percentage terms, what will you do? Don't apply on anybody's percentage alone. Total value together you take and then apply the percentage. Clear? Now, if savings of future is given, what will you do? Savings of future will create a perpetuity situation. Take the present value of that. And this should be always after tax. If in question, increase is given in growth rate. That means right now it is 4%. It is going to grow and it is going to grow at a higher rate of 8%. We saw that example. So how to calculate the market price? We follow the present value of growing perpetuity formula. Okay, but what we have to understand, to find the synergy, what will you do? See the market value today with the existing growth rate. See the market value of target company with the new growth rate. Difference whatever is there is synergy. That synergy added to the market value of acquirer and market value of target, you will get the total market value of the company divided by the number of shares. You will get the market price per share. Clear? When you get market price per share, you can always prepare the benefit table using post-merger MPS and pre-merger MPS. 11. In question, P ratio, in question, they have told ignore synergy. P ratio is given in the question and they told ignore synergy. What will you do? VA plus VT is the VAT. That's it. Finished. And in 12, if they tell considering market price of target reflects its true value, that means target company is already showing its true value. So don't add any synergy directly. VA plus VT will be VAT. Clear? These two terminologies can be there in the question. 13. Shareholders percentage of acquiring and target. Acquiring, what you'll do? Existing shares in acquiring company divided by total number of shares after merger. But for target, what will you do? Shares issued to target divided by total number of shares after merger. Now when you're calculating promoters percentage, what will you do? Number of shares issued to promoter divided by total number of shares. Now held by promoter, if you're calculating promoter of target company, what will you do? Promoter of target company, only what is issued to the promoter of target company. Promoter of acquiring company, what will you do? Already what they had. So promoter of acquiring company, what is already there, plus what is issued to the promoter of target divided by total number of shares. These percentages also will be asked in questions. Now 15, if turnover to be computed, inventory turnover ratio and debtors turnover ratio is given. Which one will you prefer? Inventory turnover ratio, because debtors turnover ratio gives you only credit sales. But inventory turnover ratio, the resultant figure will give you cost of goods sold, add the profit and get the sales itself. Next, 16. MPS is equal to EPS into P ratio. Breakdown of formula, we already know this. Okay, 17. If in question, acquiring company is considering allowing target company 25% in the merged entity. Not the regular swap ratio where they tell 25%. Here they're telling acquiring company will give 25% to target company in the merged entity. That means right now, whatever acquiring company is having, that will become 75%. With that, you'll get the total number of shares and you'll get the number of shares issued also. Okay, 18. Minimum price promoters will be ready to accept to give up controlling interest. If they frame the question like this, minimum price promoters will be ready to accept. Which promoter is accepting anything? The target company's promoter is accepting anything. When target company's promoter is accepting, he will want today's market price, plus he will want whatever salary he is losing. So future is going to lose salary, calculate present value. Again, it will going to be present value of perpetuity. That will be the value. Now value of acquisition. If they use the word value of acquisition is VAT minus VA. That means merged entity, what is the value? And what is the value of the acquiring company before merger? That means value of acquisition is not synergy. Value of acquisition is including synergy. Okay. Now value of original shareholders. This is one bakwas thing. Some place they have told not logical. Here, if you see that question repeating again, when we go to that question again, I'll remind you this point. Okay, if they say value of original shareholders, VA plus VT divided by the total number of shares after merger, you will get the value of original shareholders, multiply into number of shares there, multiply into number of shares here, you will get their original value. Clear? 21. Purchase price premium. Whatever extra you have paid divided by the share price, that you will get the premium percentage. Free float market capitalization other than promoters and government, whatever is there, which is freely trading. Take the percentage, take the price of that and multiply. Then 23, purchase consideration or cost of acquisition. Whatever market value of shares issued, debentures issued, liabilities paid, other expenses paid, everything you add, minus the amount received from sale of assets. Cash and bank balance you minus only if inventory and debtors are going to be realized. If it is not going to be realized, cash and bank balance don't go to subtract. Is this clear? Then 24, financial feasibility of acquisition. Just now you calculated cost of acquisition. What is the present value of cash inflows? After taking this company, we are going to get future inflows, right? Calculate present value of that. From that, you subtract the cost, you will get the NPV. NPV, it's like investment decision. Here also, we are doing investment decision, buying one company. Demerger. Part of the company going away. Whatever shares are given to the existing shareholders, calculate that. That's all. Okay, restructuring company. Restructuring company, what is this? Internal reconstruction. So benefit can be only because of two things, asset increase or liability decrease. Then that benefit, how will it be utilized? First to reduce the P&L debit balance. Then for creating some extra provision. Or if asset value reduces. Or if fictitious assets, if you have to write off. If you do all that, that time you will get the benefit which is going to be utilized. After that also, if you have some benefit remaining, transfer it to capital reserve. Then right issue, which we calculated. Here, what kind of question they can ask? They can ask you to calculate the value of right. Value of right, how will you get? Number of shares before. Basically, this formula is before plus after divided by after. Number of shares before into price before. Right shares into right issue price divided by total number of shares. Now, this will be the value of the share. This will be the share price theoretically after right issue. But what will you do? You will see the difference between these two numbers. That means that is the value of right. That means that much value you can get just by selling the right itself. Okay, and we saw this example also. If from this example, what did we derive? If the shares are going to be subscribed, your total overall value will remain same because cash outflow is also there. If the shares are going to be renounced at the value of right, exact value of right, then also your value will be same because whatever value you are going to lose, that you will get in the form of cash. But if the what is say this offer is going to be like ignored, you're going to ignore it completely, then you're going to have a loss. You're going to have a loss. That loss is nothing but what you could have got by selling your right. Okay, buyback. Number of shares after buyback. Simple. Before buyback, what was there? Remove the shares which are bought back. Done. But when you're calculating EPS, post buyback EPS, if they ask EAT, okay, EAT, that is, EAT of acquiring company plus EAT of target company, all that is not there because only one company here. So EAES of the company before buyback, but whenever we have outflow, we have to calculate opportunity cost of that. So after tax interest rate you will take, and then you will divide it by the number of equity shares. So with that, we are done with the concepts of mergers and acquisition. Please go and revise once again, because tomorrow is going to be completely problem solving day. Okay, whatever concepts we have discussed in the last 2 days, that is going to be applied tomorrow. Clear? Yes. So that should be it, guys. See you tomorrow at sharp 6 o'clock. Bye.